is information. But not all information turns into knowledge. Today, every company leaves digital footprints in hundreds of different sources. But this information by itself does not tell you who it is you're looking at and what the risks of doing business with them are. Businesses can't exist in a vacuum. They need employees, customers, partners, contractors, investors. Good counteragents help a company succeed, create products, make profit, expand business opportunities. But what about bad ones? 49% of organizations around the world say that they've been victims of fraud or economic crime. 2/3 of Russian companies say they've encountered economic crime in the past 2 years. This is significantly higher than the global average. Every year, 15% of companies simply disappear, whether on their own initiative or because they're forced to do so by tax bodies, often leaving unpaid debts. If you want to minimize your risk, you need to find and analyze every scrap of information you can, identifying, analyzing, collecting facts. Processing big data is impossible without qualified specialists, experience, time, expensive equipment, new technology, machine learning, graphs. Spark Interfax gathers information from all available sources and converts it into knowledge, allowing you to see the world of business in its entirety with all its risks and opportunities. And there's no doubt that tomorrow we'll be able to understand the world of business even better thanks to the emerging digital economy, cutting-edge technology, and the availability of new information about the lives of companies. Knowledge decreases risks and creates trust, the foundation of any successful business. Knowledge is information, but not all information turns into knowledge. Today, every company leaves digital footprints in hundreds of different sources. But this information by itself does not tell you who it is you're looking at and what the risks of doing business with them are. Businesses can't exist in a vacuum. They need employees, customers, partners, contractors, investors. Good counteragents help a company succeed, create products, make profit, expand business opportunities. But what about bad ones? 49% of organizations around the world say that they've been victims of fraud or economic crime. 2/3 of Russian companies say they've encountered economic crime in the past 2 years. This is significantly higher than the global average. Every year, 15% of companies simply disappear, whether on their own initiative or because they're forced to do so by tax bodies, often leaving unpaid debts. If you want to minimize your risk, you need to find and analyze every scrap of information you can, identifying, analyzing, collecting facts. Processing big data is impossible without qualified specialists, experience, time, expensive equipment, new technology, machine learning, graphs. Spark Interfax gathers information from all available sources and converts it into knowledge, allowing you to see the world of business in its entirety with all its risks and opportunities. And there's no doubt that tomorrow we'll be able to understand the world of business even better, thanks to the emerging digital economy, cutting-edge technology, and the availability of new information about the lives of companies. Knowledge decreases risks and creates trust, the foundation of any successful business.
Good morning, and thank you for joining Renaissance Capital's inaugural Nigeria Tech and Fintech Virtual Conference. I am Adesoji, Solanke, and I lead our frontier and Africa-focused banks and fintech equity research and venture investing teams. 2021 has been a breakout year for the Africa tech ecosystem. Since the beginning of this year, we've seen landmark fundraising transactions, which have attracted heavyweight global venture investors, such as SoftBank, Sequoia, and Tiger Global, and new unicorns coming to life with Flutterwave, OPay, and Wave being some of the major ones, which all happen to be in the fintech space. When we look at some of the data, we find that African tech companies have raised over $2.5 billion year to date across over 450 deals, which is more than double what was raised in August 2020 year to date, and already more than 30% above what was raised in all of 2020. This highlights the growing interest that Africa continues to receive in this environment. When we dissect by country, we find that Nigeria, Kenya, South Africa, and Egypt are the leading destinations for venture funding on the continent, which are all markets where we have offices and boots on the ground. Startups headquartered in these countries combined to account for close to 90% of total funds raised in Africa year to date. Nigeria tops that list with a 43% share, implying $952 million raised across 110 plus transactions year to date. While fintech is the most active sector in Africa, attracting over $1.5 billion year to date, which is almost double what the sector attracted all of last year. Within fintech, we find a wide range of solutions that entrepreneurs are looking to build, which spans across agency banking, digital wealth management, open banking, offline and online acquiring, digital lending, alternative credit scoring, crypto-based solutions for remittances and stock trading, amongst many others. One final positive development on the continent is that the share of funding going to startup teams with at least one female co-founder has almost doubled to 15% relative to last year, which is a big thumbs up for the investor community. So with all this activity going on, you're probably wondering, where does Renaissance Capital fit into all of this? The first thing you should remember is that we are a 25-year-old emerging and frontier markets-focused investment bank, leading across all our markets. We lead with transparency and knowledge, and this is why our research team continues to maintain its leading rankings, which supports the innovative advisory work of our investment banking team, while facilitating capital flows across multiple countries and issuers. Secondly, Renaissance Capital has decided to double down on the Africa tech and fintech space. This simply means that we will be taking our competencies, which typically focus on large corporates, to support the tech ecosystem on the continent. This is why we're having this conference today, and it's the first of its kind for us, despite having already worked with leading names like Fowry, Fairmoney, and Accelerex Holdings on the continent. We will support the ecosystem in three primary ways: advisory, research, and venture investing. As we've already done in public markets, we will once again lead with knowledge and transparency to help reduce the friction with sourcing equity or debt capital for tech companies, driving exits, mergers, and acquisitions by connecting entrepreneurs with financiers and strategic investors around the world. Some of our research you may have already come across, and there will be many more as we go on from here. On the investing side, we will be allocating capital off our own balance sheet to support some of the most promising tech entrepreneurs we come across on the continent, across seed to Series A stages. And if you want to reach us, please email africatech@rencap.com. Finally, we have strengthened our team significantly over the past month to focus on these new initiatives, and we continue to invest in our Africa franchise as we remain firmly committed to supporting investors and founders like we've been doing for well over a decade on the continent. Once again, I welcome you to our inaugural Nigeria Tech and Fintech Virtual Conference, and I hope you find the many conversations we have lined up for you today highly insightful and engaging. I look forward to staying in touch and hope you have a wonderful conference.
I'd like to thank everyone for joining the inaugural Renaissance Capital Nigeria Tech/Fintech Conference. I think we start this conference by having a discussion with the regulators, or perhaps aptly put, infrastructure providers. These providers provide the regulation in which many of our tech and fintech platforms lay upon, and they also provide infrastructure for creating value via the capital markets. The speakers on here today represent a large subset of this regulatory base, and I'll start with a very quick introduction of those parties. We've got Temi, who is the CEO of the Nigerian Exchange Limited, Olufemi, Sojinrin, who is the Chief Information Officer of NIBS, and Emomotimi, Agama, Deputy Director and Head of Registration, Exchanges, Market Infrastructure and Innovation at the SEC in Nigeria. Just to set the scene here, what we're going to try and do is further understand the thoughts of our infrastructure providers / regulators, how the outlook for the ecosystem and the various initiatives many of them are putting in place. I think we've got three regulators / providers here, and what we'll try and do in the spirit of constructiveness is make sure that the focus is in their remit and not without. So starting off, perhaps I can draw on Temi, the CEO of the NGX, to talk around capital formation in Nigeria. The NGX recently demutualized, and that's seen as positive. And this is one of the reasons I have said it is an infrastructure provider as such to a regulator, because there is a different division that does that. But we'll say in Nigeria, for example, capital formation has been few and far between. There are IPOs every 3 years, and a general malaise from the investing public. This could be as a result of experiences from the past, but something that has been addressed in multiple markets that have gone through the same cycles that we have. On the other hand, we've seen the tech community bring together entrepreneurs, ideas, and capital in a very, very quick and rapid fashion, typically private, and in many cases via offshore markets. What solutions and innovations is the NGX looking to put in place to address this? Thank you.
Sam, thank you very much for the question. Let me say good morning to you and to all of the participants, also to the other panelists, and to start by commending RenCap on what is, in my view, a brilliant initiative. Thank you. You know, it's always good to see intermediaries really invest time, resource into just deepening and developing the market, particularly this sector. So thank you to you and everybody at RenCap. You ask a question that, in my view, is obviously very important, but it is within what I would call one scope of the services that we deliver, which is really listings. As you know, as a market infrastructure, we do both listings and we offer some sort of ability to trade in the secondary market. So if you'd be kind enough, I would just very quickly perhaps expand the scope of your question, and then I will come back to directly address what you ask around listings and capital formation. If you think really around what I call this exchange, as it were, and interaction with technology, and if you look at it really along the lens of, say, digitization on one hand, digitalization on the other, and digital transformation, what you would find is that the exchange today is an extremely digitized place, an extremely digitalized institution. I would say both internally and also in the way people consume our product. So for example, it's going on nearly 2 years now that there has been no physical trading on the floor of the exchange. It's all happened digitally. I think that's a remarkable testament to, you know, just all of the technology, call it interactions at the exchange. Of course, speaking now to this sort of secondary trading part of our business, there's this digital transformation that really then is the next phase post this demutualization. And I think the problem set there is relatively straightforward, which is how can we as an institution ensure that, you know, the way that last mile delivery, as it were, of our product is extremely digitized and consumes through technology. Another way to think about that is that why should it be easier for a Nigerian in Nigeria to access foreign securities than it is for them to access securities on our exchange? So all of that body of what I'll call digital transformation needs to be done. I'm glad to see the SEC represented here. They are the apex regulator, and they are taking a very active lead on this while we also work with them. So, that's that on the sort of secondary markets trading side of things, which is really to communicate that the exchange of the future is one that is actively trying to address this question. Because once you do that, then we really start to address everything that the exchange is there for, whether it's, creating wealth, helping the nation, helping corporates achieve sort of capital raising and capital formation objectives. Now, I go very quickly to our listings business. And you made some extremely important points as you spoke. There is indeed capital being formed all around, particularly within the tech ecosystem. And the question then is, how can we as an exchange sort of participate and facilitate this a lot more? And a lot of things come out and stand out very quickly. I think the first thing people need to remember and realize is that a lot of this funding within tech tends to be more early stage. As you would know from the stages of capital formation, the listing process is really sort of a more mature path when a lot of the VC and the angel investors and indeed the PE investors are done. But nonetheless, the question does need to be asked, and we are asking that as an institution, that what would it take for the exchange to get more involved with all of the work that is happening with the tech ecosystem? The reason we're asking that is partly selfish, because as an institution, we need to get involved. These are the companies of tomorrow. And to your point, is really where you're seeing the activity. To address that, I should say quickly as well, it's a subject the exchange has tried to address in the past. We do have a growth board, as I'm sure you're aware. We have a company like BrickLinks that raise capital through that growth board. But nonetheless, a lot of work needs to be done. So what are we doing? There are certain things that I can't really go into much detail on right now, but I think philosophically, the way we are approaching this is to come to a realization very quickly that the way that our rules are currently set up and the way that our boards are currently set up may not necessarily be particularly, call it, acceptable to the tech ecosystem. So you would find things, for example, everything from what I call investing philosophy, where perhaps the typical investor in Nigeria, the way they would view a tech investment will be different. They might be looking for dividends as an example, and we know that that ecosystem doesn't quite participate like that. So there's all that sort of, call it, education that needs to happen. But more importantly is if we come back to our platform and you look, for example, at the way all of the capital is being raised. These are typically in foreign currency, as an example. How do we make sure that we're friendly towards that? These are typically dual class structures also, as an example. How do we make sure that we can accommodate that? How do we make sure that our rules really accommodate the fact that the landscape is changing and is evolving very rapidly? So all of this body of work, the exchange, again, is working both internally, externally, to ensure that there is a platform that is acceptable for all of this. The final thing I would say before I then pause is also the way we view technology going forward. Technology historically, you would find perhaps in most businesses, there's been more of, I guess, support, as it were. Technology at the exchange post-demutualization is a standalone business line. It is a business that then enables, call it, support. So you would find the exchange increasingly ask itself how it can do more through technology, perhaps to drive revenues, which is really one of our sort of ethos now, post-demutualization, and also, as it were, to drive and develop this market architecture responsibility that we have. So Sam, I think I've spoken quite a bit, but I just thought it was important for your audience to understand really how the exchange is viewing this subject. Thank you.
Thank you very much for that. And I think it's very clear what we will be looking forward to, and holding you to account is on the positive developments as you look through many of these changes and innovations as we push forward. And perhaps now we move on to Olufemi Sojinrin of NIBS. When we look at the Nigeria ecosystem, we can almost say that there's a disproportionate focus on payments. Many of this lies in the fact that there's a belief by many entrepreneurs that payments can be more efficient, and also there's a large segment of the population that needs to be included in that ecosystem. Payments has been the forefront of the new tech economy, and I think if you look at the capital that has been raised, a big portion of that has gone into that payment system. And the liquidity there has supported the creation of jobs and many other positive things. How does NIBS support the development of the onshore tech ecosystem? And what plans does NIBS have in its position to reduce friction and enable sandboxes so new partners can easily come, test the ideas, and create value and jobs as well, and wealth within our country?
Thank you, Sam, and good morning, everyone. Good question, and I think that question actually speaks to the core objectives of NIBS. NIBS was set up in the middle 90s, I believe 1994, and we are jointly owned by the money deposit banks as well as the CBN. And our core objective was, one, to create an automated settlement system. Those who remember how the settlement system used to work back in the days know how it has really transformed over the last 2 decades working with the CBN. We've put in, so I'll just touch on some of our products that we've put in from the beginning of the foundation of NIBS up to some of the earlier products that we've released to try and facilitate and enable the payment system as well as support the fintechs. Right, so like I was saying, NIBS was set up for 3 major reasons. One, to automate the clearing and settlement system within the Nigerian banking system. 2, to support the cashless policy that CBN have been driving, or the regulators have been driving for a couple of years now, and also to deepen financial inclusion. We know we are an odd 200 million people in Nigeria, but till today we have up till only about 160 million accounts, and you know that these are accounts that I may have 2 to 3 accounts. So unique accounts, I would say we have only about 49 million accounts within the Nigerian banking sector. So that shows, that disparity shows that there's a lot of growth opportunities within Nigeria when it comes to payment and banking. So in terms of what NIBS is doing to ensure that we facilitate and improve the efficiency, like I said, one of our legacy solutions was the automated clearing system, which built the foundation for some of the services that we're releasing today. And then we released our NIBS interbank payment service, which at the time was really novel. There were very few countries at the time that were processing and giving real-time transactions and providing real-time settlement. That service enabled growth within the Nigerian economy. It brought down the cost of processing, and it also provided instant value for our customers. More recently, we've released what we call NQR, which is the NIBS QR response payment service. And NQR basically provides an added layer of efficiency on top of the services that we provide. It also comes very, I would say, suitable in the present situation within the country or within the world when we're dealing with the coronavirus effect. And what it allows you is, without touching the terminals, you can use your phone to scan and make payments to merchants. Now, this service does not only enable interoperability between all the banks. It also allows the fintech innovate on this product. Now, those who are very conversant with this payment mode have seen how it has been applied around the e-commerce payment space, as well as the retail payment space. So you have situations where people can do automated checkouts without physically making payments with individuals. So you can take your phones and scan the QR code to enable payments. We also have layered a couple of other services known as the biometric authentication service. So the BVN service is what I would call an identify and payment service. What NIBS has done is link the BVN with your NIN, as well as your other biometric. Your NIN is your national identification number, as well as your biometric identification, like your fingerprint, as well as your facial recognition. And with that integration, it's obvious again how the fintechs can use that to innovate around payments, not just within the banking industry, but also across identification, identification around places within the Nigerian banking sector. So these platforms that we release is helping us reduce cost within the Nigerian banking space. Now, we also talked about the possibility of a sandbox experience with the introduction of open APIs, which is something taking a lot of notice within the banking sector, within and outside of Nigeria. It's obvious what kind of capabilities it brings. It allows us to innovate, it allows us to partner with all the stakeholders within the sector. This is something that NIBS is actively looking at. Within the coming month, we've already piloted our internal sandbox experience, which we would make more popular at the end of the year. When we release this should allow self-service and also, help some of the fintechs within the Nigerian banking space improve on the innovative products that they have. Besides providing an innovative platform for the fintechs and partners within the Nigerian banking space to innovate, we also provide training. And I think this is one area where very few people know that NIBS has that capacity to provide. So we provide training around regulatory compliance, around use of our products, and basically customer service and things that can help growing fintechs launch their businesses. So in a nutshell, those are the platforms that NIBS provides. They're in our common discussions. I'm sure we'll touch on a couple of other things. So I'll stop there.
Thank you for that, and that was clear. And it's good to see many of these innovations and links, because the future is simplicity, and at the end of the day, that is what technology enables. Now we move on to the SEC, Mr. Agama, and the SEC is the apex regulator and promotes capital markets whilst protecting investors. I think those two parts of the equation cannot be unbalanced. You have to promote a sustainable capital markets for it to grow and for it to add value to any society or economy. And this is much needed in Nigeria, because the experiences have shown that investors do need some level of protection. And as products evolve, there needs to be set criteria for the parties that are able to sell those products, as well as the formation of those products. There's a large non-qualified segment of the economy that looks for returns, whether it be high or modest. And I think the SEC has a strong role in pushing that. How does the SEC intend to further its role without burdening new entities looking to innovate and promote growth in the economy?
Thank you so much, Samuel, for the question, and also very happy that Renaissance Capital is running such a program to promote African investment. And of course, indeed, I say good morning to Temi and Olufemi. It's really a great opportunity to be able to speak on behalf of the SEC regarding what we are doing in this space. But, you know, what is gladdening is that, Samuel, you've already taken it off my, my lips regarding what we do, regulation and market development. There are two sides of the same coin, very important, very interwoven, and symbiotic even in nature. But clearly, you also made mention of the fact that the space where we operate with over 200 million investors or intending investors, a good number of those investors actually do not understand investment. And because they don't understand investment, a lot of people go into so many kind of stuff that they shouldn't ordinarily go into. And when they get beaten, of course, the next place to cry to will be the SEC, or the next person to weep will be the SEC. And so it is, naturally a very, very critical position that we have found ourselves in trying to bring a balance between regulation and innovation, and then protection of investors, and of course the thorny issue in the space about restriction of innovation. But I think clearly that point about restriction of innovation or inhibiting innovation is a misstatement from the uninformed. And I say that with all sense of humility, because the number of persons that have really been burnt by the actions of, innovators in quotes is so much that you will rather do what you need to do to make sure that this does not happen again by introducing regulation, even though it's construed the other way. So for us at the SEC, fintech is in our blood, fintech is in our space. We can gladly, or we can beat our chest to say, as a regulator, we are about the most innovative in this space regarding regulation of fintech and being open even to the fintech institutions. But I need also to mention that that does not just come the way it came. It is because that's actually the way the system or the financial system is wired. When you speak of financial market infrastructure and really speaking to the IOSCO principles of financial market infrastructure, you find out that what you speak to will be about 70–80% capital market and maybe 20–30% money market, payment systems. So when you speak to financial market infrastructure with all of the categories of issues in financial market infrastructure, what you have is more of capital market, less of the payment system. However, in the universe of institutions that are actually in fintech, you have so many of them in the payment system. Hence, it does appear as if the capital market is smaller than the money market or the payment system. So clearly, it gives us a very, very important role and significant role to play. And the most significant really is that of investor protection. So all we do at the SEC is try as much as possible to do that responsibility that we have been provided, to do by the ISA. Section 13 of the ISA specifically speaks to that, function that we try to execute so faithfully. But in doing that, do we stifle innovation? No, we don't. And speaking to that, I will clearly take us back history. What we have done in the last 3–4 years is when fintech started in this space, what we did was, in order to get everybody along, there was a fintech committee, a fintech roadmap committee, a market-wide committee, which brought together every stakeholder, conceivable stakeholder within the space. So come, let's think about what next. This thing is going so fast and it's running so fast. If we do not catch up with it, well, it will be hard for us to catch up with it. So we set that up, and led by a market committee member, Adesoji was the chair of that committee, and that committee fashioned out clearly, trying to possibly diagnose the entire system in order to provide particular pillars for which growth can be achieved. Having done that, we went further to set up a blockchain and virtual financial asset committee, and the intention was clearly because in most of the fintech assignments of fintech products that we see, the base of such products is the blockchain, digital ledger technology. And so that committee was set up to say, okay, what regulation, what do we need to know and understand around it? And of course, it is extended to the virtual financial asset. Having done all of this, we set out to introduce our clarification and classification guidelines, September 2020. To say, this is what we are going to do. This is the area we are going to work on. Having done all of this, we can see the results. We've started registering companies in the fintech space. And just to add more, just recently, just this week, we issued or released the robo-advisory guidelines for robo-advisory operations in the Nigerian capital market. Not long after now, what you'll be seeing will be a regulatory incubation guideline, which we've actually socialized, and we'll definitely start operationalizing these guidelines in order for new fintechs, innovative young persons to come in and let us see exactly what they are doing and how they want to go about it. The essence is simply two things. One, risk management. Two, investor protection. And at the end of the day, I think the market will be the better for it, knowing fully well that the next frontier is actually fintech, all about capital formation and growing the capital market in a digitized format, as the NGS and other participants in the market are actually leading on us to. Thank you.
It's very pleasing to see that you're moving very quickly. We will be reviewing the robo-advisory guidelines and looking forward to the additional innovations that the additional guidelines to innovation that the SEC is putting in place. I think the SEC has typically been quite open, and we are going to rely on that openness and, of course, naturally stretch it in many cases. Perhaps we move back to NIBS, and NIBS has basically developed quite a few innovative products, some of which are fully live, as we mentioned earlier, but by Olufemi, but others that perhaps people want to understand where they stand. So BVN for customer verification, linked to NIN, I think that's clear. With the facial capturing being put on there, I think the ability to stretch that for payments is quite intriguing. I think we also know that NIBS is looking to a Nigeria card scheme. It would be good to understand where we are on that and what is expected. There's the global standing instruction, which addresses issues around loan payments and perhaps feeds into a broader, more digital ability to provide credit to the market. It'd be good to understand that. NIBS also has Pay Africa, which is a cross-border payments platform. And this could essentially lead to more simple, cheaper ways of transferring value across the African continent and even outside of it. It would be good to understand the status of that also, as well as any other innovations perhaps that have not been highlighted in the public forum that you can disclose naturally. Thank you.
Okay, yes, thanks, Sam. So I'll start with the national card system. Okay, I'm sure we all realize that the Nigerian card system is largely dominated by three major players: MasterCard, Visa, and Verve. And even within those three, there are still investments within Verve that are international based. So it's clear that there's still a large space that we need to play in terms of local card introduction. So what NIBS plans to do is to ensure that that gap is closed, providing a national card system allows us further reduce the cost of transactions, which is one of our primary objectives. And it allows us deepen financial inclusion, like I mentioned earlier, there's still a large amount of Nigerians who do not have access to financial services. So this card allows us to further improve on the amount of people that we can pull into the financial services industry. Now, the card system is still a project that we are discussing with the CBN and some of our internal stakeholders. It's a project that we intend to launch before the end of the year. And like you know, we need to ensure that we have the relevant processes, policies, and infrastructure in place to ensure that when the card system comes out, it's something that is standard and can compete with the international cards that we have. So as much as we realize that it's important for growth within the sector, we also want to ensure that when we do this, we do it properly. We're working with, like I said, some external stakeholders without having to give out too much to make sure that this works. And when we introduce it, I guess it's clear that we can also layer a couple of services on top of that. We have the national ID card. So the card scheme can act as both a payment platform as well as an identification platform. And you can see that the innovative possibility around that is limitless to use that word. Now, I think the second initiative you asked about was the GSI, which is with Global Standing Instruction. Now, that service is in production as we speak. So it's a service that is readily available for our customers to use. Now, just a brief introduction of that service. It basically has two components or categories of the service. The Global Standing Instruction Service can be used by the banks to drive the credit quality within the institution. It takes advantage of the BVN service that we have to aggregate accounts. So it means that for a particular account holder, we actually know his account in all the banks. We know his ability to repay across the banks. So this means from a banking perspective, it's convenient for customers to ensure that, or it's convenient for the banks to ensure that there's reduced fraud, increased credit, and it improves our collection capability. Now, from a payment standpoint as well, there's a lot of value that this service can bring. Like I said, a lot of the services that we have are layered on top of each other and can be used as a combined service. So if you combine the GSI service with the BVN service, the payments, the fintech service providers can basically build products that allows you identify your customer, can allow the customer decide on which account he wants to use for payments. And based on that, we also have a centralized identification and security system that we're working on with the banks, which we will be releasing soon as well. Layered this on top of that service, it means that you can actually verify payments using any of your accounts nationwide. We also have a product called Central Pay. Central Pay is NIB's unique payment portal. It provides the standard payment capabilities like cards, but it also provides NQR payment as well as account-based payments. So it allows you make payments by putting in your account number without having to provide any. If you have your card, if your cards are not with you, or if your phone is not with you, you basically can make payments using your account number, layered on top of the security system that we've put in place with the banks. So these are a couple of the products that NIBS has released and is releasing to ensure that we further drive down the cost. You also mentioned, I believe, PAPS, which is the Pan-African Payment Settlement System, which is, I would say, our counterparty service that's been run by Afrexim Bank. And this service is built to drive inter-trade and inter-Africa payment. We have, in terms of the status of where we are, we have started discussion again without having to provide information that's not required at this time. But we have, we're in deep discussions with PAPS and Afrexim Bank, and I believe the global picture in terms of payments is pretty clear. We want to be able to facilitate payments across Africa. The central banks within Africa are also on board these discussions, and layering that on top of the AFCA agreements that's supposed to drive intertrade within the African space, we can see how trade and commerce between the countries in Africa will grow the economy. So in a nutshell, I hope I've touched on all the questions that you've asked. You can let me know if I've missed anything out. Thank you.
I think you covered it all, and we look, as always, we look forward to seeing many of these come through. And I think the way you've said it, also around the sandboxes, means that these could be quickly deployed in a secondary derivative way to provide value for consumers across. We'll move back to the SEC, who have been doing quite a bit in terms of setting the pace on fintech regulation. The SEC has an innovation and fintech portal, has commenced regulation of digital stockbrokers, many of whom also have foreign currency operations. Also mentioned earlier was the fact that there's now rules around robo-advisory, and there's more other sectors to be covered. Many of these innovations require engagements with other regulators. How does the SEC engage other agencies to ensure there's an alignment of stance with regards to what is permissible and what is not permissible? And and this would be advice for the fintech community. How does the SEC think the fintech entities should go about regulatory engagement and advocacy?
Well, thank you. This question couldn't have come at a better time, especially because of how a lot of fintechs and indeed the populace see the SEC. One of the things I would say always, for those that have engaged with the SEC, we are very, very open. We are always available. The idea is, well, it's like, seeing your father and wanting to think that your father is a terrible person. You know it yourself, that your father certainly is not a terrible person. It's only that he has to guide you. And if he gets too playful with you, you will not understand how good his advice is or how useful it is. On Samuel, you understand that? I'm sure all of us can relate to that. So clearly we are available, always available. We've had several discussions, several engagements, and we continue to do so. And what we say is that it's better that you come and ask questions than doing what is wrong and later coming to seek for a reprieve. We are not such regulators. If you violate the rules and regulations, and indeed the Investment and Securities Act 2007, the full weight of the law will come upon you. But what is important is that before even attempting to violate it, why don't you come and ask the SEC, I want to do this, I want to do that. Is it possible for me to do it? What are the things I need to do? Are there licenses regarding this activity that I want to be involved in? And sometimes, because a lot of young people do not actually read, so to speak, beyond what they have learned, they probably do not know. The Investment and Securities Act, Section 13A of that act simply says, and very, very crisply too, that the SEC regulates the investment and securities business in Nigeria. Simple. So if you are doing an investment and securities business in Nigeria, you do not have anywhere else to go, basically, other than the SEC, because that is the law, and it empowers us to do so. And what is investment? You know, when you start thinking about returns, that you are promising returns, that there are going to be returns regarding that, and you are issuing securities in whatever form you want to issue it, as long as you fall within the PLC brackets, as we speak today, you must be under the regulation of the SEC. Having said all of this, we have continued to engage. We will continue to engage. We have the external relations, division of the SEC. Besides, people like me that have been open to everyone that has actually come to ask a question. I head the registration, exchanges, market infrastructure, and innovation division, the department. And that simply has four divisions. One of them is onboarding of new entrants into the capital market. So whatever you are, we onboard you into the market. So if you have any question, of course you can reach out to me. You can reach out to the SEC, and we'll definitely, deal with the issues that you have. Then the SEC specifically, because of the times, created the Fintech and Innovation Division. What is the essence of that? The essence is, can we speak to these people in the language that they understand? And that is what we've been doing for the last 3 years, and we're still running. And that's what brought about the idea of the regulatory incubation. And if you must know, the SEC belongs to GFIN. I'm sure you know GFIN, the Global Fintech Network. And the reason why we are part of that group is because we share the same aspirations, global aspirations about the growth of fintech, the use of fintech, the importance of fintech in the ecosystem and in the general build-up of the capital market. However, it is important to note clearly that these young fintech stars need some assistance. What kind of assistance? The assistance of putting them in the right direction. A major challenge in the fintech space is the lack of structure and governance. And for the SEC, for you to be able to collect money from people, from investors, from individuals, promising them returns, you must provide some structure. You must provide some elements of governance. It is not a fly-by-night business. The SEC, as part of its mandate, is market development. And we are the only regulator in the world, that I know that has those twin mandates of regulation and market development. And that is principally speaking to the contextual development of our client. And you made mention to that. So we are, the SEC, are open, available 24/7 to make sure that we build an ecosystem that all of us will be proud of. All of the unicorns that the Nigerian space has produced in the last 2 years has been a great pride to the Nigerian nation. But we believe and hope that where that pride will be even more justified is when we find them listing on our exchanges and, of course, growing our market. We believe and hope that is an aspiration, the fintechs are looking out for. And I'm sure the exchanges in Nigeria are fit and proper and are geared to assimilating and accommodating such institutions. We very well also know that as SEC, we will continue to support innovation, we'll continue to support fintechs, and we'll continue to support the Nigerian economy. Thank you.
Thank you very much for that. And I think we all mirror that in that we want to see a more developed market that can basically create value for all. And I'll just go very rapid fire now, and perhaps I'll address these questions to all three panelists, starting with Temi, then Olufemi, then yourself, Mr. Agama. So what aspects of the fintech or fintech developments are you most excited about, and which areas require more caution? Starting with you, Temi, then Femi, and then yourself, Mr. Agama.
Okay, thank you very much, Sam. I would say that there are a few parts. One way that I think about this is really the fact that, as they say, a rising tide lifts all boats. One of the remarkable things that the fintech ecosystem has done is to create a general awareness, I would say increased awareness, just around capital markets and just what you can really do as far as personal investing is concerned, or perhaps just looking for financial return. So that, naturally then has created, I would say, at least more attention and visibility to the subject of investments, which then ultimately has a knock-on effect to our institution. But I think more importantly, I spoke earlier about how the exchange, as we think through what I call our last mile distribution, there is no way that we can do that without two things. One is relationships. The other, of course, is technology. If you look at our historic intermediaries, they do very well on the relationships, but post-demutualization, one of the things that we'd be doing, working with these existing intermediaries, but particularly also what you call fintechs, is really how we can then address that ability to use technology to democratize finance. And so that also excites me because the fintechs are doing quite a bit of that. And I think there's a lot more that we'll be doing together with them and with other stakeholders on this subject. Away from that, then also things around blockchain. If you look at what is happening in a few exchanges notably, you would find very quickly that blockchain also is the future. And so for us as an exchange, we're asking ourselves, if you look through all of the parts of whether it's the capital raising process, the secondary market trading process, or perhaps the settlement part of the entire ecosystem, which are in our control and which do we think is open to potential disruption or perhaps optimization. And I think if you think through just the secondary market trading, one of the things that we would be looking to pilot and look into a lot more with the regulator is really how you can apply blockchain into exchange of assets. And I think that is, I would say, the midterm future. Away from that, I think looking and thinking further out of things around artificial intelligence. Increasingly, you are seeing a lot more digitization of assets. And so whether those are traditional assets, whether those are other asset classes that are not traded traditionally, whether that's real estate, for example, or art. As an example, you're going to find a lot more tokenization and digitization of those, which is really how the future will be. And I think that finally, what I would say as far as when I think about, in this case, I think a broader subject around technology. And what excites me about that with the exchange is just the fact that the exchange has the potential ability to help spur what is clearly the next, sort of wave of growth and development in Nigeria, which is around technology. So it brings me back to really, as that ecosystem continues to grow and to develop, I think I saw a figure that we're on course for close to $1 billion worth of capital raised this year in Nigeria alone. Why is that figure 1 billion? Why isn't it 5 times that? I think that the exchange is looking to answer that question and to spur that. So I think all things put together, these are the things. Thank you.
Thank you very much. And then Olufemi.
Thanks, Samuel. I think I would say my initial or immediate excitement is around what we can use, 2 major products that we have released from NIBS. There's still a lot we can do around the QR payment. We've seen how China has used that service to totally change how payments is made within the Asian market. And a new service that NIBS is about to release called NXPay. NXPay allows payment to be done through email as well as using your mobile numbers without having to remember your account. So using email addresses, people can seamlessly make payments in a secure way. Now, if we go back to the QR code payment, it can be applied, because we have BVN. People forget that BVN is not just a number, but it can be used in any scenario where you have to identify and where you have to pay. So the use cases are limitless. From unmanned retail, we have seen services from Amazon where people go into retail shops unattended and can make payments. The QR code is a service that can be used to facilitate this within the Nigerian retail space, all the way to immigrations. In the airport, you have people showing their passports to identify themselves to enter the country. This is something that we can use biometric to solve. You have little payments going all the way to how we make payments at the toll, how we facilitate payments in transportation. So the ability to improve on the payment space within Nigeria is so huge, and it's exciting. And it would also provide an opportunity for companies to grow and for Nigeria to continue to improve on being the #1 destination for foreign direct investments. In terms of caution, I would say, of course, when there is growth in any space, there is also the ability for fraudsters to take advantage of the situation. So as we grow in enabling our payments, continue to innovate and use services like blockchain, we need to ensure that we layer that with the right security on top of it to reduce crime and to ensure that will I say, when customers use a service for the first time and there's a high possibility of fraud, then the return use of that customer becomes very low. So we want to be able to ensure that we provide confidence for first-time users. And the only way we can do that is to ensure that the fraud rates on a lot of the services that we provide is very low. And that's the only area where I say we should tread cautiously and provide the right service to support the payment industry. Thank you.
Thank you for that, Olufemi, and very interesting views. And finally, Mr. Agama.
Yeah, Samuel, for me, the entire space is available for the take with fintech. So, and that tells you the limitless nature of the opportunity that does exist. If we take our minds back to Joseph Schumpeter, the 1950 economics Nobel laureate, that spoke to the issue of creative destruction. That's exactly what fintech is. And that rolls back to the theories of Karl Marx. And in all that we are being told is creating a new tool to take over the old business. What better tool can we use to do that other than fintech? So there is no limitation as to what excites me, because if you take the entire capital market space and spectrum and you introduce fintech into it, there will be a revolution that will be creating a new paradigm that will be required and is also quite necessary for the millennial, because that is their space and that is their environment. So everything is exciting. Blockchain, digital ledger technology. There are several use cases in capital market that are yet to even come up. People are still thinking. And as we go back to destroy the old tradition in order to introduce a new paradigm, the SEC and the capital market are geared to making sure that the environment is good enough, the regulatory space is good enough for anyone that wants to do business properly within the framework of the law and innovation to be accepted, welcomed, of course, ushered into the new euphoria. And that euphoria is about successful business within the framework of the capital market.
Thank you very much for that. And I guess on that note, we've all heard how our regulators and infrastructure partners are looking to bridge the gap between regulation and innovation. There is strong support, even though there are certain parts around investor protection that always come to bear. Thank you all for listening to this panel, and we look forward to your continued participation over the course of the day as we explore various parts of this ecosystem. Thank you once again.
Thank you.
Knowledge is information, but not all information turns into knowledge. Today, every company leaves digital footprints in hundreds of different sources. But this information by itself does not tell you who it is you're looking at and what the risks of doing business with them are. Businesses can't exist in a vacuum. They need employees, customers, partners, contractors, investors. Good counteragents help a company succeed, create products, make profit, expand business opportunities. But what about bad ones? 49% of organizations around the world say that they've been victims of fraud or economic crime. 2/3 of Russian companies say they've encountered economic crime in the past 2 years. This is significantly higher than the global average. Every year, 15% of companies simply disappear, whether on their own initiative or because they're forced to do so by tax bodies, often leaving unpaid debts. If you want to minimize your risk, you need to find and analyze every scrap of information you can, identifying, analyzing, collecting facts. Processing big data is impossible without qualified specialists, experience, time, expensive equipment, new technology, machine learning, graphs. Spark Interfax gathers information from all available sources and converts it into knowledge, allowing you to see the world of business in its entirety with all its risks and opportunities. And there's no doubt that tomorrow we'll be able to understand the world of business even better, thanks to the emerging digital economy, cutting-edge technology, and the availability of new information about the lives of companies. Knowledge decreases risks and creates trust, the foundation of any successful business. Knowledge is information, but not all information turns into knowledge. Today, every company leaves digital footprints in hundreds of different sources. But this information by itself does not tell you who it is you're looking at and what the risks of doing business with them are. Businesses can't exist in a vacuum. They need employees, customers, partners, contractors, investors. Good counteragents help a company succeed, create products, make profit, expand business opportunities. But what about bad ones? 49% of organizations around the world say that they've been victims of fraud or economic crime. 2/3 of Russian companies say they've encountered economic crime in the past 2 years. This is significantly higher than the global average. Every year, 15% of companies simply disappear, whether on their own initiative or because they're forced to do so by tax bodies, often leaving unpaid debts. If you want to minimize your risk, you need to find and analyze every scrap of information you can, identifying, analyzing, collecting facts. Processing big data is impossible without qualified specialists, experience, time, expensive equipment, new technology, machine learning, graphs. Spark Interfax gathers information from all available sources and converts it into knowledge, allowing you to see the world of business in its entirety with all its risks and opportunities. And there's no doubt that tomorrow we'll be able to understand the world of business even better, thanks to the emerging digital economy, cutting-edge technology, and the availability of new information about the lives of companies. Knowledge decreases risks and creates trust, the foundation of any successful business. Knowledge is information, but not all information turns into knowledge. Today, every company leaves digital footprints in hundreds of different sources. But this information by itself does not tell you who it is you're looking at and what the risks of doing business with them are. Businesses can't exist in a vacuum. They need employees, customers, partners, contractors, investors. Good counteragents help a company succeed, create products, make profit, expand business opportunities. But what about bad ones? 49% of organizations around the world say that they've been victims of fraud or economic crime. 2/3 of Russian companies say they've encountered economic crime in the past 2 years. This is significantly higher than the global average. Every year, 15% of companies simply disappear, whether on their own initiative or because they're forced to do so by tax bodies, often leaving unpaid debts. If you want to minimize your risk, you need to find and analyze every scrap of information you can, identifying, analyzing, collecting facts. Processing big data is impossible without qualified specialists, experience, time, expensive equipment, new technology, machine learning, graphs. Spark Interfax gathers information from all available sources and converts it into knowledge, allowing you to see the world of business in its entirety with all its risks and opportunities. And there's no doubt that tomorrow we'll be able to understand the world of business even better, thanks to the emerging digital economy, cutting-edge technology, and the availability of new information about the lives of companies. Knowledge decreases risks and creates trust, the foundation of any successful business.
A warm welcome to everyone who has tuned in for our second panel of the day with traditional banks. This panel is focused on traditional banks who have developed unique digital propositions and are at the forefront of payments, merchant acquiring, and agency banking. Our speakers today are Olufemi Jaffet, Head, Business Solutions at Guarantee Trust Holding Company, Chuma Izirim, Group Executive, E-Business and Retail Products at First Bank of Nigeria, Adeolu Bajomo, Executive Director, Information Technology and Operations at Access Bank, and last but certainly not least, Isaac Kamuta, Group Head, Payment Service, Cash Management, and Client Access at EcoBank Transnational Incorporated. Just to go straight into the questions. First Bank of Nigeria and Access have sizable agency networks. ETI has its Pan-Africa switch and card scheme, while GT Bank and Access are carving out payment subsidiaries. Can we discuss the strategic options each of you are considering in unlocking value through your respective digital propositions? Let's start with you, Olufemi.
Good morning. It's a pleasure to be here. One of the benefits of running a banking franchise is that you're able to play in different financial services and digital platforms. And you kind of over time see where most of the value is and see where the growth is likely to occur. In GTCO, we've decided that the growth areas are really in payments and in that fintech space. And that's why we've decided to spin off a payment subsidiary. When we look at mobile penetration, when we look at the growing SME base, we feel that these are the things that will drive the payment industry. And when we look at the investments that are coming into that sector as well, it's obvious that everybody sees growth and potential in that sector. And that's where we've decided to play as well.
Thank you very much. So if we could just go to Isaac, how do you plan to create value for your shareholders?
Thank you. And I think for us at EcoBank, our first realization is that, I think focus on payments, I think is critical. We definitely have got a Pan-African, banking network covering the 3 countries in Africa, and ensuring that this network is utilized by anybody that wants to do business in Africa is a key priority for us. And therefore, first, the first thing that we want to do, or we are focusing on, is ensuring that this network is made available to anyone that wants to do payments within Africa, whether they're in the African continent, whether they're outside Africa, anybody that really wants to play in the payment space in Africa. We try to make sure that this network is made available to to them. And so by beginning to have that focus and delivering that network in a seamless fashion to our customers, I think is absolutely critical. Now, of course, we're doing that with the customers at the center of everything. The idea here is that whether you are providing those services in the Nigerian market, from a domestic point of view, but we all know that there's all this, intra-Africa movement as well. We want to make sure that that value is not only realized in Nigeria, but those same customers are then given access to Africa, from one place. So really, if you look at it, is ensuring that if you connect with us in one point in Nigeria, you not only have the Nigerian market from a payments perspective, but you also have actually the 3 countries delivered to you through one single integration. And we think that's a lot of value for our clients.
And Ade? Ade, I think you're still on mute.
Thank you, TLC. I think for us, really, it's really about unlocking value. When you look at the market and how it's grown, especially over the last 4 years, fintechs want what the banks want, which is a large customer base. Banks typically want what the fintech want, which is to be agile, to be innovative, and to provide really compelling customer proposition that drives growth and real value, really. And for us, really, our proposition goes beyond just payments, really. Our proposition is to provide really enduring value across a number of spaces, really. If you go back and look at our 4-year strategy, we said very clearly from there that we want to be the gateway into Africa. And that gateway is in many forms and shapes, so to speak, really. And you can look at a number of our digital propositions. If you look at Access More and internet banking today, we have over 10 million unique customers. If you look at what that is doing, it's competing sometimes with the best of the best, not just within Africa, but outside of Africa, winning awards as well. You could almost, so to speak, take that and make that a digital bank in its own form if you really want to take unlocking value to the extreme, and the same goes for some of the other propositions we have, whether it's in corporate banking where we have Primus Plus or trade finance where we have trade propositions. But then you look at our digital lending propositions as well. Again, that's probably one of the most enduring on the continent today. And if you have any Access Bank customers listening, you only need to dial *901 *11 hash. Within 10 seconds, we can have a loan disbursed into your account, provisioned and disbursed into your account. Those are really strong value propositions that we think that, going into a pay call and basically unbundling each of these as we go along can really release real value for our customers, but also for those who are shareholders and our employees as well.
Thank you, Ade. And you, Chuma.
All right, thank you, Tolu. So for us in First Bank, digital is very core, to our delivery of banking services, to our customers. Okay, we do this using different platforms. So we see our business as a platform play. Okay, we are a 127-year-old financial institution with over 32 million customers spread across 8 different markets in the UK. Okay, the good thing about our customer base is that over 50% of them bank only with. We've also, as a way, develop our agency banking, which is also helping us to serve the customers that today are unbanked. So for us in First Bank, we believe that opportunities exist, for banks, to disentangle some of the platforms or businesses that are not very core, to their business. And that even when they do that, okay, the spring of entities, okay, or entity, would accrete value, to the enterprise, and also they complement, what we currently do, as a bank. So that's how we see, what is happening in the market. Thank you.
Thank you very much for your responses. So this next question is for Chuma and Ade, and it's on agency banking. So could you talk us through how you're thinking of the opportunity here and how this network evolves from just being human ATMs? There's an argument that with SANF agents, most are primarily serving already banked customers. But how do you leverage this to drive financial inclusion when all the banks essentially have access to the same network? We could start with you, Chuma.
All right, thank you, Tolu. So for us in First Bank, first, I think we are very proud of what we've done, okay, as a bank, developing this business, in this market. The concept of human ATM, actually, our idea, which we implemented, with one of the processing companies in Nigeria. So we are very proud of, what we have done. Having said that, the non-exclusivity model of the agency banking business in Nigeria, and the fact that most of the services are highly undifferentiated, I think is impacting on the drive, to include more Nigerians, in the financial services, industry. Okay, so these features, have their implications, which I don't want to mention here. Having also said that, the truth is that the market as it is today is highly fragmented, with players that have different objectives. I think that the current structure is not sustainable. I believe that with time there will be consolidation in the market. For us as a First Bank, agency banking is core to what we do as a bank, and we are committed to building a model that is sustainable, that would help us to reach the underserved and the unserved segments of the market. Thank you.
Thank you, Chuma. I'm keen to hear your thoughts, Ade. Do you agree with Chuma that there's going to be some consolidation in that space? How are you thinking about agency banking at Access Bank?
It's actually a very interesting space, really. without a doubt, when you look at certainly the African space, agency banking has to be the natural extension of traditional banks, traditional banking. I mean, when you look at the cost of brick and mortar, the penetration of digital, there will still be certain services that digital alone cannot provide. So for us, really, we see digital, when I use the word digital, I'm talking about the ability to use feature phones, smartphones, and provide really, really endearing services as primary. But the natural, if you like, last mile to that service provision has to be agency banking, because some people want cash, some people still want that personal interaction, and so on and so forth, really. And there are a number of services that we're providing through agency banking. So you will see that growth certainly continue for us. You know, we're very clear about that. That growth will happen for us in Nigeria. It will happen across all our, all the entities that we operate in very, very clearly. But the competition, as Thomas alluded to, is extremely stiff and will remain stiff. There's no question about it. You have to compete based, quite frankly, on cost. Because the agents can be very finicky in terms of pricing. They can be very finicky in terms of service, because you have somebody standing in front of you. So your platforms must work 24/7 and as much as possible non-stop. And indeed, your service levels in terms of servicing those agents has to be second to none as well. So all of those are what will drive competition. All of these things are what's going to eventually determine what the ultimate winners will be. And without a doubt, consolidation will be part of what will evolve eventually with agency banking. But I think when you look at, certainly when you look at Nigeria, the population of Nigeria, the number of banked customers, unbanked customers, then you really can see the space, where agency banking can play. And that space is still very, very large as far as we can see.
Thank you very much, Ade. And I feel I'm going to ask you the next question as well, because I think it's very pertinent for you and Edwafon, especially as both your banks are spinning out payment subsidiaries. So what are your views on the intense competition for tech talent from well-funded fintechs and even global big tech? It appears that the banks are already on the back foot with regards to this. How are you responding to this talent drain in the ecosystem? And how can you realistically compete with the fintech dominated by engineers and have their risk basically taken by venture capital when you have the added constraint of having to deliver shareholder returns? If we could start with you, Edward.
Okay, so I think it's obvious to all of us now that we're competing for talent, not just locally, but also globally. And I think that right now our strategies need to be global as well. The workforce has changed, especially through the COVID year. People have now realized that they don't need to be physically present in some premises to be able to work effectively. And the banks need to change. They need to become flexible and open to new ways of working. So today, before we always had staff who maybe would spend 10 years with us, 5 years with us, and come into work every day. But we're beginning to see that those tenures are shortening because people are looking for new experiences. They're looking for the next new adventure. And so we need to realize that those tenures are shortening. And maybe we then need to look at what are the core staff that I really need to keep. Can I use freelancing? Can I use shorter term contracts? Can I use people who are working offshore, but I use them for particular projects and particular tasks so that I can access the best talent and still be able to deliver them without looking for those long-term contracts that I always used to have. And then I guess the onus is on us to grow that talent locally as well. So all the banks need to be significant contributors to growing and harnessing tech talent. I know there are a number of partnerships with tech academies, with universities, but I think we all need to be more deliberate about it so that we can grow that pool of talent. And then we need to be more open to newer models of engaging this talent to be able to get the resources that we need when we need them.
Excellent. Ade, over to you.
Thanks, TFC. I think one of the really interesting things about the fourth industrial revolution, which is where we are today, people are saying it's coming to an end, we're about to start a fifth, is that it's happening everywhere in the world at the same time. if you look at the first, second thought, it will happen in some parts of the world, take some time before it gets spread out to the rest of the world. So you can almost develop skills and transport those skills around and build them locally. Here, everybody is developing at the same rate. There's a global shortage of talent. That global shortage of talent is not is something that we spotted several years ago as part of our strategy, to be highly digitized and to compete in the digital world, really. And we've been taking really clear actions in terms of addressing that. One is around obviously building local talent, building our people, forming partnerships globally, and indeed just providing what will be a much more endearing working environment. So this year, we went 1 or 2 stages further. We commenced the Advanced Africa Training Program in partnership with Udacity. Many of you may know Udacity, which is basically one of the leading online platforms for training. And the plan is simple, provide capacity far, far beyond what we need. Because it's not just about solving our problem. We have to solve this problem collectively across the wider society. My gain or my loss cannot be someone else's gain or loss. We just have to do much more in the environment, really. So if you take Advanced Africa Training Program, we plan to impact 2,000 Africans. 65% of those will clearly come from Nigeria, which is the base of our operation. And indeed, proportionally, when you look at population across Africa, that makes sense. The other 35 will come from outside of Nigeria, really, and a number of levels there. We're training people on real digital skills, which actually help them, to get jobs, but also work with us if indeed they meet up to the criteria. But also, very important for us is developing the female talent, because that's a very, very untapped. We still believe it's not as tapped as it can be. And we've commenced the Female Digital Academy. For us, that's a 4-month program. Where we're training, women who are qualified and have the baseline skills on mobile app development, front-end development, back-end development, Python for data science, and basically all of those to contribute to actually drive those skills. The reality is this, that talent war will continue. It's not going to ease anytime soon. And I think we just all have to do more collectively to create more capacity within the industry and the society at large that we can all tap from, but also keep developing really, really endearing, if you like, work practices to retain the talent that we need to retain as well.
Great. So moving on to another topical issue. I wanted to address this question to Isaac and Chuma. With the increasing adoption of digital currency globally, the Central Bank of Nigeria has responded by introducing the e-Naira. How will this work, and how is it different from what the banks already offer? Can we start with Isaac, please?
Yeah, thanks, Tos. I think that's a very, very topical and I think very, very, very good question. And we all knew that it was going to happen. It was just a question of, time. And I think when you look at the e-Naira and the approach that the Central Bank of Nigeria is pushing, it's one of, where they more or less control, everything. I think from the early stages, of course, it's still, evolving. We're still looking at, how they want to do this. But you can see that they want that approach of still ensuring that there's control within the central bank, and then leveraging the banking industry to be able to support, whether it is on, funding, the e-Naira wallets, ensuring that you're using the banking industry to be able to, to fund there. Also, even I think I see it extending as well to agency banking as well. I'm sure they'll be able to go to agents and still be able to fund your e-Naira. So you'll still see, really from a central banking point of view, they're still trying to, have command and control and dictate what goes in there. And I think it is still early stages, to be able to evaluate how that will go. That if it's launched properly, you can create a very good ecosystem, because for any wallet, the most critical thing is the ecosystem that you're able to generate. And because they are central bank and they have regulatory authority to be able to bring in all the players, the banking industry together, it can still be able to evolve and become a very powerful way of trading, because all you need to do is then connect the pillars, connect that to as many termination points as possible, and then all of a sudden people have got a new way of paying. So I think that's the approach that the Central Bank of Nigeria is taking. Now, of course, as a Ecobank, given our 33 presence in Africa, we're also seeing the same sort of thing coming up with other countries. Ghana, they're also in the process of doing and ECD as well, and a couple of other central banks in the countries are all evolving. And I think if you take that and look at what the banks have traditionally taken, the play they have taken is within each of the bank has been trying to do something. Every bank has been trying to launch some e-money of some sort in partnership with the telcos. I think for Nigeria, we have had the bank-led sort of model. The other countries outside of Nigeria, they've had the telco-led model, and it has got its own weaknesses and the strengths. I think the one that has taken off mainly has been the telco-led model, where we have seen the growth, whether it's M-Pesa or you go to Ghana, where the mobile money has become big. So it is still very, very early days. But I think it throws in a spanner in the works in terms of how will banks evolve in this. Do you then continue leading that bank-centric model where each bank is trying to do its own thing? Do the banks step back and say, hey, wait a minute, can we do something together as a financial institution as well? Or do we just then support what the central bank is doing? So I think it is still very early days, and from a regulatory point of view, we're watching and participating, but I think it's still very early days. Thank you.
Thank you very much, Isaac. Juma, could you share your thoughts with us on the e-Naira and how the banks are responding to this, or how First Bank in particular will be responding to this?
Okay, so for us as in First Bank, I think it's a welcome development. It's what we've observed, that central banks all over the world, are implementing. So Nigeria cannot be an exception. I think that the introduction of e-Naira in the market will change the competitive landscape. Okay, based on the features, of a digital currency and the role of the central bank in the e-payment ecosystem. Okay, is going to change, the competitive landscape. The impact for now, the information we have is still sketchy. We don't have the detailed operational modalities and the commercial structure. But I think that the impact will depend on the role each party plays in the e-payment ecosystem. For banks, I think that we might. It might affect, the balance sheet. Okay, some of our revenue lines, and for what we've seen some markets, they produce cross-border transactions. Will also affect that aspect of our business. The major beneficiaries, from what I can see, will be banks that have, wide and robust distribution and acceptance networks. Thank you.
Excellent. So now we spoke about competition for tech talent. Now I wanted to drive the conversation more towards competition for actual revenue and market share. So I'm going to address this question to Edward and Isaac. What are your views on the competitive environment, especially between banks, private fintechs, and telcos? How do you see this competitive dynamic going forward in Nigeria vis-a-vis other African markets? We could start with you, Edward.
I think when we look at the fintechs, we look at banks and telcos, we're enemies of sorts. So we're all growing, and we're all growing on the back of each other. So you see the fintechs growing on payment rails that the banks have provided, and the banks also trying to deepen their market on top of infrastructure rails that the telcos provide. And I think that each of us has our unique strengths and our competitive advantages. And going into the next couple of years, the winners, I guess, will be the organizations who are able to leverage those strengths and be able to deepen the market. So today we have a customer or population base of over 200 million, but the fraction of that is actually being served by these entities are really small. And I think that as we all attack the market, that will begin to deepen and go further down the bottom of the pyramid. And I guess it's the organizations who are able to create the best experiences, customer experience, and deepen that market who will eventually succeed and survive. The regulator, I think, will also have a big part to play. We've seen in other markets where we have telco-led financial services, and I think that the regulator in Nigeria has somehow tried to keep some sanity in the system. Beyond the policies, there also been the infrastructure that they've put in place. So digital products grow on the back of identity management and being able to identify people digitally, being able to do real-time payments. And those are the things that the regulator has put in place, and I guess will allow this market to grow. So going forward, I expect that the customer will be king. As we all go into the market, we'll begin to deepen this market and offer better and more sophisticated services. That's what I expect to see.
Thank you, Adolfo. Isaac, could we pick your brain a little bit on how you're seeing the competitive dynamics play out?
Yeah, thanks. Competition is always a good thing because it forces us to do our best. I think it's Henry Ford, if you recall, who said that competition whose motive is merely to compete, to drive some other fellow out, never carries very far. He said, in fact, the competitor that you need to be worried about is the one that never bothers about you at all, and is every day he just goes on making his own business better all the time. That's what Henry Ford said at the peak of the competition in the auto industry. So I think competition is good because it makes all of us better. But I think it's also good to just step back and say the telcos, the fintechs, and the banks, they are solving specific problems in the marketplace, because that's what business is about. It's about what problem are you solving. They are helping remove friction and actually help drive economies forward. On the other side, if you look at the banks as well, there's a specific role that banks are playing, whether it is in working very closely with the regulators to achieve certain economic targets that the government needs to have. You still need structured lending. You still need multiple products in the industry to be able to move the economies forward. So there's a very clear role for banks, but we also understand that the telcos are also playing a very important space, and even the fintechs are also playing a very important space, and especially removing friction from the system. So I think, as Erufona said, there's going to have to be collaboration, but at the same time there's going to be competition. Collaboration is because we need each other. If it's a bank, I need the rails or the telcos to be able to provide financial services, and the telcos or the fintechs also need banks to be able to deliver their services. For example, as you had me mention, if you look at the EcoBank network, 33 countries, and you are a fintech that wants to scale very fast in Africa, then it makes a lot of sense to to leverage those rails, because if I can connect you in Nigeria, you're having access into the 3 markets in one instant. You don't have to go repeating that scale across those markets. So in that instance, you need those rails for you to be able to scale up quickly and also develop the value that you need. So there's always going to be that depending on each other to be able to build services. So I think there has to be collaboration. There's going to be competition. At some point in time, you find ourselves competing against one another, but I think it's something that's going to exist. At the end of the day, I think it is the customer that is going to be the determining factor. And I think the customer experience, and I think, as everyone said, really growing the market. It's no point of competing over 40 million people when there are another 200 million in Nigeria that we can all serve. So our ability to deepen that market, provide differentiated solutions, solve specific problems in these regions, in these markets, I think that's going to be absolutely critical. So it is a healthy thing. It will continue to to exist. We need each other. At the end of the day, the customers are the ones who are going to really be the determining factor. And of course, as we said, regulation is important. Regulators drive everything. They drive behavior. So whichever side the regulators want, you'll find the economies and the businesses moving towards, gravitating towards that side. So it is going to be, I think, competing at the same time, collaborating and trying to solve the problems that exist in the Nigerian market and I think Africa in wide.
Thank you very much, Isaac. I completely agree that it's a delicate balance between competition and collaboration. And I like the way Adolfo phrased it. You and telcos and fintechs are frenemies. I think that's a key takeaway from this conversation. So my next question I'm going to address to Ade. What are your thoughts on the current fintech valuations that we're seeing in the market these days? And how sustainable do you think they are? And I guess to lay on that question, how is your bank unlocking strategic value through your own digital propositions in response?
That's a very interesting question, Toyosi. Valuation is an interesting thing, and there are all sorts of, you guys know it better. There are all sorts of models around valuation, and there are all sorts of emotions around valuations, and there are all sorts of insights around valuation and where you see things going as well. Really, I think many people will tell you, depending on where you sit, if you sit on the side of the traditional valuers, then they'll say, can anyone explain how 6, 7 tier 2 banks with clear assets, not physical assets, number of customers we can see, et cetera, all added up can be worth less than one fintech with less assets, less customers, et cetera. I think that's all about a play into the future, how you see the future. What is very clear these days for us, certainly, and for us in Access Bank, is that valuation is clearly also a function of whether people believe you can solve the real problems of the future. And whether you have a team, you have the capacity, and you have the capability to be agile enough, to be adaptable enough to solve those problems. And I think that's a key part of the valuation story, really. So there are many ways you unpack that. You unpack that by what you're doing. When you look at our base in terms of, for us, in terms of number of customers, our ability to integrate very, very smoothly and grow our base consistently, compete with the best fintechs in the digital market. All of that is great, but it's also clear that putting all of those, if you like, in the banking framework does not actually unlock the value. So being able to, like I said earlier on, unpack these assets, so to speak, and put them in PECO. And there's a whole plethora of assets. Some of them we know today, some of them will come as we adapt and we compete into the future businesses that we can see and into solving problems regarding, being the gateway to the African market, from all the other places as well. So for us, the PECO is not about payments. It's really about being able to offer a plethora of value-added firms that are solving deep problems in payments, in lending, in data and data insight, and across a whole plethora of items. And if those valuations compete with fintechs or exceed fintechs, great, as it were, really, but also making sure that we run a robust, solid bank that is well regulated, highly compliant, and can compete with the best in the world, and not necessarily Nigeria.
That's very interesting. So, Chuma, can I ask your thoughts on this same question as well? How is First Bank planning to unlock strategic value through its digital propositions? Sorry, Chuma, I believe you're still on mute.
Okay, sorry. Yeah. So like I said earlier, for us, it's a platform play. Okay, so if you look at our digital banking business, it comprises of several platforms. And each of those platforms, we use, to address specific segments of our customer base. Okay, so how we look at unlocking value is actually, from the point of view of, how core is that platform to what we do as a bank. Having said that, okay, we also know that those platforms, when disentangled, from the enterprise, could, accrete value. Okay, so we look at payment, from the platform point of view, and then when we begin to disentangle, it will be a platform based. Okay, and we believe that as a bank, we have enough platforms, okay, to really compete in the market. Okay, depending on which of the segments that we, which of the markets that we decide to play. Thank you.
Great. Edwafo, can we have your thoughts on this question?
So for us, we're leveraging focus. And I think that what the fintechs do very well is that they take a small area and they give it focus. And that's why some of those products do turn out sometimes to be a big competitor with the bank products. So what we're doing is looking at the key sectors where we think there is growth and potential. So focusing on payments, focusing on merchant acquiring, giving it strategy, giving it talent, giving it funding, so that we are serving the customers the best way, giving them the best products. Like Ade said, we're now competing in a global marketplace. So people are not just limited to local bank products, they're looking all over the world for what meets their needs. And that's what we're doing. So we're taking focus in key areas, and we're combining them with that successful bank franchise that we've already run and brand equity that we've already acquired, so that we can serve and deepen this market better.
Excellent. And Isaac, could you please let us know how ETI is playing this?
Yeah, I think it's the same thing. We are driven by the trends that we are seeing in Africa, and as you know, there are two I would say key key themes that we are seeing here. One, you got the intra-Africa trade, which is becoming a big thing. There's a renewed interest in a lot of things happening within within Africa. So that's an area that we are very focused in, and ensuring that we can be able to assist Africa, Africa trade and the payments within Africa, and make it as efficient, as cheap as possible. And that's something we can do, because of the geographical coverage that ETI, has, of course, with Nigeria being a very, very, very important market. If you think about the three countries we cover, the currencies that we are able to to handle, I think we are best placed to be able to assist anyone that wants to do business in Africa, with one-stop shop. So that's one area that we are very, very focused on. But the second one is also really facilitating those that are outside Africa who want also to do business in the African continent. And as you know, the African continent is big. It's still 55 countries, central banks, regulations, and all that. And navigating that can be a big task for anyone, including the fintechs that want to expand here in Africa. Now, thankfully, ETI, from its inception, it was created to remove friction, that border friction. When you see EcoBank, the way it was created, from the inception, it was a Pan-African bank that has got banking assets in each of the African countries. It is not a one bank that belongs to one country and then try to do business or expanding to other countries. It was a Pan-African banking group with assets in each of these countries. So the bank was created to remove friction across Africa and just make it very easy. And so if you look at those flows, all the multinational clients that are trying to do business access Africa, then we believe that that is a specific area that we can be able to assist and really help them navigate that area, remove that friction, and just make it easy to invest in Africa, through providing that one-stop shop to international investors and fintechs that are trying to access Africa, or big companies that are trying to expand into Africa. Whether you are a big Nigerian company that wants to do to expand into Africa, and we should be there to be able to help you navigate that very easily, because we have already removed those borders. We have the banking licenses. We clear all those currencies. We settle those currencies, and we have the EcoBank Paris, at least international franchise. That's also helps us in terms of just the trading of those currencies in a more effective way.
Great. So my next question is also for Isaac and Edwin. In recent times, we have seen the regulator pay particular attention to the activities of fintechs, given their growing systemic importance. So my question for you is, what are some of the key factors that the regulator considers when performing its oversight functions? What does a regulator look out for when they're granting licenses or approving these? Edwin, please, could we start with you?
Okay, so and I'm speaking from my perception based on the interactions with the regulator. I think the regulator, for every new license they give, they want to know what value you're bringing to the market. What are you adding to the ecosystem? They don't just want to load on players, but you need to be solving a particular problem or adding something to the existing infrastructure. They're also careful that they're not introducing any systemic risks as they onboard the new players. So they're making sure that you're adequately funded, that you've thought through your processes, that you've thought through your technology, you've gotten the right certifications and complied with the right standards, so that there's no systemic risk that you are introducing. And I think that they're essentially trying to create also a level playing ground. They don't want anybody to be a monopoly. If you look at the new licensing regime, where they've tried to separate mobile money operations from switching, from processing, just to make sure that there's equity in the market, is open, people can play, people can innovate and grow, and essentially making sure that the consumers and the users of those products are still able to do so without taking on any additional risk.
Excellent. Isaac?
Yeah, thanks. I think just to add on what Edufona said, regulators, at the heart of regulation is risk management. The regulators are, the one thing that concerns them is always ensuring that they have control over risk. So in granting licenses or or licensing regimes, they will tend to look at, are we introducing risk? Have we defined the risk that actually we are taking? And as we license, do the people that we are licensing have actually the capacity to be able to manage risk? Now, if you step back to some of the discussions we've had here, the reason why fintechs have grown very fast is because they solve specific problems. And I think one of those problems is speed to market. They are quick, they are agile, they can take technology, deploy it very quickly. But I think one of the things that that comes with speed is also a whole issue around risk management. And the reason why the traditional banks have been seen to be slow is because over the years, they've made a lot of mistakes. And in the process, they've learned a lot. And when you make mistakes, then there are policies that are given by regulators and procedures and programs that you must adhere to make sure that you don't repeat those mistakes. So I think at the heart of regulators is ensuring that as they grant more licenses, the risk management side of this whole business is well thought out. And then secondly, also, don't forget, regulators across the world, they talk, they exchange information, you may be looking at the regulator in Nigeria, but they are very much in touch with the regulators in the US, the regulators in other parts of the continent. They exchange information. And so as they sit here, they're also getting to understand what is happening in the rest of the world. And no regulator wants the same problems to end up in their own country. So I think, to me, it's an issue around risk management as being very critical and in the heart of what, what's going through their mind as they give more licenses. And of course, the whole issue around, competition, make sure there's no monopoly. It's, it's well thought out. You don't want to create a dominant space that becomes difficult to control later on. I think those are some of the things that are in the back of their mind. And remember, they always want to protect the population. They want to make sure that the users of some of this technology, they are, at the end of the day, they are citizens. And they want to make sure the citizens are not, they are safe and their transactions are okay. So I think it is really risk management, I would say, is maybe the key thing that they are considering, in addition, of course, to the other things. Thank you.
Great. Chuma, I'm keen to see if you have anything to add to what Isaac and Edwin Fong have said on this question of the role of the regulator.
Thank you. I think, between the two of them, they largely addressed, that question. So the regulator is concerned about ownership. They're concerned about the structure. They're concerned about, the technology, the risks, and then of course, the depth of the solutions, that the fintechs are offering. I think in Nigeria, we are lucky that we have a central bank, that understands, payments. So the licensing regime in Nigeria has been largely liberal. And, I think that to a large extent, we've not seen any need, to really, worry about the number of players in the market. So I would say that, without, repeating what, I've been said earlier, that, I think in Nigeria we've gotten the licensing, regime right. And we believe that also that there's more room for players, to enter the market. Thank you.
Great. So while I still have you, Chuma, I've got a question on agency banking. How much more room do you think still exists to drive financial inclusion? And how well can banks leverage the SANEF network to win new customers? Because when a customer visits an agent in Kano, for example, which bank account will he propose? What drives those dynamics?
Okay, I think, like I said earlier, the model we are operating in Nigeria is non-exclusive. So meaning that, any agent can serve any bank's customers. Okay, so and it works. I think the market is also benefiting from the non-operability of our payment system or ecosystem. Okay, meaning that any player can, once you hooked up to the national switch, can offer services to others. So for me, I think that the market is still shallow. There is much room for growth. That's what I believe. Concentration is still around the cities and the semi-urban areas. Okay, so when you go further down, you still find out that we've not really made much progress. Okay, so what I see that will happen, okay, in the coming years will be, that banks, the players will now start coming up with some, compelling value propositions, that will bring in, more customers, into the market or into the ecosystem. I also believe, like I said earlier, that when the consolidation happens, okay, you're also going to be seeing, some, players that would, have to bring a capital, to develop markets that today, look unprofitable. Okay, so for me, if you ask me, I think that, the market is still shallow, and we have, room, to really, grow, the business. Thank you.
Thank you, Chuma. And back to you, Isaac. We've seen a lot of pricing pressure, especially in terms of payments and agency banking. You could argue that there's a race to zero going on at the moment. How sustainable do you think this price war is? And how do you see it evolving going into the future?
Yeah, thanks. That's a very interesting one. And I think it is expected. This is a very competitive, market. When you start having you know, one agent serving multiple banks, then, you know, you can expect the type of competition that's going to be coming in for even for the services that are delivered over that side. So I think the market, the competition will continue. I think it'll only get worse before it gets better. I think there's a role that the regulator or the central bank has to play, because at some point in time, remember, at the end of the day, you know, businesses are run on profit. You know, these are profit-making organizations, and you know, at some point in time, you have to make you know, decisions. But I think the pressure for pricing will continue. I think it will force banks to be efficient. Because when you're under pressure of pricing, the one thing that then comes to your mind is how do you get more efficient? How do you start thinking through what you're doing? You start thinking the question, why are you doing it? How you are doing it, how you're delivering. So there's going to be a lot of pressure that will come in, and the people will be asking questions, you know, why do I continue to do this? Can I do without this? So that pressure will continue to, you know, will continue to exist. To the extent that, because as you know, in Nigeria specifically, you know, there's a lot of controlled pricing as well. You know, on what you can charge, and that sort of, you know, puts under pressure, you know, on the system as well. So there's going to be a lot of innovation as well, because when you have pricing pressure, it also drives innovation. People start looking at other ways of doing things. They start questioning some of the what as the industry practices, asking, are they still relevant for today? So I think it will go in until I think I would say a very, very you know, I would say until you reach the end point. But you know, I think this is good to continue. Definitely, the regulator has a role to play in terms of ensuring that, you know, that the whole thing is sound and it makes sense for everybody. But you know, I see that pressure continue.
Great. And now for the last question of this panel, which I'm going to ask everyone. What is the next frontier for African payments, and how should banks position for this? I'm going to start with Adolfo.
Okay. So what I have seen is that when we all started out, we all leveraged foreign payment systems. So we all use cards, and in other climes where we have seen countries create their own homegrown solutions, I think that those have largely been a lot more successful. I think that as we go into the new frontier, that we'll begin to see a lot more homegrown solutions. We see what CBN is doing with the e-Naira. I think it's going to be fantastic infrastructure. If we're able to leverage it and grow our own solutions off of it, I think it's going to do extremely well. So I think it's going to be a very innovative landscape. And the people who are able to innovate and scale and grow are going to do very well. But definitely, my bet is on seeing a lot more homegrown solutions.
Thank you. And you, Chuma?
All right, so thank you. Very interesting question. So when you look at the markets, you know, it's full of, you know, what I call, you know, plain vanilla offerings. You know, so, you know, more than 85% of what we offer as financial service providers, you know, undifferentiated. But I think that, you know, as the markets, you know, begins to mature, you know, we begin to see innovation around digitalization of customer lifestyle needs. Okay, so for banks, there are strategic opportunity areas, you know, when you look at, you know, lifestyle needs. I think that, you know, most banks should begin to look at, you know, partnerships, you know, beyond payments. You know, so you just have to, know that, you know, you're not just partnering based on payments. You know, there are other considerations. You know, that's what is going to enhance, that process of digitalizing, you know, customer needs. I also think that when you look at the lending space, you know, Okay, so there will be need, for us to develop unconventional and new ways of assessing risks, in those markets today that we consider not very attractive. And then lastly, I think that banks should begin to develop or enhance capacity around using advanced tools to come up with data-driven customer insights. So for me, the future looks very interesting, and I think that beyond the plain vanilla offerings, banks will now begin to involve, the players will begin to innovate around what I call mobilization of banking. Looking at customers' lifestyle needs. Thank you.
Awesome. And Isaac?
Yeah, so if you would have asked me this question a couple of years ago, maybe I would have had a very different answer, because if we thought, if someone had asked me, will cash disappear? Will cash disappear in the African continent? Maybe 10 years ago, I would have hesitated by saying maybe it may not go. But I think the future, especially in Africa, I think is cashless. I think we are now nearing that point where the future is going to be cashless. I think there will be a generation that will come and be told, once upon a time we used to have notes, bank notes that used to carry along. But I think the future of Africa is going to be, cashless. It took time before you could kill checks, and we've seen them buried. I think there are still a few left around, but checks have actually disappeared, and I think they're on their maybe the final right. So I think the future is cashless, and with the things like e-Naira coming in and all the digital currencies coming in, I think it's all driving that. So if the future is going to be then cashless, you can then expect all the solutions that are going to be built around that cashless is going to be really the plus for the future. And especially around lending, because we have solved the payments problem, has more or less been solved. We can do instant payments, you can do it on the mobile, you can do person-to-person transfers, you can do micro lending, small lending. But I think there's still a huge component there of a big need in Africa that has not been solved. And I think with the cashless Africa, now data being available, we should be able to then step in and start doing proper lending to the masses, so that people can still be able to borrow to get to buy a car, borrow to get your school fees, borrow to to finance your wedding, and in a very organized way. So I think we've solved a bit of the payments problem, and with the future being cashless, I think there's still a lot of potential in lending to be exploited. Thank you.
Thank you very much, Isaac. And I'd like to wrap up by saying a very big thank you to all our panelists for the excellent and well-informed insights that they've provided for us today. And of course, to our audience for joining in. Please enjoy the rest of the conference. Thank you and goodbye.
Thank you.
Knowledge is information, but not all information turns into knowledge. Today, every company leaves digital footprints in hundreds of different sources. But this information by itself does not tell you who it is you're looking at and what the risks of doing business with them are. Businesses can't exist in a vacuum. They need employees, customers, partners, contractors, investors. Good counteragents help a company succeed, create products, make profit, expand business opportunities. But what about bad ones? 49% of organizations around the world say that they've been victims of fraud or economic crime. 2/3 of Russian companies say they've encountered economic crime in the past 2 years. This is significantly higher than the global average. Every year, 15% of companies simply disappear, whether on their own initiative or because they're forced to do so by tax bodies, often leaving unpaid debts. If you want to minimize your risk, you need to find and analyze every scrap of information you can, identifying, analyzing, collecting facts. Processing big data is impossible without qualified specialists, experience, time, expensive equipment, new technology, machine learning, graphs. Spark Interfax gathers information from all available sources and converts it into knowledge, allowing you to see the world of business in its entirety with all its risks and opportunities. And there's no doubt that tomorrow we'll be able to understand the world of business even better, thanks to the emerging digital economy, cutting-edge technology, and the availability of new information about the lives of companies. Knowledge decreases risks and creates trust, the foundation of any successful business. Knowledge is information, but not all information turns into knowledge. Today, every company leaves digital footprints in hundreds of different sources. But this information by itself does not tell you who it is you're looking at and what the risks of doing business with them are. Businesses can't exist in a vacuum. They need employees, customers, partners, contractors, investors. Good counteragents help a company succeed, create products, make profit, expand business opportunities. But what about bad ones? 49% of organizations around the world say that they've been victims of fraud or economic crime. 2/3 of Russian companies say they've encountered economic crime in the past 2 years. This is significantly higher than the global average. Every year, 15% of companies simply disappear, whether on their own initiative or because they're forced to do so by tax bodies, often leaving unpaid debts. If you want to minimize your risk, you need to find and analyze every scrap of information you can, identifying, analyzing, collecting facts. Processing big data is impossible without qualified specialists, experience, time, expensive equipment, new technology, machine learning, graphs. Spark Interfax gathers information from all available sources and converts it into knowledge, allowing you to see the world of business in its entirety with all its risks and opportunities. And there's no doubt that tomorrow we'll be able to understand the world of business even better, thanks to the emerging digital economy, cutting-edge technology, and the availability of new information about the lives of companies. Knowledge decreases risks and creates trust, the foundation of any successful business. Knowledge is information, but not all information turns into knowledge. Today, every company leaves digital footprints in hundreds of different sources. But this information by itself does not tell you who it is you're looking at and what the risks of doing business with them are. Businesses can't exist in a vacuum. They need employees, customers, partners, contractors, investors. Good counteragents help a company succeed, create products, make profit, expand business opportunities. But what about bad ones? 49% of organizations around the world say that they've been victims of fraud or economic crime. 2/3 of Russian companies say they've encountered economic crime in the past 2 years. This is significantly higher than the global average. Every year, 15% of companies simply disappear, whether on their own initiative or because they're forced to do so by tax bodies, often leaving unpaid debts. If you want to minimize your risk, you need to find and analyze every scrap of information you can, identifying, analyzing, collecting facts. Processing big data is impossible without qualified specialists, experience, time, expensive equipment, new technology, machine learning, graphs. Spark Interfax gathers information from all available sources and converts it into knowledge, allowing you to see the world of business in its entirety with all its risks and opportunities. And there's no doubt that tomorrow we'll be able to understand the world of business even better, thanks to the emerging digital economy, cutting-edge technology, and the availability of new information about the lives of companies. Knowledge decreases risks and creates trust, the foundation of any successful business. Knowledge is information, but not all information turns into knowledge. Today, every company leaves digital footprints in hundreds of different sources. But this information by itself does not tell you who it is you're looking at and what the risks of doing business with them are. Businesses can't exist in a vacuum. They need employees, customers, partners, contractors, investors. Good counteragents help a company succeed, create products, make profit, expand business opportunities. But what about bad ones? 49% of organizations around the world say that they've been victims of fraud or economic crime. 2/3 of Russian companies say they've encountered economic crime in the past 2 years. This is significantly higher than the global average. Every year, 15% of companies simply disappear, whether on their own initiative or because they're forced to do so by tax bodies, often leaving unpaid debts. If you want to minimize your risk, you need to find and analyze every scrap of information you can, identifying, analyzing, collecting facts. Processing big data is impossible without qualified specialists, experience, time, expensive equipment, new technology, machine learning, graphs. Spark Interfax gathers information from all available sources and converts it into knowledge, allowing you to see the world of business in its entirety with all its risks and opportunities. And there's no doubt that tomorrow we'll be able to understand the world of business even better, thanks to the emerging digital economy, cutting-edge technology, and the availability of new information about the lives of companies. Knowledge decreases risks and creates trust, the foundation of any successful business. is information. But not all information turns into knowledge. Today, every company leaves digital footprints in hundreds of different sources. But this information by itself does not tell you who it is you're looking at and what the risks of doing business with them are. Businesses can't exist in a vacuum. They need employees, customers, partners, contractors, investors. Good counteragents help a company succeed, create products, make profit, expand business opportunities. But what about bad ones? 49% of organizations around the world say that they've been victims of fraud or economic crime. 2/3 of Russian companies say they've encountered economic crime in the past 2 years. This is significantly higher than the global average. Every year, 15% of companies simply disappear, whether on their own initiative or because they're forced to do so by tax bodies, often leaving unpaid debts. If you want to minimize your risk, you need to find and analyze every scrap of information you can, identifying, analyzing, collecting facts. Processing big data is impossible without qualified specialists, experience, time, expensive equipment, new technology, machine learning, graphs. Spark Interfax gathers information from all available sources and converts it into knowledge, allowing you to see the world of business in its entirety with all its risks and opportunities. And there's no doubt that tomorrow we'll be able to understand the world of business even better, thanks to the emerging digital economy, cutting-edge technology, and the availability of new information about the lives of companies. Knowledge decreases risks and creates trust, the foundation of any successful business.
Okay, good morning once again, and thank you for joining this panel discussion on agency banking and mobile money development in Nigeria at Renaissance Capital's inaugural Nigeria Tech and Fintech Focus Conference. We will focus our conversation to dissect on-the-ground development in the agency banking space, as some players have raised tremendous sums of money year to date, whilst also trying to understand how this last-mile network can be leveraged to solve the merchant payment acceptance problem or other use cases for it in future, and how well the players can compete with digital-first companies and how they are positioning themselves for that inevitable future. We are pleased to be joined today by the CEOs of, the CEO of Temi, Tosin Enelorunda, the CEO of eSettlements, Olaoluwa Awojodu, the CEO of Accelerex Holdings, Tunde Ogungbade, and last but not the least, General Manager of Mobile Financial Services at MTN Nigeria, Elta Mussolini. I am Adesoji Solanke, and I lead our Frontier and Africa-focused banks and fintech equity research and venture investing teams. Welcome to you, everyone. Okay, so let's get into the conversation. My first question will come to you, Tosin and Tunde. Since we had both of yourselves on our panel in January, since then you've raised tremendous capital, expanded internationally, and your businesses have evolved quite significantly, building on last year's wins. Can you give us an update on what's been happening with your respective businesses year to date, where you're at on the fundraising front, and what you intend to do with what you've raised so far? We can start off with you, Tosin, and then over to you, Tunde.
All right, thanks, Soji. Yeah, and thanks for having me again here. I mean, since last year, we've continued on our growth trajectory, and basically also expanded to more countries like Cameroon and also like Ghana. Basically our focus right now is to continue our growth and, absolutely, make the impact we want to make in Nigeria and other African countries. We closed the Series B. We are also currently raising another round also to further expand many of the opportunities that we have seen. And, we're pretty much very excited about the future. Yeah. Thanks a lot.
Okay, that's helpful. Over to you, Tunde.
Thanks, Soji, and good morning, everyone. Thanks for having us again at having Accelerex Holdings and be a part of this. So since we spoke in January, a lot has happened. Certainly one that is obvious is last year we were rated A- by Augusto, BBB+ by GCR. We're in a 20 billion board program in Nigeria. That's going on through the public markets. So we're excited about that. That 20 billion board program will be used to accelerate certainly agency banking, leveraging local debt, which is a faster way to manage the FX risk in Nigeria. Outside Nigeria, we have expanded, certainly everyone is aware of our operations in Ghana. We've moved east as well and slightly to Kenya, and looking forward to the great things that are going to be happening down in Uganda, Tanzania, and also Congo. So very excited about the lessons that we've taken from Nigeria to now expand our business footprint in agency banking, particularly, and working with acquiring banks in those markets. Thanks.
That's really good to hear. So fundraising, expansion, I think these are two aspects of what you're both doing, and that's across equity raises and also debt funding. So that's good to hear. Let me come over to you now, Olaolu. We are pleased to have you join us today. So thank you. For those who might not know too much about e-settlement, it will be very helpful for you to give a quick overview of your journey to date, your funding status, and where you're at in your evolution.
All right, thank you very much, Soji. I'm happy to be here this morning. Thanks for having me as well. E-settlement was set up in 2018, primarily to create access to financial services in peri-urban and rural areas. Typical financial services like your cash withdrawal, cash deposits, bill payments, and so on. But prior to that, I used to run a similar startup that was focused on acquiring merchants through MPOS technology. And what we noticed around 2016, 2017 was that, a lot of merchants that we had set up, especially outside of Lagos, were using our terminals that we had provided to receive payments for their usual purchases. They were actually using it to receive payments to process cash outs. And that was mostly because they don't have enough banks in those communities. So typically you set up a merchant and you expect customers to come in and then they receive, payments. But instead they're just offering cash out services. And then we thought about that and said, hey, there's a problem here that people are using our technology to solve, even without our consent. So why not just go ahead and focus on that? And of course, that was what led to the birth of PayCenter and setting up the company focused on providing access to financial services. Now, as of today, so far, we have over 70,000 agents. We process about $250 million monthly. We've raised about $1.1 million in funding, and we are currently on our Series A, trying to raise $20 million.
Okay, that's great. Before I come over to you, Elsa, perhaps I should give a quick opportunity to Tosin and Tunde, because I suspect some people in the audience might not know fully well what you both do. So if you could spend a minute just giving a high-level overview, what does Temi do, and also maybe some quick stats. How many agents do you have? How much do you currently process on a monthly basis in dollar terms? So we can start off with you, Tosin. Then Tunde, you can comment. You're on mute, Tosin.
Sorry about that. Yeah. We basically currently, our mission is focused on essentially providing financial services to the underserved. That's the mission. And that's also because that's one of the largest untapped markets in Africa. A growing young population of people who have either no access or subsistence payment access or just general poor access to financial services. And a subset of this is cash in and cash out. And but of course, beyond cash in and cash out also includes many other kind of needs that the underserved people of Africa need. And that's what Temi through our Money Point brand is focused on. Prior to starting Money Point, we were one of the largest software vendors for Nigerian banks. And in 2019, we started operations and grew to become Nigeria's largest agency network by transaction value processed. Today, we process about $4 billion worth of transactions monthly through a network of 120,000 plus agents. And currently, we are looking, of course, beyond cash in and cash out. Like I mentioned, there are many more services that consumers and customers of Africa, including Nigeria, need. The people need access to convenient, affordable, fast, and reliable financial products, which includes from the basics of being able to deposit into an account, which means you need to have an account and be included, to being able to withdraw from it, which is cash in and cash out, which is also account opening, to credit products, to savings products, all sorts of services that people need to be able to grow their lives. That's what we're focused on. We have the goal to push and, we're both commercially and impact driven, commercial being the largest, of course. And we have the goal to, become Africa's largest provider of financial services to the underserved in the next 5 years. And we're lucky to already be Nigerians because Nigeria represents a good portion of the continent. Thank you.
Are you able to give a ballpark estimate of what you process typically on a monthly basis?
Yeah, so I think I mentioned we do a GTV of about $4 billion monthly today.
Okay, super. Today, do you want to give a quick overview of Axelarx?
Thank you, Soji. Axelarx Holding is the holding company. We're Global Axelarx in Nigeria. We have 3 businesses in Nigeria. Certainly, we have an MFP play in Nigeria. We have in financial services, we have an agent network, ANL in Nigeria, Axelarx Network Limited, and of course the payment business, Global Axelarx. Our business, Axelarx Holding, has 3 pillars, 3 footprints. One is financial services, one is agent banking, one is payments, and related payment technology switching, etc. And our business is expanding on those 3 pillars and taking it country by country to build out what is necessary to address financial inclusion based on those 3 pillars. So in Nigeria, that may be payments first. In Kenya, that may be something else. In Congo, it may be something else. So that's really our strategy to find a melting point, a synergy between those 3 pillars to achieve the objective of making payments simple and easy and seamless for every African. That is the business goal. In Nigeria, I think if you think about it, we have over 100,000 agents plus merchants. Year to date, probably done in terms of successfully processed transactions well over $2 billion. We have close to, I think, 3 to 4 million transactions on a daily basis. So when you think about the number of transactions that go through these systems, what we are focused on right now, when you think about post the bond I talked about earlier on capital raise in 2019, is a rapid African expansion. There's just so much learnings and lessons that we have discovered, worked well in Nigeria, that's now been taken into Ghana and taken into other countries. So that gives a rough idea of who we are and what we're about. We're institutionally backed by a private equity firm that has worked with companies that I've seen even on this panel at their inception. So we're glad about what the future holds.
Super. Okay. So Elsa, let me come to you now. It's a real pleasure having you represent MTN Nigeria today. You've worked with quite a few telcos across different markets. And for MTN, which is also active in fintech across many markets, how do you assess, first of all, the regulatory framework for telcos getting involved in fintech? And secondly, how does Nigeria compare, relatively speaking, across the different markets you've been privileged to look at over time?
So I think the journey of the telco entering the fintech space started like M-Pesa 2007, Orange, MTN, Airtel, everyone around 2008, all the telco enter in some of the market into the mobile money space. What is very different in Nigeria is that the telco are excluded from the mobile money space. So specifically, the regulation forbid the telco to launch and lead the mobile money business. However, regulation has evolved, and after the introduction of PSB regime, this is the opportunity for telco to create via a separate entity that will be licensed by CBN and potentially to run also mobile money operation. So that's where we are today in Nigeria. So opportunity, we are going to match from a regulatory framework under a bank-led model, what are the possibility and potential that the telco can unlock when they enter the fintech space. Today, we already have an entity that has a CBN license. So MTN has an entity called YDFS with 0 digital financial services, and we have a super agent license. So just as MoneyPoint, First Money, OPay, we are rolling out agents that can process bank deposit, bank transfer, bill payment, selling airtime. So we are already into the fintech space under a super agent license, but eager to be able to run the PSB activity as soon as CBN will allow us.
Okay, sounds good. Thank you for that context. I have a question for the independent players on this panel. So as cash gets increasingly digitized into a stored value account, and issuing, acquiring, and smartphone penetration in Nigeria and I guess across Africa deepens even further, the question is, wouldn't your agent networks become redundant, right? How well do you think you'll be able to compete with digital-first companies in such an environment? But perhaps more importantly, how are you positioning yourself for that future today? We can start off with you, Tosin, then Ola, Olu, then Tunde.
Okay, thanks, Soji. I think it would be to think of what we're doing as not being digital is a misnomer. I think that TMAP, for example, has some of the best engineering teams in the country, some of the best product thinkers also in the country. Staff payroll is heavily oriented towards digital. So I think the difference between digital first and us is we're both digital first. We're all digital, let's put it that way. We also, however, have an offline distribution. And I think that's a position of strength than a position of weakness. The reason is because the demography that we all operate in is an informal demography where sales is mostly done through word of mouth and what people think about it, about the solution, than looking on the internet and making decisions based on that. It's a known marketing fact. So if you have any product and you don't have a last mile way to distribute this product, you will be locking out a very large, significant proportion of your market. And if you take a look at some of the most successful companies in Africa, including MTN and some of the large FMCGs, a large component of their sales, at least initially started with a very, very well thought through offline strategy. So the way to think about it is more or less, these are digital companies. I know my friend Laulu operates a tech company. It's not an offline clearing company. It's a tech company, but with an offline distribution strategy. Now, to also push this forward, so how do we see this evolving as cash become more digitized and digital store of value? I think, like Laulu mentioned, started a business doing merchant payments, and he quickly realized that the way people are doing transactions is basically buying cash, right? So in reality, the same processes and systems that you have built for agents is the same thing merchants use. It's an acquiring system that works with issued tokens. Either it's a card, it's a QR code, it's a transfer, it's simply the same acquiring systems that you have built. So if you want to say that, is there anybody who is much more positioned in the building to be able to take on the merchant acquiring angle of things? I think it's still ultimately the same processes, same systems, the same distribution network that we have all built that will evolve into the merchant acquiring systems of the future. So I think as cash is getting more digitized and people store more value in digital wallets, it means that people don't need to go through cash systems to make payments again. They can just go directly to merchants and present their card and buy what they need to buy. And what will happen is that most of the traffic that go to agents today will simply start going directly to the end customers, because what people do today is they withdraw cash, to spend the cash at merchant locations. So rather than going through that process, what will happen is people will just go directly to those merchant locations and make those payments. And it's literally the same set of products that agents use, that merchants use. To bolster that point also is that in as much that we all focus on agents, we are aware that some of our agents also use it for payments also. They could use that same point of sale to also accept payments for people that are buying goods and services. So I don't think there's anything to worry about that as cash gets digitized, there's a form of disruption that's going to happen in the space. I think it's still the same set of systems that customers will simply shift behavior from buying cash to using those systems to buy goods and services. Thank you.
Okay. And Olali, do you agree or do you have a different opinion?
Yes, I agree, but I want to add to that as well. So in addition to that, we all know that, part of the reasons why the agent networks are thriving today is mostly because cash is king. So of course we offer a lot of services, account opening, bill payments, but we know that, of course the most prominent are cash in, cash out. And the reason is because, because of, the way the economy is cash driven. Everybody wants to get out cash to be able to transact. So I think that over time, as cash gets more digitized, the businesses as well will continue to evolve, and then there's going to be a future where we actually have to evolve the service from being just servicing the agent to actually servicing the customer as well. But I feel like it's going to take a lot. It's not something that's going to happen next year or 2 years down the line, so it's going to be like a long process, but I feel like, it's just part of life generally. Things need to evolve. And I think that just as well, our businesses will evolve technologically as well to be able to make that migration as well. So thank you.
Antunde, do you share similar views? What's your thinking here?
I'll take a different dimension. I think those points have been well noted. There will always be a need for physical to meet digital. So every time we talk about digital, there needs to be a physical interface. And I think it was at a web summit 4 or 5 years ago that someone made that comment. And that's why IoT, things like that thrive in the market. But when you think of the other extreme, which is completely, digitized crypto type economy where everybody keeps their, that's the other extreme. Everybody's an issuer, an acquirer. That is one extreme. But if you look at it from the agent's perspective and where we are today, the agents are serving a unique need. They are bank branches that don't need to be built. But beyond that, when you start thinking of a completely digital assets, your type cashless environment, where the agent is no longer the broker of cash and carrying that cash as a, if you will, a tool of trade, then what ultimately will happen is those bank branches then become more economically viable, because now it will be addressing the real consumer need, not just it being a broker of cash. And I think that's the position of agent banking in the future, certainly on the continent of Africa. Thanks.
I want to hold on to a point that has come across in this particular conversation, to just take the conversation a little deeper. So considering that majority of transactions being done in Nigeria today across agency banking networks is cash in, cash out, implying that these networks are primarily serving already banked customers using human agents and not really merchants, as you've alluded to. How practically possible is it to leverage this human agent network to solve the merchant payments acceptance problem in Nigeria? I think Tosin tried to touch on this earlier on. And secondly, for example, the CBN has issued non-bank merchant acquiring regulations. Is this something you will consider, or can you do this under your current license? I think Tosin, you can kick off here, and probably Tunde, if you have a view on this.
Okay, thanks, Soji. All right. So, agents clustering is strongly related to commerce. If you take a map of where agents are present and superimpose it with the commercial hotspots of the countries, you will see that agents align. Contrary to conventional opinion that agents are good for rural, it's not particularly aligned to rural. It's strongly aligned to commerce and lack of banks. So what this means is that you have agent presence in markets, and these markets can as well be rural, especially wholesale rural markets. Or you have them in spare part markets, or you have them around schools, or you have them around neighborhoods, essentially where transactions take place. And the typical use of these agents is people go to these agents to withdraw cash. That's because people don't want to carry cash along. So if you want to withdraw cash, if you want to do a transaction in that location, let's say you are going to a spare part shop to buy an engine, and the engine is going to cost you, say, 200,000 naira. You go to the agent location, you withdraw the 200,000 naira, and you go to the spare part dealer. Or sometimes the spare part dealer will follow you to that agent location and do that transaction. Or it's or maybe it's a grocery, a neighborhood, and people want to buy their daily groceries. They go to an agent location, withdraw 10,000 naira and buy their groceries. So, like I mentioned earlier, acceleration of or change of agents to merchants is simply going to be a position of where people's behavior now change. They now believe now that rather than go through the cash as an intermediary to do their actual end transaction, they can skip that step, save cost, and go directly to the merchant. But the problems today is the acceptance. Acceptance is related to the reliability of the products for merchants, as well as the costs it processes them, the perceived cost to that. You will see already in many urban areas, in highbrow areas, it's typical for you to have a point of sale. So it's for this same behavior to begin to translate down to the other non-so high class areas, and you begin to see behavior begin to change now from people going to agents to people going to merchant locations. So, and maybe agents will be disintermediated. Customers will not be disintermediated, however, because it's still, behaviors will simply change. But the good thing, however, is that this hotspot for any solid agency banking business already knows where to concentrate their efforts on. As you begin to move from agents to merchants. It's not something that's going to happen soon. I think there's going to be a need for some substantial infrastructure upgrades in the country for people to begin to trust it. There's going to begin to be some incentives in types of, say, pricing that will allow merchants to also trust it, because you will need to be able to tell your regular mala who deals with your everyday groceries that you can accept a payment of 500 naira, and you'll be able to access this 500 naira very, very easily. So it's when all the systems come in place, which a couple of years from now, that I believe that this transition will begin to happen. And I think, I think people like South Africa, using with the likes of Yoko, are already there, where people, because they have a lot more ATMs in those places, but Yoko is making a lot of waves by deploying merchant acquiring systems, and Nigeria is perhaps maybe 5 years away from that same scenario. So to answer the question, it's still the same hotspots that have the agents that will have the merchants, and that's a very solid proposition, because there's already word on the street about all these brands that provide cash in, cash out services already. So it's not a different product.
Okay. I'm keen to hear what you have to say about this, Tunde, because I know you're also quite active I was in Lagos a few months back, and I did come across a couple of Accelerex POS machines, at a bunch of restaurants. So I'm just trying to understand how you think of the practicality of converting a human agent network to solving the merchant payment acceptance problem, and whatever else you have to say about this particular question.
Thanks, Soji, again. When we came into the market at the 2010-11 timeframe, we only had one objective at that point in time: leapfrog the ATM, because we saw many lines and people who had cards who are just queuing up to withdraw cash. And at that point in time, the solution was deploy POSs to merchants, and that solved that problem relatively well. It doesn't mean those lines have been eliminated, but the second wave of the attempt of this financial inclusion was this concept of these human agents carrying these endpoints to be able to do transactions. And the real reason why acquiring banks at the time did not go directly to retail, SME, or the SMME to try and acquire them was because it was just not worth it. The costs were prohibitive, and it just didn't make any business sense. Times have changed. Now we have agent networks. We're engaging in giving agents these devices to go and do these transactions and benchmark them on that. So there is a convergence coming. I don't know when, but I sense it's coming. One, there's going to be education on the part of the consumer, asking that, why am I going? I'm not taking cash to the market. I'm going to an agent to collect cash from this agent to give to someone who is maybe 5 yards or 7 yards away from them. Some light bulb is going to switch on, and they're going to say, wait a minute, why can't I give the money directly to you? And that's going to be based on the fact that there's profit being made on that agent's part, that the merchants who is not acquired begins to think about and say, why can't I earn that income and also sell my merchandise? That convergence is coming. I don't know when, but it's coming, because education is going to happen on the part of the small to medium or even micro merchants, and they will then be geared for the next thing, which you touched on. There is a regulation now that came out in May on non-bank acquiring, and non-bank acquiring then makes the economies of scale of scope possible to address the mass market of those neglected or potential merchants, and see, is there a combination of those two things trying to converge into maybe a segment-based acquiring that focuses on the uniqueness of them and find means to make it economically viable. So we believe that will happen. We are well positioned for it, because on one hand, we do the agents, and on the other hand, we do the merchants, and at the right economic model, it may be worthwhile looking at those, if you will, micro merchants and acquire them. Certainly, what to make it prohibitive right now is the cost structure, as I think Tosin alluded to earlier on. The fee structure may not be affordable, or they may just not understand it. I've met with people who run major organizations in Nigeria and who have been able to analyze the cost of cash for them. It's costing them maybe 12, 13 basis points actually maybe even more, 12% on a monthly basis, just because they have all this cash to bank, and they just it's just not worth it. So at some points, some micro merchants is gonna get savvy enough and say, how come that agent is making more money than me on my tomato paste, and he's the one that they're collecting cash from? Why can't I be the one also doing that? And I think that's where the convergence is coming. And lastly, what's going to make it possible is education. We know that the consumers are educated now. They know they don't have to carry cash around. The merchant education at the micro level will happen. And when that happens, those merchants will become agents. Maybe the non-bank acquiring will then have full scale. So that's my take on that, Soji. Thanks.
Thanks a lot, Tunde and Tosin. Coming over to you. Lalu, did you have a comment?
Yes, I just wanted to add to that, that even as of today, we have like two broad categories of agents. So there is a category, which is maybe about 30 to 40% of agents that are actually proper retail outlets, like pharmacy stores or your grocery stores. And these guys currently, they have the agent banking business side of it as a side also, sort of. So they still do the cash in and the cash out, but they run their business as well. Now, in order to convert this set of agents is like pretty straightforward, because it's just about the value add to say, hey, you can do this as well. You already have the tools. This is just, how it's going to work for you. So that is very, very easy going forward. And then the second category, maybe about 60 to 70% of agents, the ones that we typically call like POS shops in Nigeria, are the ones that, are a bit tricky for now, but with time as well, they will converge at some point. Thank you.
Okay, super. I think that was the core point I was trying to get from all of you. So thank you for bringing the conversation to a good point. Coming over to you now, Elsa. So MTN has done an incredible job building out its agency network over the last 2 years in Nigeria. First of all, how many agents does MTN have, roughly speaking, nowadays? And how have you managed to grow that agent network so quickly in the last 2 years? And secondly, how does your agency banking proposition compare with what is being offered by the independent players on this panel, for example, or even the banks like First Money or Access Closer? So two questions in one.
Okay, sure. So today, as YDFS, we have a base of 270,000 active agents. But remember, for MTN, we have about like 2 million retailers across the country. So we can fairly say that today, okay, we have onboarded like a bit more than 10% of them. Just to give you an idea of the potential and up to where MTN via YDFS could grow that network. And actually to some of the comments that were made, yes, mobile money, agency banking is first and foremost an agent network that then we transition to like cash in, cash out, less cash in, cash out, and that need maybe to be repurposed as merchant. But the first block to be put together is that agent network. So which agency banking allow? Where I react a bit, I want to react a bit to what has been said. I think there is a critical role in Nigeria as super agent player to move out of the POS technology. Such an incredible amount of money spent and so on to roll out POS to actually be able to do deposit and withdraw. Why as actor in this industry and why as bank we don't try to move to cardless? Why an app for the agent is not enough? Can we move to biometrics? Can you move to QR code? Why so much excitement to invest into those players and not try to? I think this is a challenge for agency banking. Can we move to a CapEx less intensive, OpEx less intensive model and evolve with technology that will be the one that will fit for Nigeria and move to more digital formats? So I think that's one of the things that as MTN we believe that we can play a pivotal role to actually digitize more even the over-the-counter experience and the tool that the agent is using. So I think that would be one of the differentiation factors. Outside of that, I think there is most of the actors, and I think we can discuss, most of the actors that thrive on agency banking, they thrive on quality of service. If you ask an agent why do they prefer to take OPay, MoneyPoint, MTN, or like the first answer that they give is the quality of service, and meaning that the platform is available, and also when I have a problem, my problem is quickly solved. So I think that's like whereas all the players try to compete, and where we believe that also as MTN we can have a significant competitive advantage by mastering the communication and the connectivity that is provided to the agents.
Okay, I suspect some of the players might have some comments on this later on, but let me ask you a quick follow-up question, which is around the PSB license. So a lot of conversations around how important this is for MTN, perhaps how it would help MTN eventually launch some sort of wallet strategy, etc. So what I'd like to understand is, if you do not get the PSB license, and because of that cannot operate a wallet in Nigeria, what could you potentially do with the agent network that you've built out so far?
If we cannot get that license, we'll stay on that agency banking layer, which I think is sad. It's sad for the country because there is so much having worked with MTN in other countries, especially in East Africa, that can be unlocked from an economic perspective. Example given, like Open API for mobile money API in Uganda is like a thousand developer is really setting up a startup environment that become VC eligible. If you see what is happening in Kenya, most of it is driven by mobile money as M-Pesa API, and the most exciting startup and project go to Kenya because of mobile money. So as Nigeria having like an enormous number of fintech already today, what would happen if actually we set up a mobile money environment bank-led, but with a license given to MTN and Airtel? I think it's a fantastic impact of the country. So it would be really a sad story if we don't take that opportunity to involve the telco into that space, and that will benefit to all the players, because even as an MTN wallet, you like probably also go and withdraw on deposit at a MoneyPoint agent. So it's like it's novel redistribution of value, innovation, so on, that is at stake here. So we don't like foresee. We don't want to think about that scenario where that would not happen.
Okay, thank you for your points. But I want to also now come back to the independent players on this panel to pick on some of the good points you've made, Elsa. So one of them is around the importance of transitioning the technology, right, to some sort of lower capex type solutions. So what do maybe Olaolu and Tosin, what do you think about that point? But a second point which you could all also address, and Tunde, you could also chip in here, is what room exists for you to provide digital stores of value to customers at the last mile, either via a wallet or bank account? And if you were to do this, what does the execution path look like? Do you need new licenses? And how do you expect the banks to respond? So to summarize, a comment around the evolution of the tech, and secondly, your ability to provide digital stores of value at the last mile, whether via a wallet or a bank account. So maybe let's start off with you, Olaolu, then Tunde, then Tosin.
All right. So I think that, this is alluding to part of the things that I mentioned earlier about businesses having to evolve. As it is right now, yes, there's this heavy capex of setting up agents with a POS terminal. But of course, that same agent, at least for us, has a digital app as well, as a mobile app, as a wallet as well, and all that. And I feel like, so this is what we have now. This is what the market is requesting for. Also, do not forget that, the central bank and NIBS, they've spent a lot of money over the last few years pushing for cashless, and the major tool for that push has actually been the POS terminal, to say, okay, let everybody be used to this new technology back then of the POS terminal, and creating a lot of information and knowledge about what that technology is about. And I think that that has helped define what the market is doing today, to say the most popular payment tool is still our card, despite the fact that a lot of investment have come even in solutions like QR codes. there are like 3-4 QR codes technology that have been introduced. A lot of money has been spent, but still no acceptance. But the card still works. So I think that what it is that right now the card works. That is today's solution. But of course, it may not be sustainable long term, or even just like every other thing, it's going to evolve over time. But then as it continues to evolve, as a business, we need to be able to evolve as well, so that we can keep, even through education, through the right marketing, and gradually convert those agents into guys that are going to accept maybe some form of wallet solution, or maybe payment through OTP, or whatever it is, maybe through USSD and so on, that the future would bring, that can even make us go faster and break even faster. So I think that evolution will continue to happen. And just like so many things, sometimes I think about it, and the point is that as a business, especially in technology, the competition you had last 5 years ago, are going to be different from the guys that are going to compete with in the next 5 years. So what that means is that you can't keep doing the same thing every year. So you have to keep evolving. And I think that right now, there's traction, fantastic, but then we can't sit on that. We need to keep thinking and saying, what is next? What is next? How do we move to biometric? As an example, can we get rid of the POS and just use maybe like a fingerprint device attached to a phone, and then be able to still access my bank account? So we need to keep thinking, we need to keep moving, and I'm sure that eventually we're all going to crack it.
Okay, Temi, what do you think about this?
So I'll touch first, thanks, Soji. I'll touch first on the CapEx side of things. So one of the things that I said earlier on, that there will always be a need for physical to meet digital. And so when we talk about these different instruments or acceptance methods, we always say that there's going to be something at the endpoints. Something that is going to be a physical medium at the endpoint. So when we talk about CapEx, there is really about the costs of what it takes to set up and operate that physical thing at the endpoint. Cheapest thing, no doubt, is if you can have some feature phones on both sides. That's simplest cost structure. But that said, there existing rails in, for example, markets like Nigeria that are well dominant like card, and tens of millions of those issued. The use cases and consumer behavior is there. So continue to use that and explore other options, whether it's QR, etc. But focus more on the CapEx cost and find a way to make that reduce that CapEx cost. Because at the end of the day, the whole idea is solve the problem for the consumer and run an efficient business. So I think those two things should be treated separately. In fact, in finance, investment is different from financing costs, is what you experts always say, Soji. So I think if we find a way to, because when you bring about biometric and all those other things, I mean, we've explored all those things. We supplied biometric devices to the financial service industry through NIBS, and we know the costs are not just the cost to acquire, cost to operate them are very high, much higher than the POS. So right now, the lowest denominator in terms of what it takes to operate effectively in Nigeria, we all know today is a POS, and as manufacturing improves and cost reduces and players, that thing will come down. So that's what I have to say on that. So essentially, find whatever technology works at the least cost structure and provide it and solve the problem. That's the summary there. On the wallet side, there are so many institutions in Nigeria. So while we have an MFB in our portfolio, we think there are a lot of institutions that can be partnered with, and we really are grateful for what the regulation is doing, CBN, in terms of encouraging regulated players, whether it's the tier 1, tier 2, tier 3 banks, or even the MFBs, to start embracing this digital life, holding digital store value. So I don't think the real challenge is trying to find something else. I think it's trying to find people who can do it well and give consumers the ability to be able to leverage whatever store value they have, whether it's with the big banks or with an MFB, to be able to engage at a point of acceptance, whether it's an agent or merchant. So we're not trying to reinvent another place to store value. We want to just make it possible for consumers to be able to do what we all want them to be, financially included and engage in digital transactions. So that's my take on that. Thanks.
And Tosin?
All right. I think that a way to look at how to push product is what customers want. but it's quite tricky also. Sometimes customers don't know what they want. As you know, as is a famous saying that during the era of horses, if you ask customers what they wanted, they will say faster horses. So what this really means is, I think there is something in alternative methods of payment aside point of sale. And one of the biggest things, of course, the challenges around habits, but oftentimes the innovator is the person who sees that thing that is not so obvious to everybody, takes advantage of it and moves forward. And I know that the future is one in which I don't think that POS is the future. I think it's something else. That's something else. We need to find it. Maybe MTN is looking at it. Who knows? Maybe we are looking at it. Who knows? But I think every business needs to already be taking a look at. And for me, the problem is not capex. I think if it was capex, it will not be growing. We are financing it anyway, and nobody will finance it if you are not profitable. I think the problem is a problem of a fundamental convenience for the customer, security for the customer, whatever it's going to be, but it's not the customer that even determines that thing. It's the innovator figuring that next thing out. And I also totally align that something that is purely digital is almost always fundamentally better than something that is offline. Offline, however, should just be seen as a distribution network to ultimate digital. Amazon is far bigger than many people, but of course, they're also coming offline now too, but they started online first. And I think that's a parallel that most people in the industry, or especially investors, take a use to look at industries generally. So what my summary is essentially, it's figuring out what that thing is in the case of Nigeria. If it's going to be and I don't think it's going to be point of sale forever. On wallets, I think that it's similar to what I also said. It's figuring out what customers really want, and it's not necessarily what they say. They will say that they want it cheaper, they want it faster, they want it easier. And I also think there's a large opportunity there also, aside the clear one that there are 40% unbanked people. And even of the 60% banked guys, tons of them are underserved. A proxy for being underserved is the fact that it is an agent's location. Right. So I think also that there's an opportunity there that many people, including the people in this room, are going to capture. And I think that the future is going to be certainly different from what we know now in terms of players and the kind of products that customers will use to access their money. Thank you.
Sounds good. Thank you all for your comments. I want to touch on one of the interesting things we learned when we were in Lagos a few months back, which is around the price war going on in the agency banking space, particularly with fees taken by super agents being reduced quite significantly to incentivize the use of your POS machines. I would really like you to tell us a little more about what exactly is happening with respect to this price war and what the end goal is, and how are other players responding. I would like you to start off, Tosin, and perhaps you could comment on this as well, Olaolu and Elsa.
I would say it's more of a tough war than a price war. I think that inevitably there's a mutually assured destruction scenario that everybody's aware of. And since we all have similar economics at the end, and also it's not like pushing extra money into this particularly has a significant effect in making you gain your market share. I think what everybody is literally doing is more or less trying to grow and protect their turf. And what this means is in a couple of months or even years from now, everything will stabilize to what I think will not be too far from what it is currently. That's because there are fundamental costs everybody bears on processing, and these costs are literally some of the lowest already by world standards on interchange fees. So this is not like maybe Nigeria is expensive. Nigeria is cheap compared to South Africa, compared to in Senegal, you have charges as high as 7%. Well, before in Europe, people pay far more. So Nigeria is cheap. This costs are already as low as it could be. And I think it's a tough war of people trying to grab shares. And I think maturity is already coming to the industry. So in a couple of months, I think it will change. The reason is because if you drop your cost for an agent, your competition can drop their cost too in 5 seconds. And it's not going to make, the agent is not going to leave that platform if the cost is not different like that. So it's a mutually assured destruction scenario where it's a tough war of who is going to, like, just don't take my agent. It's not a case of I want to poach agents now. It's a case of just don't take my agent. So, and I think it's things like that will generally stabilize as is expected in a couple of months or maybe a year or so from now. That's what I see on top four. However, the business itself is evolving. We know merchant payments is coming. We know digital banking services for customers are also coming. There's a possibility that POS will not matter anymore. The fact that QR code is not growing does not mean it doesn't have the potential. It might simply just be that an innovator has not figured it out properly. So that's essentially what I think the future will look like.
Okay, great. And Olaolu, what are your thoughts on this price, or should I say tough war going on the ground?
No. I'm going to keep it a price war because there is a price war actually, where players are actually slashing prices just like you suggested. But for us, we are not fighting that war. So we're actually trying to stay away from the war. The important thing for us is that our prices should be competitive. And just like Tosin said, the gap shouldn't be that wide so that you want to drop this service because the other service is significantly cheaper. So we just want to make sure that pricing for us is competitive, and then we focus more on emotional buying with the agents. Making sure that we are part of the agent's lifestyle. And working with the data we have to know that these agents as kids, and he would need money for school fees because schools are about to resume, and making sure that we are there as part of his lifestyle. He wants to get married. We are there for him, and whatever it is, just tying in into that emotional point of view, because we feel like that is what can, make us win long term, and not necessarily, who has the cheaper fees. So that is how we're looking at it, and that is what we'll continue to do. We'll continue to build loyalty from the agent point of view.
Okay, sounds good. Elsa, did you have any thoughts on this? Does it affect MTN in any way?
I don't think it's a price war neither, right? It's a market auto-regulation, because at the end of the day, it's the agent that decide the price of the customer. So yes, as agency player, you can compete on how much you debit from the agent account, right? But is it like fundamentally the number one criteria that make an agent use the POS given by MoneyPoint or the POS given by OPay? Not all the time, and there's other criteria. I talk about quality of service, turnaround time. I think there is many. It's not just driven by the price at this point in time in the market. And yes, I think on the longer term, the price will, as competition increase, it will tend to keep decreasing again a bit up to the time that you are tipping point on the actual cost of the transaction. So there is still a bit of space for the market to decrease the fees that are charged to the agents, but not that much. So, which is at the end of the day is good, right? Because it becomes more accessible for the customer. The agent can decrease also a bit what he charges, and I think it's a good thing. But not a price war, rather market regulation.
Yeah. Okay. Let me stay with you, Elsa, because when we went around the markets in Lagos a few months back, a number of MTN agents told us they didn't have POS machines to facilitate cash in and cash out, as the cardless withdrawals didn't seem to have taken off, as dramatically. So they often use the POS machines of other players like banks or independent players. So how will MTN solve this problem, for your agents? Will you be deploying POS machines, or what's your thinking around how you solve this problem?
Well, look, here is my take on this, and I think that's why it's an industry type of question. If the banks keep distributing card and that they keep pushing a card-driven model, there is zero there is little possibility. An OPEC rate at some point, I don't know if you remember, like in January, in city like Ibadan is covered by QR code and so on. MTN has tried also. And if the bank don't join the party in trying to push a cardless model, it will be very difficult to not to keep competing on this. So for MTN, the POS question is still open. We are still trying a POS-free model because we believe that all agents already have a smartphone. So why can't they serve all feature phone? Why do they need an additional machine to serve the client? There is a lot of inefficiency, even for the agent himself, right? So you need to charge now the POS plus his phone plus this. You need to buy the paper to put into the POS. It's from the agent experience, it can be improved. So yes, so we're looking at it and seeing as all the industry will evolve in a few years to decide if we should move to the POS model temporarily as the market evolves.
Okay, sounds good. Thank you for those comments. And this is my very last question to Tunde and probably Tosin or Olaolu. Since all the banks can use the entirety of your network to service their own customers, how do the banks optimize this network for themselves? Let me give you an example. Say there's an unbanked person in Kogi State who wants to open a new bank account or take out a loan. Which bank's product will that agent offer to this unbanked person? And how well is the CNF platform working in the back end to serve all the banks and what you're looking to build on your own platforms? You can kick off today, and Tosin or Olaolu, you can give a final comment.
Thanks, Soji. So I think what is eventually going to happen there is going to be based on incentives. Today, again, we run bank neutral agent networks, and those agents should have the flexibility of offering products and services that work best for their consumers. And when we think about, and I must commend the effort by, again, the central bank and the regulators and also SANEF and its management, the effort to try and bring things together and bring some structure to how the agency network is evolving in Nigeria. But that said, an agent ultimately would look at incentives. If I'm a bank A and I offer an activation cost, let's call it a customer acquisition cost that is more attractive to an agent, then that may be the offering that's available. Let's say a consumer wants a bank account that offer lending immediately because they are an artisan, and that is something that is viable for an agent to offer, then that becomes more attractive. But again, it's like an insurance broker. I tell someone, when you're trying to buy life insurance, and even if it's your friend selling it to you, make sure that you understand the incentive structure so that they're not selling you the worst policy, even if they're your best friend. So I think ultimately that's what's going to happen in the market. The agents will determine based on whatever pricing is best incentivizing them and also suits the need of the merchant. And SANEF is bringing that administrative focus on that.
Okay, I see Tosin, you have a comment on this?
Well, I mean, I'm basically agreeing with what Tunde said about SANEF having a, I mean, that's basically what SANEF was set up to do. It's to create a shared agency network and, fund it towards advancing financial inclusion. And I think they are doing a good job there to ensure that everybody, we have a shared agent network. However, I think I should still mention that there are some level of influence that agents and agent networks have on the choice that customers make. And Nigeria's problem is a distribution problem. And whoever can crack distribution problem with a solid product market fit, I think is going to unlock a new paradigm. And I could mention that that's something that ticks our fancy. Thank you.
Okay, Olaolu, did you have a comment?
Yes. So just to add to that, Tony and Tosin are very correct. But I think that the first level of the conversation from the SANEF end, after SANEF, is actually the super agents agreeing terms with the commercial bank to say, okay, I'm going to work with this bank. And then those offerings with the agreed banks are then what you offer through your system that your agents can then pick from. So I think that I just wanted to add that, but yeah, it's pretty much on point.
Okay. Sounds good. Look, this was a really insightful conversation, and I would like to thank your panelists for all your comments and your time, and the audience for listening in. I hope you continue to enjoy the remainder of the conference today. Thank you, and take care. Bye.
Knowledge is information, but not all information turns into knowledge. Today, every company leaves digital footprints in hundreds of different sources. But this information by itself does not tell you who it is you're looking at and what the risks of doing business with them are. Businesses can't exist in a vacuum. They need employees, customers, partners, contractors, investors. Good counteragents help a company succeed, create products, make profit, expand business opportunities. But what about bad ones? 49% of organizations around the world say that they've been victims of fraud or economic crime. 2/3 of Russian companies say they've encountered economic crime in the past 2 years. This is significantly higher than the global average. Every year, 15% of companies simply disappear, whether on their own initiative or because they're forced to do so by tax bodies, often leaving unpaid debts. If you want to minimize your risk, you need to find and analyze every scrap of information you can, identifying, analyzing, collecting facts. Processing big data is impossible without qualified specialists, experience, time, expensive equipment, new technology, machine learning, graphs. Spark Interfax gathers information from all available sources and converts it into knowledge, allowing you to see the world of business in its entirety with all its risks and opportunities. And there's no doubt that tomorrow we'll be able to understand the world of business even better, thanks to the emerging digital economy, cutting-edge technology, and the availability of new information about the lives of companies. Knowledge decreases risks and creates trust, the foundation of any successful business. is information. But not all information turns into knowledge. Today, every company leaves digital footprints in hundreds of different sources. But this information by itself does not tell you who it is you're looking at and what the risks of doing business with them are. Businesses can't exist in a vacuum. They need employees, customers, partners, contractors, investors. Good counteragents help a company succeed, create products, make profit, expand business opportunities. But what about bad ones? 49% of organizations around the world say that they've been victims of fraud or economic crime. 2/3 of Russian companies say they've encountered economic crime in the past 2 years. This is significantly higher than the global average. Every year, 15% of companies simply disappear, whether on their own initiative or because they're forced to do so by tax bodies, often leaving unpaid debts. If you want to minimize your risk, you need to find and analyze every scrap of information you can, identifying, analyzing, collecting facts. Processing big data is impossible without qualified specialists, experience, time, expensive equipment, new technology, machine learning, graphs. Spark Interfax gathers information from all available sources and converts it into knowledge, allowing you to see the world of business in its entirety with all its risks and opportunities. And there's no doubt that tomorrow we'll be able to understand the world of business even better, thanks to the emerging digital economy, cutting-edge technology, and the availability of new information about the lives of companies. Knowledge decreases risks and creates trust, the foundation of any successful business.
Okay, good afternoon, and thank you for joining this venture capital panel during Renaissance Capital's inaugural Nigeria Tech and Fintech Virtual Conference. Today's conversation will focus on how to address some of the friction areas with venture investing in Nigeria with a view to better understanding the sourcing and due diligence process of our speakers, where we're at in the funding and valuation cycle, how the ecosystem can help entrepreneurs navigate the rising regulatory risks and the intense competition for talent, and finally, how to create a viable exit process for venture investors on the continent. We are pleased to be joined today by Dr. Mobola Johnson, Senior Partner at Telcom Capital and Nigeria's former Minister of Communication Technology, Wale Ayeni, who is the Acting Global Head of Disruptive Technologies and Venture Capital Investments at the IFC, Iyolu Aboyeji, a General Partner at Future Africa, and last but by no means least, Benimkar, a Principal at Greenhouse Capital. I am Adesoji Solanke, and I lead our frontier and Africa-focused banks and fintech equity research and venture investing teams. Thank you all for joining. Let me start off with a question to all of you. Can you each tell us about your funds, what you focus on by stage and funding amounts, and how you ended up doing venture investing in Nigeria in the first place? Let's start off with you, Johnson, then Inyi, Ruby, then Wale. So over to you, Dr. Johnson.
Thanks very much, Soji, and good afternoon, everybody. It's a pleasure to be here. So TLCom Capital is, we were founded in 1919 by our current managing partner, Maurizio Ciao, very much focused on Europe and Israel and the US. That's where our first two funds are focused on. We invest in early stage companies, basically between $500,000, our check size are between $500,000 and $10 million. We are sector agnostic, so any sector, as long as it's a large unserved market. And as I said, we do mostly sort of seed, Series A and Series B. We're currently investing out of our we've finished investing out of our $74 million fund. That's our first Africa fund. And we're currently raising a second fund also focused on Africa. How did we get to start investing in Africa? So my colleagues, Maurizio and Ido, in the TLCom 2, which was the second fund, made some sort of wildcard investments. Some of their shareholders agreement allowed them to do wildcard investments. And they invested in these two companies that were based in Europe, Movirtue and Upstream, but actually had all of their operations in Africa. They exited these two companies in 2014 fairly successfully. And it was then that they realized that something good must be happening in Africa. And Maurizio started coming to Nigeria, to Kenya, basically looking around and seeing what was happening. And that was where I met Maurizio. And it was at that point that we actually decided to raise a fully Africa-focused fund. And so that's how we started with our Tide 1 fund, which is fully deployed. And we're moving into our Tide 2 fund. So it's not just Nigeria-focused, it's actually Africa-focused. So that's how we got into venture in Africa. Quite coincidental, actually, but now more strategic.
Okay, sounds good. Thank you for that context. Inyi, over to you.
Sure. Thank you very much. My name is Inyi, and I am the managing partner at the Fund for Africa's Future. We are super early stage, a little bit earlier than pre-seed. We write $25,000 to $100,000 checks on our own, and then we have a syndicate that writes $100,000 checks all the way up to $500,000 checks. We tend to work with founders as the first check in their business. And kind of work very deeply with them. And this is because of our deeply operational background that led us to venture. I started building companies since 2010. In 2014, I got super lucky helping build Andela. And in 2015, I started to angel invest some of my income and proceeds from selling secondaries in Andela and companies. One of the companies that I invested in was Flutterwave, which ended up as a really, really good outcome. But we also invested in other companies along the way, Kobo 360, 54 Gene, and lately Move. And so it was that portfolio that gave us the returns to be able to then get more formal with our investing. And so, in 2020, during the pandemic, we started to do syndicates on AngelList, and we've kind of ramped up our investing from that alongside other. Hey, morning, I'm on TV. Hey, Faith, sorry, Faith, can you help me? Sorry about that. So that was the funds that helped us to set up another one together with a few LPs. And we're raising right now that fund. We have a first close of $5 million, and then we're looking to raise a $10 million fund. And we're super excited about what's going on across the ecosystem. We focus primarily on 4 big areas: talent and IP. We focus on infrastructure, digital and physical infrastructure, mass media and consumer, and the environment, including agriculture. So that's all about us for now.
Okay. Yeah, thanks a lot, Ian. Over to you, Ruby. Could you give us some context around Greenhouse Capital and how you ended up doing venture investing?
Sure. Thanks for having me. Ruby here from Greenhouse. So I'll start with Greenhouse. I think Greenhouse really started as a little bit of an experiment. We today are a fintech and SME infrastructure focused investor. We tend to do average ticket sizes of something around 250 to 500K checks. And we're currently investing out of our second fund, which is a Pan-Africa and MENA-based fund. So MENA and Sub-Saharan Africa. Greenhouse, as I said, started off as a little bit of an experiment. So it was sort of spun out of the venture builder that the partners had built about a decade ago in Nigeria. It was really just a platform for them to be able to support other promising young Nigerian entrepreneurs. It was really also to be able to deploy and fill that sort of capital gap that existed, 6-7 years ago. Today, as I said, we're sort of a full-fledged platform. We run a combination of acceleration programs all the way through to also looking at things like debt, venture debt investing as well. And then on a personal perspective, I actually got contacted, or I got connected with Bumi and Kumi, who were the founders. I was super passionate about emerging markets in general, and I come from sort of a financial services and fintech background, typically working with large financial services and fintechs in the UK and the US, and then was really looking for something back in emerging markets. Got in contact with these guys, and 30 minutes of a conversation turned into about an hour and a half of us really gelling and talking about the ecosystem that Africa was starting to blossom into. And about 6 weeks after that, I ended up on a one-way flight to Lagos. So it was quite the experience, but I think really, really excited, as Ian and Dr. Johnson said. I think the ecosystem is just extremely exciting, and so lucky to be part of it.
Super, good to know. And Wale, over to you.
Thanks, and thanks for the invitation to the panel here. It's a great thing that you guys are putting together for the ecosystem. But my name is Wale Ayeni. I'm with the IFC, and actually venture investing in the IFC started about 10 to 12 years ago. We've been doing that fairly well, mostly focused on India and China originally. But in the last 5 years, we've been looking at a lot more frontier markets, Africa, Middle East, Latin America, and Southeast Asia. Our program is more on the later side of things. So we write checks from $5 to $25 million. We do both VC funds and direct investments into kind of companies as well. Fairly sector agnostic per se. So we look at all sectors, mostly from the Series B stage upwards. And then to your question about how started doing venture investing in Africa, I tell people you just need to jump on a plane and show up. So that's what I did about 5 years ago, and it's been a great ride since then. Thanks.
Sounds good. I like this jumping on the plane theme, which seems to be playing out along this panel. Okay. All right. Let me. I have questions for Ruby and Ian. Okay. So one of the areas we find that there's still significant friction in Africa is in the deal sourcing stage for venture deals. So how do you go about sourcing venture opportunities, and how has this process evolved over time? And what do you think needs to change to make this process more seamless? We can start off with you, Ian, then Ruby, you can come in with a comment.
Yeah. So when we first got into the venture space, what mattered the most to us was that we knew the founder. So we typically helped companies where the founder was either closely affiliated with us or that we knew the founder very well. Unfortunately, as time has gone on, sorry, can you hear the background? Okay, that's fair. Okay. So as we've grown, we've realized that especially as the number of companies have grown, it's not the most sustainable way to continue to source. So we've kind of arrived at a 3-step process for sourcing within our firm. The first thing we do is we actually have, unlike most other firms, a research department. So led by a guy called Peter Quesada, who's probably one of the best venture researchers on the continent. And what Peter does for us is we look for market opportunities where there's clearly a need for a venture-backed solution, but there isn't anyone yet. So that helps us kind of create what we call a thesis around a specific sector. So when fintech, for example, the payment play in fintech had been already done, we started to recognize that we needed to start looking at other areas in fintech where perhaps there wasn't as much innovation. And one of those areas was wealth tech. So we wrote something we called the wealth thesis. Sorry, give me 1 second. Faith, take her now. So we started writing something we called the wealth thesis. And the wealth thesis helped us to basically identify all the companies that were helping Africans to build global businesses, helping companies to be able to helping individual consumers to be able to invest globally. So that was kind of one of the things that we did. The second step that we take is then we have a very, very dynamic system. We have a dynamic system for filtering deal flow that comes through the transform. But then one of the things that we try to do with that pipeline is to be useful to founders, even if we have to tell them no. So matching people to different sources of deal flow. We share our deal flow very openly with the rest of the ecosystem. And that helps our deal flow get better because founders know that even if we don't invest, they'll still get to an investor who can actually invest. We've also kept our check sizes small so we can help founders validate a lot earlier. And this has helped us quite a bit in terms of identifying founders. Again, all done through the filter of our thesis research. And then the final step is we do have our own rubric for deciding what to actually invest in. And that allows us to identify adjacent opportunities in the businesses that we've already invested in. So for example, internally, we look at, we use something called the TD3 rubric called talent, data, design, and distribution. So we're thinking all the time about, how good is this talent? How much data do we know about this market? How is this product designed for scale? And how can we help the company get this product to consumers? But as we do that, we're also looking on the balance sheets of our companies to see the companies they've partnered with the best on doing this. And it's actually a huge source of our deal flow. So for example, we invested in a company that was in the mobility fintech space. We saw that the company was relying on this maintenance and parts partner, and then we invested in that partner. And so we tend to do quite a number of those types of things as well in order to improve our deal flow and sourcing.
Sounds good. And Ruby?
Yeah, I think there are some aspects that we probably echo from Ian as well. I think firstly, it's deal sourcing, I think, across the continent is almost like deal sourcing across like the UK, Vietnam, Australia, Germany, all together, right? They're fundamentally so different. And so one of the things that I think has really, as the ecosystem really broadens, I think what's really helped us is also looking at that kind of referral base, right? Whether it's from partners that we have currently in the ecosystem, whether that's on the corporate side, or even founders from our portfolio end up being incredible sources for deal flow as well. We often find that, especially in the early stage, a lot of founders who are, have this amazing idea, maybe they've built an MVP, they're actually looking at other founders in the ecosystem for either advice, for partnership, for testing their product. And often you'll find that they're working together in the early stages. And so we find that actually, when we're working with our founders and we're speaking about, hey, what are some of the companies that you've seen? Which founders do you think have the same kind of ethos, mentality towards building as well? They embody kind of that experimentation and They essentially want to essentially address problems. They're looking at kind of solving for the product or the market that they're operating in. And so we find that actually some of our portfolio founders end up getting the best deal flow, actually. And so they end up often referring back to Greenhouse. I think beyond that, I would say two other things that have been particularly interesting from a deal flow perspective. One is other fellow VCs. I know we've probably invested alongside all of the investors here on the call today. We are such a nascent and small ecosystem still, and we're still just on the cusp of pushing forward and growing. And I think most of us are probably on some kind of WhatsApp group together. And so often there's a lot of exchange of ideas and things like that as well. And I think beyond that, we also find, we look at kind of a rubric as well. So we look at things like, spending time with the founders and the team and how they kind of approach their problem solving. We look at things like how, based on kind of research and market trends, are they addressing a large enough market? Do we see opportunities to expand and change, and what do we see their market evolving into? And then I think we also really look at things like how can we add that value to catalyze some of that change as well. So things like relationships that we might have, whether there's synergy across the portfolio. We really don't operate under, I guess, a scarcity mentality, but rather a more abundance mentality, where it's someone solving a very similar problem in Kenya may be able to actually work with someone solving the same kind of problem in Nigeria. And so we also look at kind of cross-portfolio synergy as well.
Sounds good. Michelle, I'll be touching base with you about this exclusive WhatsApp group later on.
It's not exclusive. There's everybody is on it.
All right, cool. Okay, let me come now to Dr. Johnson and Wale. So for your funds, what are the top things you look out for when you're assessing venture investment opportunities? And what does the due diligence process look like in the venture space for your funds? Perhaps you can share one example that is top of mind for you, just to bring the point home for the audience. We can start off with you, Dr. Johnson, and Wale, you can chip in.
Thanks, Soji. For us, we look for, I would say, 4 top things. First of all, we look at the market in terms of, is this a big underserved market? Is it a market that can be very well served with technology enablement? Is it a market that is growing and will continue to grow and will deliver scale? The second thing we look at is really the company. There's a problem in the market. What is the problem that the company is trying to solve? How are they trying to solve the problem? What are the business models that they're deploying? Are they innovative? Are they creative? Are they just copying? So we look at the company, and how it's trying to solve the problem in the market, and how does it compare with similar companies or with competitors in the marketplace. Then we look at the entrepreneur. Is this entrepreneur, is he a visionary, or she, as the case may be, a visionary? How good have they been at building a team? How good have they been at executing? Do they listen? Will they listen? Will they learn from other? Will they work well? Is there sort of good chemistry between us and them, even as we do the due diligence? And I think finally, the last thing we look at after all these things is actually the investment itself, because is this an investment that will deliver a good return, depending on where you're entering? What are the multiples in the marketplace? How do they compare? Can you deliver those multiples in the time that you're going to invest? So those are the 4 things that we look at, and you find that there's several combinations of these things which will help you to make an investment decision. You could have great market, great company, great entrepreneur, but the investment mechanics just don't make any sense for you in terms of the return. You could have a great market and a great and an entrepreneur that really hasn't thought through how he's going to solve that problem on a long-term basis. So there are various permutations of this and the way that we look at companies, but really around those 4 major buckets. I would say in terms of our business due diligence, what we do is, again, before we decide to invest, it's a case of really just trying to understand the company better, spending a lot of time with the entrepreneur, understanding his thinking, his philosophy, why did he start the company, how is he building his team, spending time with the consumers of the product or service that the company is building, and of course spending time with the company itself, the team that the entrepreneur has built. I think one of the most interesting, when we do the business due diligence, one of the most interesting that I have ever done up to now is we invested in Popoola. Popoola is insurance, fintech, but it's also agri-tech. It's providing insurance to small-scale farmers across Africa. And of course, who are the consumers of Popoola? It really is the small-scale farmer in Africa. And they're not in Victoria Island or Ikoyi, they are in some rural parts of Nigeria. And so we had to go visit some of the farmers to see what the farms are like. And we went to, well, sorry, it was Ilaru, which I thought was just literally down the road in Abeokuta, but no, this was a different Ilaru, which was in, there was a border town between Abeokuta and Benin Republic. And this was a sort of 14-hour round trip in a car, with bad roads and everything. But I think the best thing about it, just, talking to consumers, going out there, speaking to the farmers themselves, there's a cooperative of farmers, and seeing, one of the biggest use cases of Popoola insurance, which was a maize, as far as the eye could see in this community, the maize crop had failed because there were no rains. So as far as the eye could see, you could see the dried up maize stalks. You could then really begin to understand the impact that Popoola would have from a commercial perspective, providing insurance to these small farmers, making them less vulnerable, but doing it at scale. I mean, they're doing 4.5 million farmers in Nigeria, Kenya, Zambia, but this is something that scales to other. You could easily see the scale of this company because it can scale to sort of Latin America and Southeast Asia. So that's one anecdote that I have from doing business due diligence, but really it's something that we think very carefully about it, speaking to the consumers, the entrepreneur. We probably have spent about 6 months or so with an entrepreneur before we decide to invest, because we're tracking them, and Ruby has said, the deal flow, the pipeline. Just speaking to entrepreneurs all the time and deciding that when you're going to invest, it takes a lot of time. It's not just a sort of 2-week or 1 month process, but just talking to entrepreneurs, the consumers, and also actually doing the due diligence. We actually speak to other VCs, particularly those ones that have invested, that are current investors in the company, but also people that are in the space. If it's fintech, you want to talk to some of the VCs that are fintech only investors. So that's the way that we do our due diligence. I'll stop now.
That's really good to hear, particularly around how thorough the process, even at the venture stages, because many times you think, okay, early stage companies, people are just writing checks and getting things done, but good to know that there's a lot of kicking the tires that actually happens in the back end. Wale, over to you. What are your thoughts on the question?
Yeah, thanks for asking me the questions about due diligence, because we get that a lot in the IFC, because there's this rumor that we're heavy-handed when we do due diligence, but it's partly right and partly incorrect. I do think that kind of on the space that we play, you have to do your DD quite well, and kind of how Omobola has said, our approach is kind of basically similar and the kind of things you do, right? So we just try to figure out whether the product, the team, and the market all match, right? And it depends on what emphasis you put on what leg, depending on the stage of the company, right? So if the company is super early stage or pre-seed, there's no need to review the code or have due diligence around that. You're really backing the entrepreneur. But at the stage where we play Series B or C, there's kind of more data that you can chew around and decide. The way we like to do it, at least in the group on my team, is we try to, even before we approach entrepreneurs, to have a view on the market. So whatever the sector is, whether that's financial services, whether that's e-logistics, whether that's B2B marketplaces, we already have a thesis around that particular market, a thesis around Africa, but how that plays globally. So that makes it easier for us to identify people that we want to work with. And part of that identification is both sides, right? It's not just figuring out what entrepreneurs fit into what we want to invest in, but also assessing ourselves and figuring out where we can add value. Because it's not always 100% that there's a fit, because we wouldn't invest in anything where we don't think within the organization we can add value, because we'll be just giving money and not adding enough value. So we do internal DD on ourselves as well to say, this sector we can actually add value, this sector we cannot add value. So there's no point investing in sectors where we cannot add value. So the DD process, I'll say on our end, is both ways. But from the approach that it's kind of similar in VC, we have a vision on the future, we have a vision on the sector, and then we're trying to figure out who is tackling problems in that sector where there's a compatibility between both us and them and what we want to do and what they want to achieve, and we can help them achieve that faster. But from a DD perspective, I tell folks, we have to do DD. We're not a firm that can invest without DD. So we always do DD, but we try to at least have done the market research before we actually approach the entrepreneur.
Okay, sounds good. Now I want to move on to some important topics for Nigeria nowadays. So currency and regulatory risks, which we know are some of the more significant risks that an investor into Nigeria needs to think about very seriously for Nigeria investing in particular. So first of all, how do you think about these risks when looking to make an investment in Nigeria? And secondly, how should tech companies in Nigeria navigate this landscape better going forward? So Iyi, I would like to get your comments on this, and probably Wale and Dr. Johnson, if you have any views on the currency or regulatory aspect of this question. So Iyi, we can kick off with you.
Sure. I think regulation is very important part of the business, but I think sometimes we may be putting too much emphasis on it, perhaps at the cost of innovation. My sense is that if something is a product that consumers really want, and there's real value and it's solving a big problem, it's oftentimes the role of the investor to think about what the appropriate regulatory framework or intervention should look like. At our firm, the way we deal with this problem often is that once we are aware that the product is actually going to solve a problem, we take our time to really design what the regulatory framework looks like. And the way that works typically is to partner with already existing players who are regulated to do that business, and make them our interfaces to the regulatory bodies, because small startups are not equipped and quite frankly should not be equipped to handle regulatory affairs issues. You have to do those types of interventions at scale. So it's a huge distraction for a startup founder at the stage that we invest in to be thinking about regulators, and we don't encourage them to do so. However, at the same time, there's a real role for a broader ecosystem conversation around regulation that probably has to be led by larger companies and leaders, because there's work to be done in that respect, in terms of putting together a framework that doesn't stifle innovation at the earlier stages. But my point of view of regulation in general is just let innovation lead, and your partners can handle that are much larger than you and understand more of the interests, can handle the regulation.
Okay, all right. I would like to know what what Wale or Dr. Johnson thinks around this question.
I can definitely chime in. I think regulation is not something that is unique to Nigeria or Africa. I mean, all countries all over the world have issues with regulators. But it's really around when do the regulators engage. So I think I'm of the view, and it's a view that we've proposed multiple times, that you should let innovation lead. But it's also a very fair point that consumers need to be protected at scale. So the challenging thing is when innovation is starting to go very, very quickly, when do the regulators come in? Because the role of the regulators is really not to stifle innovation, it's really to protect the end user, the consumer. But sometimes it will get heavy-handed at the earlier stage. So one of the approaches that we've used is actually engagement, because I don't think there's any regulator there that is looking to stifle innovation. Most times it comes from a position of not knowing fully what's going on and a position of fear of protecting the consumer. So our advice to everybody in the ecosystem, and we try to foster this a lot, is that there needs to be a lot more engagement where people can come and, openly discuss, this is what we're doing. It's not that we're there to, be a pain point for the consumer. It's actually the contrary, that innovation actually helps improve access to consumers. It's just how do you do it in a framework that is inclusive and it's protective. And I think there's no two ways around it, but to fully engage with the regulators to tell them in simple terms kind of what innovation people are trying to do. And then to the other point of your question around currencies, right? Because it is a fact of life in Africa that most of this currency gets devalued every 5 years. And part of the way you have to approach it, in my view, as a VC practitioner on the continent, you have to diversify, and you got to find ways to diversify quickly, where you don't want to be beholden to just one single country's currency. Because when you look at the historical charts, it's not quite, encouraging. And we've seen people that not that they didn't work hard, they've actually grown in local currency terms. But when you convert it into the dollars, it could become flat year over year due to no fault of theirs. And the approach that we advise a lot of startups is that you have to find ways to diversify your revenue stream actually quicker and faster than if you were like doing this in the US, because there's a real risk of currency issues in any country in Africa at any one time. The good thing though is that all these currencies are not going to go down at the same point, so once you're diversified, you kind of give yourself some protection there.
So okay. If I could just add, because I had the benefit of supervising a regulator for 4 years when I was Minister of ICT. And I think one thing, I completely agree with Wale around, what do we need to do? It's about engagement, but it's also about collaboration. Because when you look at the regulator's mindset is one of, trying to create and enable an environment, a level playing field for all the players in the field, but also to a certain extent, of course, consumer protection. So if you look at the regulator's perspective and the reason for being around that, when innovation begins to go faster than they can understand, and in lacking that understanding, it's about how do other competitors in the field play, given that this is innovative, everything's innovating so fast. And so when they come up with those policies that don't seem to make any sense, it's really around a lack of understanding, a lack of awareness, and really just trying to be able to control the pace at which things go so that you can actually regulate properly. So I think one thing I always said, and which I did when I was in government, was really around engagement with the industry. You've got to speak with the industry. Some of the things that were tried was getting people from industry, in NCC in particular, people in industry to work at the regulators and vice versa. So you also understand how you're thinking. So I think that engagement and collaboration is absolutely critical. And I think that's what we need to do for some of the issues that we're experiencing in this space, in some spaces in Nigeria around regulation. It really is very much around engagement, collaboration, and making sure that both the regulators and the players in the industry understand each other and understand the perspectives from which they're both coming from.
Well, that's good to hear. We actually had one of the heads of exchange regulations from the SEC join the panel today, and it was quite encouraging to hear about how open they seem to be, particularly with respect to engaging with the ecosystem. He was also talking about some of the sandbox ideas that they've come up with as SEC. But I think certainly, as you've all mentioned, there's more room for engagement, particularly with the regulators, because our house view is that certainly Nigeria is facing a currency situation, right? Which certainly means that the conversations around that facilitates FPI into the country needs to be more encouraging, okay? Because sometimes some of these headlines can be discouraging for foreign investors. Okay, so let me come now to Ruby and Wale, and this question is more around where we're at in the environment. So in public markets, we often say that when frontier markets get to top of mind for foreign investors, it can be seen as an indicator of where we're at in the cycle. So what is your assessment of the current funding environment and valuations of African tech companies? And what do you make of the risk of flat or down rounds as even some zero revenue companies are being valued at tens of millions of dollars from the get-go? So probably Ruby, you can kick off, and it'd be good to hear what you think, Wale.
Okay, I mean, in terms of where valuations are at, I think it's actually a very real risk. I don't think there's any magic wand necessarily that allows you to raise a load of money just off of fantastic storytelling. And then, suddenly you can continue raising and raising and raising, right? I think the more you raise and the more money that you end up bringing into your business, the more you're responsible to also follow through with the commitments that you've made to those investors, right? And I think there is a lot of importance around, being able to be focused, building on a sustainable business, playing that long game, being able to have kind of sustainable growth that you can actually that you can manage over time. And so I think the risk is very real. We've seen it before. So I think in terms of things like valuation cycles, they are higher than we've experienced in the past 3 to 5 years. There's a lot more international capital coming in, but there's also a lot more capital flowing in, even from local investors as well. And so I think things are starting to just heat up in general. Where I think international funding also has kind of had an impact, it's very similar to kind of that regulatory issue that you guys just talked about, right? Where sometimes there's a bit of a lack of understanding of what's happening on the ground. I think Mrs. Johnson basically had mentioned this before, where actually you find out a lot about the opportunities while you're on the ground and speaking to entrepreneurs, versus kind of saying, hey, as an international investor, I've seen someone solve this problem in LATAM or in Mexico or in India before. It must apply, and we should just be able to mold it and do the same in Africa. I'm not sure if that strategy really works, especially in that early stage. And so having kind of tens of millions of dollars pumped in at the early stage may actually end up being kind of negatively impacting the way you can raise in future rounds as well. But I also think that there is a place for that international funding, right? It creates a lot more interest in the market. It creates kind of availability of capital for the multiple entrepreneurs that may not necessarily get access to capital from local funders either. And I also think international capital brings a lot of other experience that have sort of been around for decades, especially as companies go into that sort of growth stage, when they're thinking about expanding, when the challenges are a little bit different. I think international capital has a really strong place in that sort of stage. But I think, Wale, I'm also curious to hear what you have to say here, and also Ian being on the opposite side of the of that of that deal as well.
Yeah, I can chime in here, and I'll start with just a rebuttal to what Soji just said about public markets, thinking that when frontier markets get attention, it's frothy. Maybe public markets should look at frontier markets as the future. You know what I mean? So I think we talk a lot more about that. I do think the future of tech is actually frontier markets. It's kind of where the population is. It's kind of where the numbers actually are. So I do think frontier markets getting attention, it's kind of overdue. It's not. There's been a lot of attention in the West. There's a lot of money in the West. So I'm actually, when people say valuations are high in Africa, the truth is that valuations are high everywhere. The only thing that changed this time is Africa is participating in the fraud. It's not that. So the question when I look at it is, 100% I agree that valuations are high historically in tech. There's a lot of money in tech right now globally. So across the spectrum, across regions, valuations are high, not just in Africa. And in tech is cyclical, right? So there's high times and there's down times. And my sense is that we're kind of in a high period right now where valuations are high, and even in the high times or down times, good companies are being created, right? So the question is, whether it's a downturn or high turn, there are good companies being created today. There are good companies going to be created tomorrow. I think Google was created during the .com bubble as well, right? So So my answer to that is just that valuations are high, but the people that should be more worried about it is kind of the investors, right? It's not really the founders' issue. The way I see it is that this is a good time where founders are getting money to experiment. A bunch of these things are going to fail. That's just the honest truth. But we're in the business of innovation. We're in the business of people trying things out. People are getting money to try things out. People are going to, a lot of things are going to fail. But as an investor, I look at it and say, yes, valuations are high. So what can I do? The only thing I can do is maintain investor discipline, right? So you need to understand what you invest in, why you invest, because if you invest in something that becomes a market leader, that becomes the biggest thing that was created or one of the biggest things that's created, you'll still make your money back, given that most of these valuations that are high are still kind of in the early stages, right? So, however, if you invest in things that don't pan out, obviously you're going to get down rounds, right? So I do think, the question is yes, but the concern is more for investors and how investors invest, and the risk is actually to investors. But for the founders, it's actually a good time to start a company, and it's a cyclical thing because you need companies to start and then they experiment. Some will fail, some will do well. So we see the valuation being, everybody is raising at various astronomical valuations right now. Some of those things obviously are going to fail, but some of those things are going to be extraordinary successes that even if you participate, if you decide not to participate because of the valuation, you might kick yourself in the foot. So I just think what is happening in the period of high valuation, it makes an investor's work a lot more harder, right? Because you need to decide that you're choosing, and that is our problem to solve, not the founder's problem to worry about. People need to go out and raise money and build their companies. And then investors need to, in my view, be disciplined and figure out, if this thing is going to be the next big thing, then whatever you pay is okay. But if it doesn't, then obviously there's going to be a down round in the future. And the people that are going to, people that, I don't know how many, we've not had enough cycles in Africa to really see how people behave in down rounds, but it's also people are gonna go through a down round where it would be painful to a bunch of folks. But I do think right now, I think the encouragement is, the good thing about high valuation is that it encourages people to go start things, and we're in the business of innovation. So more people are coming in to start things, and then investors will figure out what to invest in or not.
Cool. Ian, the baton was thrown to you, so we need to hear your comments on this.
I think my views on this are very widely acknowledged. I think first of all, you have to go back to fundamentals when you're having a conversation about valuation. I think one thing that we're ignoring in this conversation is that valuations have always been a function of what the market is worth, not what the business is worth, because it's a bet on the future. And the reality is that COVID blew up the market size for tech and innovation. Blew up the market for tech and innovation because all of a sudden you have all these number of people who are kind of glued to their seats, to their phones, sorry. And there's internet coverage, and there's all this infrastructure that enables connection over the internet. And this is pretty important to note. So the market TAM has grown exponentially. And furthermore, when you look at valuations around the world and multiples, Africa is still very, very low, right? Even with the same traction, you're not comparing to your India peers, you're not comparing to your Philippines peers, definitely not comparing to your US peers. So I think it's a fundamental error in judgment to look at valuations in isolation. It's a global market, even more so than it used to be pre-COVID. Businesses are now able to pursue customers around the world. Businesses are now able to leverage and execute with talent from all over the world. some of the costs of building a company have gone up because of COVID, and some costs have come down. And so as a result, it's very important for us to think in context as far as these things are concerned, so that we don't make the wrong valuation judgment. Thank you.
Yeah, thank you. Thank you for your comment, E. I want to come now to you, Omobola, and this is a question around FX versus local currency investing. So one thing about the funding environment is that the deals we often hear announced are mostly done or announced in foreign currency for companies that are earning local currency revenues. So what scope exists to get more local currency funding to back these companies? And how do you think about the pros and cons one way or the other?
Yeah, look, it's a great question about trying to have local currency capital. When you say what scope exists, is actually, to be honest, it's not that great, because, and I speak for Nigeria now, not the whole of Africa, but I suspect you can extrapolate to the whole of Africa. When you look at, people have alternatives, people have choices, whether you put your money in venture, or whether you put your money in real estate, or whether you put your money in government bonds and bills, or whatever it is. And I think that's the real challenge that we have in Nigeria right now. The returns on, at least in the last 3 to 5 years, on treasury bills and government bonds and real estate have actually been quite high. And they're quite, you can do 90 days, 180 days. It's short term, you get your money back and you get interest on top of it. But when you're talking about raising local capital for venture, you're looking at being able to put money away for 3 to 5 years with no guarantee of a return. And so when people are trying to raise, the asset managers that have tried to raise local capital, the question they kind of get asked is, what's the guarantee? And as we all know, there is no guarantee when you're doing venture capital. Even when you have you give them a hurdle rate, that hurdle rate makes sense within the context of where they can get investments, where they can get returns in other alternative investments, whether it is real estate or bills or bonds or whatever it is. So I think that there are efforts being made right now to raise local currency debt, but the fact of the matter is that for many of the people, local currency equity, but many of the people that can actually give that equity, the big PFAs, the big asset managers, these are people that really are not incentivized to do so. You're not incentivized to risk anybody's money to get a higher return. You're incentivized to return money month on month, year on year. So I think it's still a little bit way out, but I do know there are asset managers that are trying to raise local currency debt. They're trying to do it in innovative ways by having shorter cycles, and all of that. But basically, I think that it needs to be done. But there are some challenges that we're going to face along the way. And like I said, it's around what the alternatives are. But definitely needs to be done because, I think it was Wale that made the point earlier that, the way that you diversify the currency risk, and there's a big currency risk in Nigeria. When we invested in companies, you're doing at 360 to 1. Now we're looking at, budgets for, or trajectories for 2023 and beyond. You're looking at anything from 500 to 550. So basically just running, you have to do like 3-4x returns to make any sort of sense. So there is definitely a need for it, because if you're earning local currency, you should be funded with local currency. But I think that it's still a little bit way out, and it requires, again, as we said, a lot of awareness creation, understanding of what what venture capital or private equity capital does, how it operates, particularly with some of the bigger asset and fund managers. So there's a process, and all I would say is that based on what I know in the market, the process has started, but it's going to be quite a while before we see sort of big billion naira or several billion naira funds available for venture companies.
Okay, sounds good. Thank you, Dr. Johnson. Look, I think it's important because there's a number of domestic investors who I presume would like to get more actively involved in the venture space, and I'd like to hear what he has to say because.
Sorry.
Okay.
Sorry, if I could just want, there is this, as we just talked about valuations. So there's this excitement about venture because everybody sees this very high valuation and everybody wants to get into, one venture company or another. But I think that, when it's not a case of if, when the market turns, I think you'll find this capital would leave very quickly. And when they can't leave, it really is going to be a problem for people that have raised local debt to raise subsequent funds. It's going to be a big, big problem for them because they can't get the money back. They've lost it, but they will not be able to raise, subsequent funds. Sorry, Ian.
Ian, you're on mute. You want to unmute yourself.
Sorry. Yeah. So again, on the local Naira fund, I think it's important there's a role for local currency capital in the venture ecosystem. But it's important to understand what you're investing in. You're investing in intellectual capital, right? For the most part, you're investing in software for the most part, or hardware, and you're investing in Pan-African scale. If you really want to get the maximum returns, no one has ever built $1 billion business by sitting in Nigeria, at least $1 billion tech business. Almost every unicorn has had to have Pan-African design to be able to reach their true potential. And I think it's important to keep that in mind, because when we have a conversation about local currency debt, I think we got to understand the currency itself and its own macros are not stable, right? So if you're going to invest in a company for 18 months, you're going to put 100 million naira into a company. If 100 million naira can within 18 months be devalued by 30%, that creates all sorts of other problems for the business that are independent of what the investor and the business can do. So I would say, and more so, your goal should not be to maintain Naira revenues as a large percentage of your business. Your goal should be to transform Naira revenues into growth, right? By hiring local staff, by continually pushing the limits on growth with Naira revenues, using it to buy local ads, using it to buy local growth factors, and so on and so forth, incentivize your customers. So I would say from a financial architecture point of view, I think if at any point in time local currency became the currency for our venture industry, it will die. That's my belief. I think local currency can at best be debt, right? That can be used and anchored against dollar equity assets, and that's more secure for the ecosystem. And I just think that if you want to invest in IP that can go global, you got to bring the currency of global markets to play, which is USD, so that you're getting a fair value for your money. Because I would never advise a founder to take money that can be less within the period of time he's expected to spend it. Because we can't go back to the investor and say, you were supposed to invest $250,000, now it's $100,000, and then, that it won't work. So that was the point I wanted to make.
Okay, thanks a lot, Ian. And I know that Wale has a comment on this question, but as you think of your response, I want you to answer an additional question to that as well, which is around exits. So the question is more around what room exists to create a secondary market for existing investments in the venture space, given the low number of tangible exits on the continent. We heard today that the Nigerian Stock Exchange, they are looking to create a platform to facilitate this type of transactions. But what options do you think exist to smoothing the exit process for venture investments? So that question, in addition to your thoughts around local currency funding.
Thanks for that. I'm actually passionate about the local currency topic itself. And I do think from what you said and what Omobala said, both right, the two things I'll add is like from an equity perspective, given that you're dealing with global investors, the currency of equity globally is US dollars. So I don't think there's any room for people to say, okay, we'll invest in Naira in equity in things that are venture-esque. However, if anybody wants to start a local currency fund in Africa, they should really, really look at venture debt. They will clean the market out, because I do think there's a huge opportunity for venture debt in local currency across Africa that a lot of startup needs. There's a huge demand for it. So if you want to start that kind of fund, even us as an organization will happily back something like that, because it's a huge need that is actually there, because you can't, the currency of most of the startups is local, so their working capital needs are local as well. So if people think about creating local currency, they should really think about venture debt, because there's a debt component to it, but there's also an equity kicker that you can actually get upside in dollars as well on your local currency investment. I just think it's a huge opportunity that people should take a look at. But for your question around kind of exits and secondary markets, I think those things form as the ecosystem develop. Secondary markets are a function of the quality of startups that you have. So if a startup is doing well and there are more investors than new equity that is supposed to be issued, you will naturally get secondary markets. And we're starting to see that even in the early stages as well. There's secondary deals that are going on right now in Africa in early stage companies right now. So I know people want to create an infrastructure before the market is there, but I do think let the market develop, let the startups start issuing secondaries, then you can create like a market to facilitate it. But as I see today, I don't think if you have a great startup in Africa, that there are more investors than new issuance of equity. I've not seen people being challenged not to do secondary sales. I do know a bunch of secondary sales have already happened on the continent as we speak right now.
Okay, thanks a lot, Wale. That was very helpful. I want to ask this question to you, Ruby, which is more around something we learned, what we heard about very often when we were in Lagos a few months back, and this is around the competition for talent. Okay, so how challenging is the competition for talent? When I say talent, I mean particularly software engineering talent. What we heard a lot about was big tech poaching talent from Nigeria, and other well-funded tech companies who are increasingly poaching talent from each other, or even from the banks. So how are you or your companies addressing this challenge, or even as an ecosystem? It'd be good to hear what you think, Ruby.
Yeah, it's definitely something that we found a lot of our portfolio companies have talked about. I think there are a couple of things that, and it's not just software engineering talent. I think there's a lot of other talent gaps as well that we found exist. I think we've been engaging quite extensively with schools from the onset. So really trying to pull some of the younger kind of talent into, some of our programs and acceleration programs that we have in-house. But also just looking for either two things. I think the funding aspect actually supports some of the talent. I think there's a lot of talent that ends up moving abroad and doesn't necessarily come back. So actually some of the kind of, ability to raise equals the ability to pay your talent, equals the ability for sort of going into brain draining as early as possible. So in working with kind of some of the institutions that are actually solving for this, that's kind of how we've done it. Obviously there are companies like, Andela, there are companies that are solving for it as well. But it's really just around being able to provide sort of training grounds, being able to provide work with really, really large institutions or universities, and then bring them through the entire journey. That's kind of where we've seen most success.
Okay, thanks, Ruby. And this is my very last question to all of you. So it's a very quick fire question, which is, first of all, what aspects of tech or fintech venture investing are you most excited about in Nigeria? And secondly, which other African markets are you paying the most attention to today? So let's start off with you, Dr. Johnson, then Wale, then Ruby, then Ian.
I think very quickly for us, it's really fintechs that are providing infrastructure, or the terminology is now the rails for other fintech and other companies to do things using their services. For me, that's for us. That's really where we're focused on. In terms of other markets that we're looking at, Nigeria is obviously one of the most compelling markets for fintech. I would say Egypt as well, because of the size of the population and the penetration of financial services. Those would be the two, and probably other smaller countries around West Africa. East Africa is tough because of M-Pesa and the ubiquity of M-Pesa and what they've done. So I'd say those are probably the markets, North Africa and Nigeria, plus other countries in West Africa.
Okay.
Yeah, on our part, on kind of fintech, fintech is a great sector, but what we actually spend a lot of time with people that are starting to create apps that can capture the imagination of the consumer and let them reside in there. So while fintech might be the enabling factor initially, it's more about the long-term goal or are you creating an app that becomes part of a consumer's daily need and necessity? And that includes things like embedded finance, and things like how can you use super apps and all of those kind of plays, because we do think the infrastructure is being built and people have started to do that, but there are other ways where you capture the consumer while the fintech kind of rides underneath that. So we're spending a bunch of time on that because our approach, we're trying to build things that are very, very big and large scale and pan-African in nature. From kind of where we sit, we don't focus on one country per se. I think for anything we do, it has to be pan-African. You might start in Nigeria, or Kenya, or Egypt, but you have to have aspirations of either being pan-African or actually being global as well. So we don't, and we've seen most of the startups, it doesn't really matter where they start, they mostly go across Africa very, very quickly. So we don't put kind of country demarcations on them.
Okay. And Ruby?
Yeah, I think for us, definitely within the sort of fintech infrastructure space, but really around, where are they building connectivity? So we see massive opportunities and really interesting startups coming up in the SME infrastructure space as well. So how do you start catalyzing the shift of offline to online for SMEs? What does that look like throughout the entire value chain as well? How do you enable things like cross-border trade? How do you enable, digital invoicing and receipts management? How do you enable digital inventory management? So laying that ground for things like e-commerce, obviously backed by things like fintech infrastructure, embedded finance, as well, I said as well. That's probably some of the most exciting sectors. In terms of region, I would say our core market tends to be Nigeria, but I really think there's some interesting opportunities coming up in even places like Francophone West Africa. We've seen more and more companies come up in the region that are solving for just incredibly large problems with really strong talent and entrepreneurs backing them. And then another area that we're starting to dabble into is across the North African region. So even countries like Ethiopia are quite interesting. Countries like Egypt, as mentioned before, also just across that sort of, we've seen, the first company come out of Morocco that's now entered YC. So we're starting to really pay attention to that region as well.
And Ian, you're on mute.
Yeah, so for us, we're really looking deeply at the intersection between decentralized finance, the Internet of Things, and asset-backed finance. We see quite a lot of physical assets as like the seeds of value, and we're looking at how we can create economies, as we call them, where we can put these productive assets to use while leveraging the asset itself as a security that backs it, and then stopgap with securitization that comes from blockchain, so that in real time we're creating higher quality lending assets that can be traded globally in a new kind of finance ecosystem. So we've done quite a bit in this area with Move, where we're looking now at the parts business, and we're looking at other kinds of finance in this area, mortgages, the really hard stuff. In terms of markets, we're learning a lot from Nigeria as the market continues to be dynamic. So it remains our primary focus for investment. But the other market that we're learning as much as we can about is Francophone Africa. We think that's the prize for the next generation of billion-dollar companies. And we think like everywhere else is a bit too busy for a small player like us. We're investing personal funds. We don't have hundreds of thousands of dollars. So we have to be very smart and go where no one else will go.
Okay, sounds good. Look, this has been a really insightful conversation, and I would like to thank you, our panelists, for your time and your insights, and even you, the audience, for listening in. I hope you continue to enjoy the remainder of the conference today. Thank you very much and take care. Bye.
is information. But not all information turns into knowledge. Today, every company leaves digital footprints in hundreds of different sources. But this information by itself does not tell you who it is you're looking at and what the risks of doing business with them are. Businesses can't exist in a vacuum. They need employees, customers, partners, contractors, investors. Good counteragents help a company succeed, create products, make profit, expand business opportunities. But what about bad ones? 49% of organizations around the world say that they've been victims of fraud or economic crime. 2/3 of Russian companies say they've encountered economic crime in the past 2 years. This is significantly higher than the global average. Every year, 15% of companies simply disappear, whether on their own initiative or because they're forced to do so by tax bodies, often leaving unpaid debts. If you want to minimize your risk, you need to find and analyze every scrap of information you can, identifying, analyzing, collecting facts. Processing big data is impossible without qualified specialists, experience, time, expensive equipment, new technology, machine learning, graphs. Spark Interfax gathers information from all available sources and converts it into knowledge, allowing you to see the world of business in its entirety with all its risks and opportunities. And there's no doubt that tomorrow we'll be able to understand the world of business even better, thanks to the emerging digital economy, cutting-edge technology, and the availability of new information about the lives of companies. Knowledge decreases risks and creates trust, the foundation of any successful business. Knowledge is information, but not all information turns into knowledge. Today, every company leaves digital footprints in hundreds of different sources. But this information by itself does not tell you who it is you're looking at and what the risks of doing business with them are. Businesses can't exist in a vacuum. They need employees, customers, partners, contractors, investors. Good counteragents help a company succeed, create products, make profit, expand business opportunities. But what about bad ones? 49% of organizations around the world say that they've been victims of fraud or economic crime. 2/3 of Russian companies say they've encountered economic crime in the past 2 years. This is significantly higher than the global average. Every year, 15% of companies simply disappear, whether on their own initiative or because they're forced to do so by tax bodies, often leaving unpaid debts. If you want to minimize your risk, you need to find and analyze every scrap of information you can, identifying, analyzing, collecting facts. Processing big data is impossible without qualified specialists, experience, time, expensive equipment, new technology, machine learning, graphs. Spark Interfax gathers information from all available sources and converts it into knowledge, allowing you to see the world of business in its entirety with all its risks and opportunities. And there's no doubt that tomorrow we'll be able to understand the world of business even better, thanks to the emerging digital economy, cutting-edge technology, and the availability of new information about the lives of companies. Knowledge decreases risks and creates trust, the foundation of any successful business. Knowledge is information, but not all information turns into knowledge. Today, every company leaves digital footprints in hundreds of different sources. But this information by itself does not tell you who it is you're looking at and what the risks of doing business with them are. Businesses can't exist in a vacuum. They need employees, customers, partners, contractors, investors. Good counteragents help a company succeed, create products, make profit, expand business opportunities. But what about bad ones? 49% of organizations around the world say that they've been victims of fraud or economic crime. 2/3 of Russian companies say they've encountered economic crime in the past 2 years. This is significantly higher than the global average. Every year, 15% of companies simply disappear, whether on their own initiative or because they're forced to do so by tax bodies, often leaving unpaid debts. If you want to minimize your risk, you need to find and analyze every scrap of information you can, identifying, analyzing, collecting facts. Processing big data is impossible without qualified specialists, experience, time, expensive equipment, new technology, machine learning, graphs. Spark Interfax gathers information from all available sources and converts it into knowledge, allowing you to see the world of business in its entirety with all its risks and opportunities. And there's no doubt that tomorrow we'll be able to understand the world of business even better, thanks to the emerging digital economy, cutting-edge technology, and the availability of new information about the lives of companies. Knowledge decreases risks and creates trust, the foundation of any successful business.
Good afternoon, everyone. Thank you for joining us on this panel discussion, where we'll be focusing on digital payments and online acquirers in Nigeria. We'll be looking at the digital payment trends with a view to better understanding the competitive landscape and take rate evolution, also to understand the regulatory dynamics, the venture funding landscape, the dynamics around engineering talent, and finally, what the next frontier for digital payments in Nigeria is, particularly as technology and business models evolve and as they play out. We are pleased to be joined today by Muyiwa Asagba, the Divisional CEO of InterSwitch Digital, and that is a division within the InterSwitch Group, Amandine Lobel, the CEO and Head of Business Operations at Paystack, Akshay Grover, the CEO of Cellulant, and finally, Chioma Nkechika, the CEO of CoralPay. We're pleased to have you all join us today, and we look forward to a very exciting discussion. I am Shion Onoiga, and I lead Renaissance Capital's West Africa investment banking and advisory business across products and service and sectors. So to kick off, my first question goes to everyone. Can you please very briefly tell the audience a little bit about your businesses and what market opportunity or problems you saw that you are looking to solve? I'll start with you, Chioma, and then we'll move on to Muyiwa, Amandine, and then Akshay.
Hi everyone. Good afternoon. Okay, it's a bit not specific when I say CoralPay is a payment facilitator and aggregator in the payment landscape. But essentially, what we set out to do was try and redefine payment standards in the reality of the African context. prior to commencement of Coral Pay, it's been more of foreign technology, foreign payment initiatives coming into the market as designed by the Western world. One of the things we realized that the whole effort to deepen payments in Africa has been limited to the opportunities and the infrastructure. So we actually set out to try and create that standard in the African context, primarily as a B2B, as a payment processor. And that's essentially where we build out to the full length of the ecosystem.
Thank you. Muyiwa, do you want to go next?
Okay, thanks. So we are a payment switching and technology company. We set out to solve payment challenges. We started off primarily in Nigeria, but over the past 17 plus 18 years or so, we have taken our solutions across Africa. And so now we have an Africa focus in looking at all of the payment challenges in Africa and being able to create value and wealth for Africans through what we do. Yeah. Thank you.
Thanks. Amandine, do you want to go next?
Hi, good afternoon, everyone. My name is Amandine. I'm the head of business at Paystack. We are a technology company that helps African businesses accept payments from their customers. So our mission is really to help African businesses grow their companies. And we think that by providing a very simple solution to accept payments from their customers that is affordable, that is reliable, is one of the best ways in which we can help businesses grow. We have an omni-channel checkout platform, so we help merchants accept payments, whether it's cards, bank transfers, USSD, QR codes. We were started five and a half years ago now, headquartered in Lagos. So in early 2016, headquartered in Lagos. And I think we've made a lot of progress in the last few years. We were the first Nigerian startup to get into Y Combinator. And earlier this year, we were acquired by Stripe, the US-based global payments platform. But very nice to meet you all and looking forward to the discussion.
Thank you, Amandine. Akshay?
Hi, everyone. Akshay Grover, CEO for Cellulant. We are a Pan-African payment service provider. We are now in 33 countries, out of which in 17, we are actually physically present, have an office. In many of these, we have licenses. We have aggregated now probably more than 150 payment methods across the continent. We process payments for merchants, but increasingly, how we differentiate ourselves is we are sitting between banks on the one side and merchants on the other. So we're deeply integrated both on the banking side as well as on the merchant side. And we see that as a key differentiator for ourselves as a business. Finally, we are focused on both the online space, which is online checkout, payment processing, payouts, etc., but also very heavily addressing now the offline checkout space across a bunch of our footprint markets: Nigeria, Kenya, Uganda, Ghana, Tanzania, Zambia, etc. As a business, we actually have a long history, but our business model has evolved over the last 15 odd years. We are backed by TPG and by a fintech specialist investor called Velocity Capital. Happy to be here and meeting with all of you.
Thank you very much, everyone. So my first real question goes to both Muyiwa and Chioma. You both have been active players and are involved in businesses that have been key participants in digital payment evolution that Nigeria has experienced over the last 10, 15 years and continues to experience. Can you give us a quick overview of how the landscape has evolved over the last 10 years and what has driven its takeoff, particularly over the last 5 years? We'll start with you, Muyiwa, and then I'll come to you, Chioma.
Okay. I think over the past 10 years, I think we've started from evolving from a card ecosystem driven by ATM, POS, and web channels. And then that has evolved in the past maybe 5 years to not just card, but card and non-card. And with the introduction of the mobile channel that happened within the past maybe 5-6 years. And more recently, that mobile channel, I think, is evolving. and mobile has moved from mobile apps into USSD, and USSD is now a very dominant part of the evolution. In the past year or two, I think we've started to see financial inclusion and agency banking start to shape the way the ecosystem is evolving. But we've also seen a lot of dynamic entrepreneurs taking on challenges, creating new types of solutions, and we've also seen the impact of mobile telephony, particularly, what Google and Apple do with the Android and iOS store. It's really democratizing who can play and what they can play. And maybe lastly is the accelerator programs from big tech. It's really allowing our talent to start to come out and start to do really exciting things. So those are the things I think are evolving or have evolved the ecosystem in the past 10 years. I think the second part of your question, what has caused growth? Capital. There's a lot of capital flowing in now, and that's helping to fund growth. We're also seeing that the financial institutions in Nigeria, they are very, very competitive. They demand innovation excellence, and so that's really helping to drive what we are all doing. And maybe the last part is, interestingly, we think it's also the impact of CBN, the regulator. They are challenging us to be proactive, to be ahead of the curve, but at the same time trying to make sure that everything is secure and the right policies are in place. So I think that will be it from me. Yeah.
Thanks, Muyiwa. Chioma, any thoughts?
Okay. Thanks, Muyiwa. You've actually set the pace for my approach to the question. I think we should, in the Nigerian context, we should give credit to the central bank. Actually, in 2007, there was a deliberate attempt to refocus the dynamics for payment ecosystem. And with that, certain guidelines were brought into place, policies were brought into place, which has helped the interests of the general public. But more importantly, with the growth that has been created, there's been more awareness around the different parties within the ecosystem as to what they can do. Then, of course, the influx of capital has helped. But more importantly, and which is what Muyiwa touched on, if you look at the sequence, it was predominantly cards. Then at some point, there was the need for us to have a super processing platform with NIBs, which brought opportunity for a lot of technology to come into space. There was a platform for people to test out all their ideas. Now that brought about the whole telephony, the growth in the telecom sector, the need for people to be able to transact. And if you look at it in the 10 years and 5 years, there was a major change 5 years ago. What happened? It was the point that with the capital that has come in with the technology advancement, there were a lot of initiatives around people paying without needing their cards. So you begin to find things like token payment, you begin to find things like tokenization of different payment infrastructure. All of this culminated into development where you have the Y Combinator series, a lot of people who trained up coming in. But essentially, where that has brought us to is the foundation for which I want to recognize our context of Africa. What do we have working for us? Typically, if you look at the growth in cards, it was stunted. Why was it stunted? There was a distribution problem, which was typical of our demographic. But of course, the success of the telephony industry brought about people being able to make payments with mobile apps and USSD, which Muyiwa touched on. And those are the things I think have really evolved to grow that space. But more importantly, there's still quite a lot of initiatives in the play which are coming in, because now the ecosystem has been built up. There's loyalty. There is a lot of ideas around data protection, data enhancement. All of this has culminated in the success story of the payment ecosystem.
Excellent, super. Thanks a lot, Chairman Muyiwa. And very good points you all articulate. But I'll just write off the very last key points you made and with respect to the role the regulator has played in all of this. We've seen the payment space face tremendous central bank regulation, over time, and payment service companies, have seen an increase in this regard more recently. Now, the regulatory risks seem to be on the rise in the broader payment and fintech ecosystem. I'll come to you, Ashke. You have a very interesting background and have worked in several frontier and emerging markets. How do you think about this regulatory dynamics? And how do you think about them vis-a-vis your experience in how they have also panned out in other markets?
Yeah, I would say, when I think about a couple of geographies in my mind, South Asia, particularly India, you look at this side of the world, the Middle East and Africa as a continent, because Africa itself is broken down into so many different parts, but I'm not getting into each country for the moment. But when I think about that, I would say India probably top of the stack on regulation, but a very strong follower to that would be Africa, and Middle East would fall far behind. And if you think about that, I actually think that African regulators have been quite progressive, across the board in general. As a fintech industry, as we process more payments, we do remittances, we do consumer loans, it's unfair for this industry to expect that there will be no regulation. In fact, some regulation is important so that there is a balance between, let's call it, the good actors and the bad actors, which are always there in an industry. And I think that's very important. And I think that in general, I would say regulators have been very forthcoming, at least my experience, across all the markets in Ghana, Tanzania. These are all places where we've gone in and acquired licenses. We've actually had conversations with regulators, and we've realized that a lot of them may not be fully up to speed on the thinking, but when you talk to them with logic, with answers, with parallel examples, they are very keenly listening to you, and they're very open to invest time and effort in understanding your viewpoint. So that's been my experience, across the board in Africa.
Thanks. No doubts the regulators have a tough job to do, and sometimes they don't necessarily align with the desires of the operators. But thanks for those thoughts, actually. Amandine, I'm going to come to you now. You're an executive at Paystack, an entity that is basically looking to solve payment problems for businesses, particularly small and medium scale businesses across Africa, by enabling them accept payments digitally, at least at the heart of it. Paystack is probably a lot more than that, but at the heart of it. How do you estimate the size of Nigeria's cash economy to be? And what percentage would you say has been digitized so far? Or put it differently, what percentage of transactions in the Nigerian economy do you estimate are happening digitally as opposed to in normal analog cash form?
Yeah, no, it's a good question. I think, as we all know, cash still plays a very large role in the Nigerian economy. I think there's still a lot of informal activity that happens in Nigeria, and it's very hard to quantify just exactly how large that is. I think one thing that I always remember is I was sitting on a panel 5 years ago with someone from Visa, and someone asked them who their biggest competitor was, and the answer was not MasterCard, the answer was cash, right? So there's still definitely this knowledge and just this reality that cash is incredibly prevalent. I personally have not done statistical analyses to see what it represents in terms of the whole economy, but I know that some have tried to put a figure to it. The Gates Foundation, I think, says 95% of the volume of transactions, not necessarily the value, because of course, a lot of cash transactions can be quite small, but in terms of volume, some estimate that it's still up to 95% of the volume that happens in cash. That said, I do think that there has been a massive move towards digitization, and part of that is also because it's just a lot easier to accept digital payments. So if I think of Paystack and our journey, what we process on a monthly basis today is more than 8 times what Nigeria as a country was processing on a monthly basis when we started the company in 2016. So that's a massive exponential increase already. Just the entire country was processing less than 8 times more than what we are processing today as a single company. And I think part of that was also a lot of education around people were paying online with their cards for the first time. You've also seen a lot of innovation. Someone was talking about the types of innovation that we've seen in payments, but even just beyond card, NIP, bank-to-bank transfers in Nigeria. I think Nigeria is one of 5 countries in the world where you have instant bank-to-bank transfers. That's a massive innovation that has happened in Nigeria in the last few years that was spearheaded by NIBS. And then more recently, if we look at COVID and what has happened, that was also another catalyst for innovation. So just us, again, we saw our signups increase 5x in 3 months because of COVID, and because we made it very, very easy for people to accept payments online. If you think about it, if you are restricted to cash, you can only do business face-to-face with your customer, probably from 9 to 5. But as soon as you switch your business online, you can accept payments anywhere from anyone at any time. You're basically doing business 24/7. And so that's obviously got a massive benefit to African merchants. So I think we are seeing a lot of that digitization. That doesn't mean that cash is going to go away tomorrow. But yeah, it's an exciting time to be part of payments in Nigeria.
Super interesting thoughts there. And for my next question, I'm going to stay with you, Amandine, but I'll also bring Muyiwa into the conversation. Now, riding off the back of some of the things you just mentioned, Amandine, from where we are today, because whatever that figure is, whether it's 95%, 80%, there's still a huge opportunity right there, and a lot of work that needs to be done in digitizing the exchange of value between people. From where we are today, what would you say is required to get digital payments in Nigeria to the next level, and what do you reckon are the main impediments or hindrances to us getting there? We'll start with Amandine, and then we'll move over to Muyiwa.
What do I think is needed to get payments to the next level? I think that there are a few things, there are a few pain points, and these are things that we've tried to address one by one. I think the first thing is just to make it as easy as possible to get started, right? If it takes someone 3 weeks to try to integrate and to try to sign up and start accepting digital payments, they're going to abandon, they're going to lose heart. So I think one of the things that we tried to do was to make it as easy as possible for anyone, even if you are not a developer, even if you are not a technical person. We actually launched something called Paystack Commerce, which is basically e-commerce in a box. Just upload photos the way you would on an Instagram account, but automatically start accepting payments. So I think that's one aspect of it, is just trying to make it as easy as possible to get started. And that means onboarding, KYC, easy plugins, all of that. I think the second thing is probably on the pricing side. And I know you mentioned at the beginning, Sharon, that we'll talk about take rates eventually, but it also needs to make sense for merchants to accept payments, right? If it's going to cost them 20% of the transaction to accept digital payments, it's just cheaper to use cash. So I think pricing is something that has to be taken into consideration. And then I think the third thing is just reliability and security. I think the most important responsibility of a payments company is to make sure that payments are reliable and payments are secure, that there's no fraud going through your platform, and that if a customer is trying to pay, that payment will go through. And for a very long time, it was something that needed to be changed in the psyche, that if I pay online, it's actually going to reach my destination as intended. I think that's still something that is very important for all of us as payment companies to get right. And we have a massive responsibility to reinforce that, which will in turn increase digital payments.
Thanks, Amandine. Muyiwa?
Yeah, I think I'll just add, I agree completely with Amandine, and I'll just add to what she said. I think because it's a really broad question, how do we really get to the next level? I think the big thing we probably also have to add is collaboration. We are so many players, we all have to compete, so we have to collaborate and compete, end up competition. But the opportunities are so large. I don't think any one entity or any one company can take it on themselves. For us to be able to innovate quickly, take on the biggest problems, and there are quite a number of them, we need to collaborate. But I just try and explain that a bit. You know, in Adesoji, we have this thing where we say we have a live and let live strategy, and so we create solutions, we create services, and we allow others to use these rails to build their own businesses. Yeah. And so if I just use a similar example, if your specialty says in, say, blockchain, we want you to be able to look at us or look at other players and be able to use their rails to make your own business something bigger. Yeah. And so in summary, I think if we look at collaboration from the point of view of all of us coming together, taking each other's strengths, I think we'll be able to really take everything to that next level. Yeah, so that's a big thing I think I'll add to what Amadine has just said.
Ashley, do you want to add something?
Yeah, I was just going to say, I mean, you know, I think I fully agree with all the points that Amadine and Myoba made, but I think I'd add one more element there, and that is development of the ecosystem. And what do I mean by that? Because, you know, it's payment ecosystem, but it's a lot beyond payment ecosystem. Let me take an example to illustrate some of those things. So, for example, you know, somebody talked about paste e-commerce in a box. You know, the question is, there are today, you know, when you go to Indonesia or when you go to Asia Pacific, you find homegrown Shopify's very strongly prevalent over there, right? And they don't necessarily specialize on payments, but they specialize on how to take your business online, you know. And I don't want to comment on anybody's product, but I would imagine that if you focused as a business only on taking a business online, right, that is different from when you offer it as a value-add service as a payment company. Because then your core business is still payments. It's not taking a business online. It is, but it's not entirely, right? So when you find that the ecosystem develops, there are network effects which benefit even the payment businesses. And to me, I feel like the more we have this interaction between the network and the payment businesses, that's one clear way that the direction can improve and be significantly better.
Excellent. All very interesting thoughts there, and I agree with all the points all the participants have made. And I think what the point you make actually is quite critical. If the more people we can get online, the better it is for the entire ecosystem. So I'll move on to you, Akshay and Choma, but I'll start with Choma for my next question. You both operate in slightly different segments of the ecosystem. And where along the value chain do you expect the most value to be captured as we go through the cash to digital transition in Nigeria? Will it be on the acquiring side? Will it be on the issuing segment? Will it be processing, switching, terminal ownership? What are your thoughts?
Thank you. It's interesting you trying to put it in a box, but I wouldn't, because if you take payment, there are so many components to a successful payment process. For every transaction issued, it has to be acquired. For either of them, it has to be processed. So they kind of all go hand in hand. What I think is more important, if you're trying to look at what would be the key focus, it's actually the framework, which is what I hear everybody speak to when they talk about the ecosystem. I will take a typical situation we have in Nigeria today, if that will kind of put it in context. Today, there's this excitement about agency banking. Everybody is talking about it, but nobody is seeing the problem we have created. The numbers look good, the turnover looks good, revenue is coming, but we have all worked counterproductive to the objective of a cashless society. So what should we do? If you take a typical dynamics the process flow. The person who has gone to the agency banking location to do a transaction typically went there with one of the existing tools, either a card, the phone, or access to the account. You imagine, what is that person doing with that cash that he or she has gone to transact on, either for the paying process or for the withdrawal in the case of the cash in, cash out? Because the reality is most of those locations do not do much of the other services designed around agency banking. So you now go back and understand that for you to focus on where do you expect growth, you want to build out the ecosystem so that the representation of all the channels that make a successful payment are well represented and really promoted. That is where I come in to say it is not about choosing one over the other, but the full spectrum to be sure that it is fully integrated. I know I might not sound politically correct because it will look like you're taking revenue away from a segment of the market, but the truth about it is there is opportunity for all of those players to evolve from all of that cash-laden process to a cashless process and still provide service. So nothing says, like Ashe was speaking to, nothing says if you live in Ogbomoso, you are a provider of terminal services to all the shops around Ogbomoso. You earn money as a terminal owner, you earn money as the infrastructure provider. So there's opportunity for everyone. So if we really define payments, let's first of all ask a group, as an entity, what is our objective? The lady spoke about the need for us to say, build out end to end. When you're building out end to end, who are the key players you need to enable? Those are things that we need to focus on. But for me personally, I would say build out full spectrum and let everybody find the niche and the value they can provide to the process.
Excellent. Thanks a lot, Chioma. Actually.
So Shion, unfortunately, I don't know if Chioma has disappointed you, but I might disappoint you even more because I'm not going to answer the question which you asked, because the answer, I kind of agree with Chioma, and maybe I'll say it in slightly different words, but it's the same thing. I think the guy who creates value or takes value in the chain is who solves the customer problem. And whether that means the entire ecosystem of what you're talking about, acquiring, terminal, no terminal, whatever, doesn't really matter. That is a means to the solution which you are offering the customer. If you solve a customer problem, you will take the bulk of the value in that ecosystem. That is how we are looking at payments when I look at all the markets. And let me illustrate a small example to you. We were in Lagos, you walk into one of the, and I'm not going to name the store because that would be unfair, but you walk into an electronic store where typically you would have a large transaction volume value to buy a television or a consumer durable, whatever. And you say, okay, what are the payment options? If I don't want to pay by credit card, and you say, I want to pay by bank. It says, yeah, you can pay by bank. Go to your banking application, enter this code and make the payment. And then the guy at the counter will be calling his finance person. Have you received the credit? Have you received the credit? For 10 minutes, he'll make you wait. After some time, he'll come back and say, yeah, the money has been received. Now you can go. Yeah, after 10 minutes. Now, you see this all the time. Either I've got to have that much cash in my wallet to give to this guy, or I've got to have a credit card, or I have to wait at the checkout counter for 10 or 15 minutes until the finance person can confirm to this guy that the bank payment has come.
Yeah.
So the question is, do you solve that problem? Now, we went with a solution to solve that problem. We said we can give you instant notification once the credit happens at the checkout counter. And every retailer we know is signing up on the product we don't even have 30 minutes of sell time to any retailer in Lagos to deploy this product. Why? Because it's solving a customer problem. So I think, I mean, I guess I'm just illustrating the point that I was trying to make earlier, that the value lies in problem solving, not in a particular aspect of the transaction.
Super, excellent thoughts. So if I hear you all correctly, and to put it in different words, it's really about solving the problems of the customers. And the more customers you can solve their problem, essentially increasing the pie, the better it is for everyone. and then everyone gets the benefit from it. I'll take a slight pivot to a different segment of questions, and I'll start with Amandine. Since the beginning of 2019, Nigerian startups and early stage businesses have raised well over, $1.7 billion is the last figure I put that at. Fintechs have clearly led the charge with well over $1 billion raised, with payments being one of the most active areas in attracting funding. We've also seen some exits happen, none more notable and exciting than Stripe's acquisition of Paystack, which you, Amandine, were one of the key actors in driving that. So for my next question, which is a two-part question, I'm going to start with you, and I'd like to get the thoughts of everyone on the panel. And it's, how do you assess the barriers to entry within the payment segment? And now that a lot of money has been raised by a decent amount of actors, how do you see the competitive landscape evolving from here going forward, including from the banks? And we've heard it from a few of them today in earlier panels, who are now looking to get more active within that space.
Yeah. On your first question, so what do I see as the biggest barriers to entry? I think probably the biggest one has got to be regulatory. It's because, as we've all already mentioned, this is a highly regulated space. Yes, anyone can start a fintech business tomorrow, but at some stage, you're going to need to start thinking about regulation. And when I think about capital, fintech companies are actually pretty lean and efficient. They're not very CapEx intensive. When we had to close our office, it was actually very easy for us to go to remote work because everything sits in the cloud. So it's not a very CapEx intensive business per se. That said, there are a lot of capital requirements when it comes to regulatory needs. So I think as much as there's massive entrepreneurship and a great ecosystem in Nigeria, as soon as some of these burgeoning fintechs start gaining scale and growing, the licensing aspect is probably going to be the biggest thing that needs to be taken care of, and that can be quite expensive depending on which vertical you're in. As we know, fintech is all-encompassing, and just in Nigeria, there are dozens of companies, whether it's savings or investments or payments or insurance. And so each of them have their own different regulatory requirements. But payments, there's been a lot of changes in the regulatory environment in payments, as you mentioned, in the last couple of years. And some of that comes with very hefty capital requirements. So I think that's probably got to be the biggest one, and maybe why a lot of capital is pouring in, because startups do need to raise money in order to meet those capital requirements. So I think that would be the biggest one, because it's not for lack of entrepreneurial hustle by far. I think Nigerians are probably the most entrepreneurial I've met in my life. So it's definitely not for lack of energy or ideas. So I think that's probably got to be the biggest physical barrier. And the second part of your question, Sharon, was around
the competitive landscape. Lots of cash and monies have been raised. How do you see that evolving, especially from, say, the banks as well, who are traditional and who are taking a keen interest in the space?
Yeah, to be honest, I think there's still a lot of value to be created. I think we are still just scratching the surface when it comes to fintech or payments in Nigeria. And I think we'll see more new entrants pop up. And it's actually a good thing, because this isn't a one player takes all market. We all have our role to play in advancing digital payments on the continent. And I think it's actually good. Muyiwa talked about collaboration. I don't actually see, the others on this panel as like competitors. We're all in the same market, and we're all trying to, make things a little bit smoother and more efficient in terms of accepting payments online in Nigeria. So, summary to your question, I think we will continue to see new entrants, whether it's fintechs across multiple different verticals, or the banks, as you mentioned. There are some banks that have very publicly said that they are restructuring into certain holdcos so that they can also themselves play the payments game. And yeah, let's see where that goes.
Excellent. Maybe we should move on to Muyiwa to get your thoughts on this topic.
Yeah, I think I'll take the second part, concerning the banks, yeah. The fact is, they are a foundational part of payments. They are just inevitable. So if they want to start playing actively, you can't say they shouldn't. They are gonna play. And the exciting thing about them really is when they play a different kind of game more often than not. They're, like I mentioned earlier, they're really very demanding, and they're very, very competitive against each other. And so that helps to bring the bar up as to what all of us as players need to do. Yeah. So I think, when they start to play more actively, as they set up their holdcos and set up their own fintech entities and so on, it's all going to get quite exciting. And we'll all have to just turn it up a bit, turn up the notch a bit more, yeah, to play here. Yeah. So that's it from me.
Thanks. Choma, any thoughts?
Yes, hi, thanks. Certainly, I've actually taken quite some notes, and I'll start with Amadine's input. I quite agree with her, but we're very or maybe ask for clarification when she says the regulatory perspective as a barrier. In my school of thought, I actually will see it as an opportunity, and the reason is quite simple. The person who is bringing in funds wants to be sure they are deploying their funds in a regulated context where there's safety. However, the limit to that regulation, what we often ask for is let it be consistent so that you would have done your risk analysis, understood what you're investing into, and then run the hub. But aside from that, another key requirement when it comes to the issue of investment is what does the investor require? One of the things we've seen on the market today is, and from my perspective, a lot of players who just think, oh, Paystack has raised this money, me too, I want to raise. You don't have to raise because Paystack has raised money. Paystack has done the work. Paystack has put in structures which has attracted investors. That's why they found them worthy to invest in them. Pardon me if I'm using Paystack, but the whole essence here is because Paystack has done it doesn't mean everybody must do it. So the whole buzz around funds flowing in is exciting. But the next question to you is, why are you raising funds? Are you raising it just because you want to build up and sell? Or you want to raise because you're building out your infrastructure organically with a long-term, or you want to expand? Those are things that are coming. But when it comes to the context of the industry as a whole, I'm quite happy to say on this panel today, I think we have a relationship now, speaking to Coral Pay. We set out as an infrastructure provider, a B2B. So we work with people who deal with customers. Now, when it comes to the context of investment, our focus is let us grow our infrastructure to be able to support our clients. So if you put that back into the context of what you see going forward with the funds being raised, I think the point to me is let us not just go with the excitement of raising funds because we want to raise funds, but raise funds particularly because of what we want to achieve with it. That's my take.
Akshay?
And I think my colleagues have covered it quite well. So I just have one small point to comment or to maybe elaborate on, which is that, I think that, you see, being an entrepreneur is not always about working hard, it's about working smart. So the question again comes back to a very simple thing. What is the problem you're trying to solve? Is that a problem which your competitors are not solving? And if the roadblock, for example, is a license, right? Frankly, I know so many companies today who don't have the license themselves, but are in exactly the business that a licensed player should be doing. Why? Because they have a commercial, no, not because they're breaking the law, don't get me wrong. Because they're going and partnering with a guy who has a license and solving the customer's problem. So yes, they are sacrificing margin, but because they are more nimble, because they have a better product, because they are actually solving a customer problem, they are becoming more successful than the guy who actually has the license himself. So does having a license guarantee you success? Answer is no. license enables you to do certain activities. Yes, it is a competitive advantage. It can be a bit of a barrier to entry, but it is not the end of the world.
Super. Thanks, everyone. Look, I think you've done justice to that question, and I think all the points made make quite a lot of sense when we put them in perspective. I'm quite mindful of time, so I'll just try and run through some of the other questions that I have left for the panelists. And I want to dive a little bit more into that competitive landscape. Nigeria's take rates are known to be one of the lowest across the continent. Some say they range between 3 to 5% or thereabouts. Now, if I start with
3 is very attractive. If you get 3, I would say
Nigeria,
right now my shareholders would be very excited if I told them 3%.
Maybe we should start with you. Actually, I was going to have you start this off.
I'm sorry. I'm so sorry.
But maybe we should start.
React to that one.
Maybe we should start with you. What are the take rates in the offline and online acquiring space in Nigeria? And then maybe I'll have you just give some color as to how this has evolved over time, and where do we see these going to over the next few years?
Look, I mean, I think the segments are all different. So there's not one rate but you're right. On international cards, maybe you could get to 3%. On domestic local currency cards, you will probably be at 1%.
0.5-1%, yeah.
On bank transfers, you might be at 0.5, 0.7%. So the take rates are definitely low in Nigeria when I look at Nigeria from a Pan-African context. Yeah. The one country where I find, but at the end of the day, I find that's an indication of either the potential of the volume or the actual volume, right? Let me give an illustrative example in Africa. Kenya, the blended take rate, I mean, Kenya is a $100 billion GDP, so we're much smaller than Nigeria. But Safaricom in 2020 did on their platform $65 billion of mobile money transaction. Yeah. On the $65 billion, can you guess what the average blended take rate is? It's 0.28%. Yeah. Now, so the question is, the more volume you drive, is your take rate going to dive? It has to dive, because I don't know if you noticed, Amandine made a comment about it, that imagine a retailer who makes 10% margin. His gross margin is 10%. Now, if you as a payments company come to him and say, I will charge you 2%, is he going to give 20% of his business profit to you because you are doing a simple thing like processing a payment for this guy? He's never going to do that, right? So he'll keep on taking cash. So if you want to move this guy to digital, your take rate has to be 0.3%. Then he will transact with you. And then you will get the volume that he brings to the table, right? I'll give you another example. Do you know what the take rate in India is, merchant discount rate in India now? 0.
Close to 0. Yep.
It is 0. It's exactly 0. And fintechs are being pushed to say, what is my business model now? Because there is no merchant discount rate. There is a unified interchange. So I think people need to be cognizant that when you want to drive that kind of volume, you have to be ready to sacrifice take rate. That's kind of my take on it.
Thanks, Akshay. I don't know if anyone else wants to add anything to it, to the point Akshay made. Chama, do you want to go ahead?
Yes, more like a question for Akshay. I like the perspective and I hear what he's saying, but one challenge I've had, and it's cut across the industry, in a country like Nigeria, where the cost of providing service is shooting high, regulation is fixing prices, there's competition in the market. How do you expect fintechs to survive? Because one of the things I've heard people preach, I don't deal with the consumer directly. I deal with other businesses who deal with consumers. They often come back to us to ask, at this price, we will not be able to serve our customers. Let's come down on your pricing. But then because we are regulated, every take we collect, we have to share based on a guide to bank charges. How do we reconcile all of this? Maybe perspective from my panelists to help, my colleagues.
I don't want to be the only one speaking, so I'm happy to offer the mic to others and I can chip in at the end, but I do have a view on it.
Muyiwa, Amandine, do you want to share thoughts, comments? You're on mute, Muyiwa.
Yeah, you know, when Choma started, he said the question was for Ashke, so I was actually looking forward to hear it from.
Okay. No, look, no. So my simple answer there to you, Choma, to be honest, is that you see, necessity is the mother of invention. Only when you're pushed against the wall do you invent your business model. But I also said another thing. So I think I'll give you an example. In places like in India, where the merchant discount rate has gone to 0, people are now earning off merchant lending. People are now earning off merchant investing. So whichever merchant has surplus cash, they're investing for those merchants. People are now earning off data analysis of their merchants, right? So I think business models evolve, right? I'm not saying that evolution can happen like overnight. It will never be like that, right? So some pain will happen, some not so good things will happen. The ecosystem has to cooperate. Regulation has to cooperate. For example, you know, I talked about take rates, right? But fact of matter is, I can't drop my take rate as a service provider today. Why? Because my mobile money operator is not willing to reduce his payment method cost. Now, you go and talk to a mobile operator 20 times every month and say, guys, I'll give you 10 times the more volume. They don't understand that. They want to maintain the rate. So what do? So that's what I said. The ecosystem has to also come together. There's no straight answer. I don't have an answer to your question, but I'm just kind of trying to illustrate the nuances here, which can drive in that direction.
Thanks, Ashke.
Let me just, I don't disagree. Okay,
No, go ahead, Muyiwa.
Okay. Now, I just wanted to give a bit of color of the evolution, to the evolution. You know, when we set the fees many years ago, I think we kind of dictated what the fees are to a large extent now. There wasn't that much POS or web MSC transactions a very long time ago. And when we started, we were trying to make it competitive because of the international scheme. So we actually brought the price much lower to generate adoption to a large extent. And what we've seen is over time is that lower price is where we've kind of had to keep it. We can't go higher, and every now and then it tends to even go lower. Now, whether it will get to 0, now I don't know. I don't want to. That's a very difficult place to get to. I don't want to speculate on that.
Just so we're mindful of time, I know we've got about 10 minutes left, and I want to just pivot to a few other questions that are quite topical. Okay. And maybe I'll start with Choma and then get Amandine's thoughts on this. Competition for engineering talents is one of the themes that we keep hearing has become one of the key challenges facing the tech ecosystem in Nigeria. Can you help us understand how big of a challenge this really is and how you're managing to navigate this dynamic? Choma, do you want to start, and then I'll move on to Amandine?
It is a big challenge. It is a thorn in the flesh. And the reasons are very simple. It comes from the bigger macroeconomic situation we see. And it's not so peculiar to Nigeria or Africa, but it's more. And the reason is quite the fact that the currency, the security situation, the end-SARS experience, and of course, the evolution. A lot of our talents, like Amadine mentioned, there's so much talent. I operate a mini sandbox system where I welcome people to bring their ideas, test with us if it works well, before we even start asking them if they have regulatory. But one of the challenges they've had is challenge of getting the desired revenue for what they want. But because so much capital is chasing Africa, the new frontier, for investment, for payment experiences, you find that these people, having learned from our experience, are able to come up with innovations. They don't have where to test it out. They don't have where to deploy it. And what they then do is then make themselves available for foreign expertise or foreign experiences. And what we face today is this. Well, let me put it how we've managed it better. So when we set out as Coral Pay, we actually created an environment where you can work from home, looking at the challenge of commuting in Nigeria, in Lagos, and all of it. So that helped us first. And we also encourage people that you can do a second job. However, so long as there is no conflict, then it's fine. And that has helped us build confidence with our team. So I haven't personally had much of what we call people leaving, but what we found is that, yes, you can do a second job and you can manage that experience. It's my style. I don't know how it works for everyone. So we are working remotely and we've tried to manage it. But the truth is, the average good guy has offers on his table. And if you don't build a relationship with them, if you don't give them interest to see that they are part of the organization, they will readily just walk away. But if you give them that opportunity that they can meet their needs and all of it, is well and good. So today we have people working for us from all over the world. That has helped us keep operations going and build stability in the infrastructure. And that's how I have managed. But the fact that it's a problem, it's a big problem, because even banks have suffered it, where a whole department within a span of 2 weeks just drop their papers and they're off. And there are so many countries welcoming everyone.
Thanks, Choma. Amandine?
Yeah, I agree. I think it's just a massive thing that everyone is conscious of. I think Paystack in particular, we are over 50% of our employees are engineers or product managers. So we are highly technical as a technology company. But of course, our ambitions are massive. And so you're really going to be constrained by the number of people that you have that can actually help you build that. And yes, there's a big commercial and business and growth perspective as well. Marketing, sales, finance, everyone plays a role. But if we think about who's actually going to be building the technology, who's going to be building the product, there's a massive premium on engineers. I think one thing that has helped us is that we've always been very remote friendly. And now post-COVID, we are remote first. We are also, even though we were headquartered in Nigeria, we're a Pan-African company. So we actually now have employees in, I think, probably 12 different countries. And for engineers, we have engineers in East Africa, we have engineers in South Africa, Nigeria, we have an engineering hub in Dubai even. So the rule that we have internally is plus or minus 3 hours from Lagos time zone is fair game. And we've made it very easy for anyone that aligns with our mission and what we're trying to build on the continent to join us on this journey. So Choma, you mentioned you have people worldwide. I don't know how you work through the logistics of time zone. We've tried to constrain it to plus or minus 3 hours. So basically Europe, Middle East and Africa is fair game. But beyond that, just to echo what Choma was saying, I think it's also very important to give engineering talent autonomy, responsibility, and feel like they are really part of the mission. So I think one thing that we've tried to do at Paystack is be very intentional about the culture that we are building, and really give people, even if they are very junior, I think the average age of Paystack is maybe 30 years old, give people the feeling that they are really part of something much bigger than themselves, and that what we are building is truly going to stand this test of time. And I think that makes it pretty robust to defend the engineers that you already have within your company.
Excellent. Thanks, Choma and Amandine. So we've come towards the end of the program, but I have one more question that I'd like to get the thoughts of the team on. And I'll probably leave this question with Muyiwa and Akshay. What are your thoughts on regional Pan-African intercontinental expansion? So for those of you who have been able to scale out of Nigeria, and I believe everyone, perhaps apart from Coral Pay, has, how have your experiences been, and how do the other markets differ from your experience in Nigeria? So perhaps Muyo, you want to go first, and then we'll wrap up with Akshay.
Okay. I think every market has its own nuances, has the socioeconomic factors that affect it. What that means, I mean, I've seen it first-hand experience. I had to run our business in Uganda for a couple of years. And what that means is that, I mean, a lot of your success in one market, you can't copy and paste it in another market. The nuances are just too strong for that to happen. And so what we've seen is from the years that we have been doing this is that we have to, first of all, look at local talents, try and get good local talent so that you can get the real insights, get the true insights of what the market needs. And then the other part of it is having a very open mindset. So allowing that local talent to be able to dictate, what the direction should be. And then maybe the third part is just having a bit of patience. It's going to take a bit of time to get the right mix together. I think when we started doing all of these things, then we started seeing the kind of results that drive scale. Yeah, so that's what we've seen, and that's what has been our experience.
And finally, Akshay, what are your thoughts?
Yeah, I mean, I think on that one, I would say firstly that I would concur with everything that Mayova said on the fact that every market is a different market. You can't treat it with a similarity. Sometimes there are similarities in regions. You will find that that there are some advantages of a particular block, right? But I think more broadly, I find that being Pan-African or across a group of countries makes your business a lot more defensible and a lot more, a lot less risky because no single market then determines how your business performs. And that's a very important element because, there will be times when currencies fluctuate, there will be times when there will be political instability. And, when you have 50% or 70% of your revenues coming out of one country, right? And suddenly somebody says now from tomorrow morning, foreign exchange is shut down. Some of these things have a material impact. And so consciously we've steered away from that. Today, I can proudly say that I think the highest contribution of any country is 30% in our business. And we are aiming that by 2024, no market will have more than 15% concentration in our concentration of revenues in our business. So that's the direction we are headed in. And we are also leveraging this with your previous question, Sean, which is around talent availability. So we're trying to build a pool of technology talent across the markets. The team is central in Kenya, right? But the team is in a way physically distributed. So it's a lot easier to find the top 5 engineers in Zimbabwe than it is to find the top 5 engineers in Nigeria. And chances are very high that you would get the same quality at probably a lower cost in Zimbabwe than you will in Nigeria. And that's what COVID has taught us, right? So we are actually moving towards a distributed technology team across the footprint in Africa.
Super, excellent. And on that note, I'd like to say a very big thank you to all our panelists, Chioma, Amandine, Muyua, and Akshay. It's been a real pleasure having you join us on this our inaugural Tech/Fintech conference. Thank you for your contributing to what I would describe as a very engaging session. I found the discussions very interesting, and I'm certain that everyone who was watching thought the same. I wish you all continued success in your various business endeavors, and we look forward to hearing more exciting stories from you all. To everyone watching, thank you for joining us on this panel. We hope you enjoyed it. Join us once again in another few minutes for our next panel discussion with digital logistic players. Good afternoon,
Thank you very
everyone.
much. Thank you, guys. Thank you.
Thank you. Have a
Pleasure
good day.
meeting.
Knowledge is information, but not all information turns into knowledge. Today, every company leaves digital footprints in hundreds of different sources. But this information by itself does not tell you who it is you're looking at and what the risks of doing business with them are. Businesses can't exist in a vacuum. They need employees, customers, partners, contractors, investors. Good counteragents help a company succeed, create products, make profit, expand business opportunities. But what about bad ones? 49% of organizations around the world say that they've been victims of fraud or economic crime. 2/3 of Russian companies say they've encountered economic crime in the past 2 years. This is significantly higher than the global average. Every year, 15% of companies simply disappear, whether on their own initiative or because they're forced to do so by tax bodies, often leaving unpaid debts. If you want to minimize your risk, you need to find and analyze every scrap of information you can, identifying, analyzing, collecting facts. Processing big data is impossible without qualified specialists, experience, time, expensive equipment, new technology, machine learning, graphs. Spark Interfax gathers information from all available sources and converts it into knowledge, allowing you to see the world of business in its entirety with all its risks and opportunities. And there's no doubt that tomorrow we'll be able to understand the world of business even better, thanks to the emerging digital economy, cutting-edge technology, and the availability of new information about the lives of companies. Knowledge decreases risks and creates trust, the foundation of any successful business. is information. But not all information turns into knowledge. Today, every company leaves digital footprints in hundreds of different sources. But this information by itself does not tell you who it is you're looking at and what the risks of doing business with them are. Businesses can't exist in a vacuum. They need employees, customers, partners, contractors, investors. Good counteragents help a company succeed, create products, make profit, expand business opportunities. But what about bad ones? 49% of organizations around the world say that they've been victims of fraud or economic crime. 2/3 of Russian companies say they've encountered economic crime in the past 2 years. This is significantly higher than the global average. Every year, 15% of companies simply disappear, whether on their own initiative or because they're forced to do so by tax bodies, often leaving unpaid debts. If you want to minimize your risk, you need to find and analyze every scrap of information you can, identifying, analyzing, collecting facts. Processing big data is impossible without qualified specialists, experience, time, expensive equipment, new technology, machine learning, graphs. Spark Interfax gathers information from all available sources and converts it into knowledge, allowing you to see the world of business in its entirety with all its risks and opportunities. And there's no doubt that tomorrow we'll be able to understand the world of business even better thanks to the emerging digital economy, cutting-edge technology, and the availability of new information about the lives of companies. Knowledge decreases risks and creates trust, the foundation of any successful business.
Good afternoon, everyone, and welcome to RENCAP's Tech and Fintech Conference. My name is Shibundu, and I am your moderator on the panel discussion with the digital logistics companies. The panel will focus on the digital logistics space in Africa, and the discussion will be centered mainly around expansion opportunities, operational challenges, and how the players see the market evolving. Given the underdeveloped and challenging supply chain environment, especially in West Africa, players will discuss how they intend to maneuver and benefit from the developing markets. Without further ado, I would like to introduce our very interesting speakers, Mr. Tayo, Genjo, Leo, Ignatius. Thank you so much for coming here, gentlemen, and we are very excited to hear what you have to say. Today, I'm co-moderating with someone well-versed in the tech space in Africa, and I'll let him introduce himself.
Oh, hey guys, my name is Tej Kenel Kafo. I'm the African reporter for TechCrunch. I'm an international tech publication. I've covered, African founders, startups, and venture capital over the past 2 years, and it's interesting to see, the startups we have here today morph into what they are, what they have become now. And yeah, it's glad to be on this panel session. Over to you, Chibundu.
Thanks, Tej. So just heading right into it. So many consider logistics and mobility as one of the toughest industries to thrive in, especially in countries like Nigeria that have a serious infrastructure and financing deficits. So just could you walk us through exactly what you do, and can we get a definition of the key problems you're trying to solve and how solving that problem has gone so far? I would like to start with Tayo, then Genjo, Leo, and then Mr. Ignatius.
Hi, Chibundu. Thanks. Nice to connect with you again, Tej. And of course, nice to reconnect with all the speakers. Yeah, so I'm currently a Chief Operating Officer for Move Africa, managing operations across our four markets today, Lagos, Accra, Johannesburg, and Cape Town. Right, so I'll start with sort of what's Move. So Move today is a revenue-based financing platform focused on mobility entrepreneurs across the continent. So to give some context and background to the problem, if you look at Africa as a continent, or look at sort of emerging markets, today in Africa, right, we're poised to have the fastest urbanization rate in 3 decades from now. Right, it's rising extremely quickly. So what's happened is lots of people have either moved or moving out to the city across the board. That rate is poised to grow by 3x. And if you take Nigeria as a case study there, Nigeria is poised to move from 10% about 3 decades ago to 50%, right, in 3 decades from now. So that's creating huge, huge gap and huge issues to be solved by the government and players like us. All right, so the question today is that urban mobility has caused a couple of issues and brought a couple of challenges, interesting challenges to be solved by players. The first thing is that lots of people are migrating, and these people who are migrating are either looking for ways to live high quality lives, right, or looking for ways to engage themselves in the system. And it's unfortunate that the rate of infrastructure growth has not been as fast. So the rate of infrastructure growth on the continent is growing much slower than the rate in population growth. So that's created a gap, huge gap. One is how do we improve quality of life of people who are making this migration or move? And the second thing is that how do you integrate people into this new economy? And if you look at what that has created, for example, in the last 1 decade, one thing that's created is there are lots of people who have moved into become mobility entrepreneurs. Unfortunately, a couple of these people, and lots of them are informal players in the system who really want to work, find a way to contribute to moving people around in a better and higher quality way. But unfortunately, right, they've not had that chance, right, just to do this. And what we're doing today as a business is unlocking this challenge by creating vehicle financing opportunities, revenue-based for these sort of entrepreneurs across the continent. And today we're Uber's preferred financing partner, scaled across our 4 markets. But the key is to use existing revenue, right, which is baked into our alternative credit score model. So using history of these drivers and customers on the platform to actually alternatively score them using this historical data and put them into embedded financing solutions to give them, number one, not just tools to work, but also help them contribute to improving the quality and also quantum of life they live in the city.
Okay, thank you very much. That was really interesting. Genjo, please.
Well, thank you very much, Chimbundu, and Tayo also for the very interesting approach. In fact, well, what Kobo does, where I'm head of structured finance and capital markets, what Kobo does, Kobo 360 actually, does is to put together transporters and cargo owners on one platform. So in a nutshell, we are a fintech-powered e-logistics platform. So by this, I mean that a transporter is onboarded, a client is onboarded, and there's a demand for transport from a cargo owner, which meets an offer of trucking services, haulage. So we bridge also gaps, just like Tayo, because it's very important to bridge gaps in Africa. Of course, we suffer of infrastructure problems, but the two gaps that we bridge particularly, one is aggregation, because the offer of trucking in Africa is very fragmented, while the demand is very concentrated. So our platform has the advantage of aggregate that demand, that offer, to be able to serve that demand. So by this, I mean, for example, the mainly what is exported from Africa is raw materials, so in bulk, and what is imported is finished goods into ports, mainly in containers. So you have to move all these, obviously, and that's what we do. And our business model is based on having the fee on the platform or charging the client. So why do we have the fintech element? Is because we believe in the financial inclusion of our universe, especially the truckers, and we believe that there is enormous potential in one, having them access to cheaper products like cheaper diesel that we can provide, access to cheaper tires, eventually care cards, and in the future also equipment finance, which is truck financing. And that's why also obviously data is extremely important. The building of the data is extremely important. But I'll stop there, I think. Just thank
Understood.
you.
Thank you very much. Leo.
Yeah, thanks, Chibundo. Interesting question. What does Lori do where I work? Very similar to what Kobo does. We're brothers in the terrain. So where do I see that terrain going? I'm sure that Genjo will agree with me that as sizable as our growth has been, both of us, we're still a very tiny drop in the ocean called the logistics space in Nigeria. And not to talk about the rest of West, East Africa, and Southern Africa. The space is extremely fragmented. Clients are underserved. Problem of matching these two big players, transporters and client, and facilitating that marriage to keep it seamless is an issue. The background to your question is infrastructure challenges, regulatory framework not supporting this kind of union. Exactly why we have a business, because there is a problem that is set to continue into the foreseeable future. And so all of our business models looked at the pieces of this puzzle. How do we make the transporter happy? It is by keeping his assets optimally utilized. How do we make the customer, the owner of the cargo, happy? It is by ensuring that his goods are picked on time and ensuring fulfillment. What are the key strategic pillars to ensuring that this happens? It is on journey management, via technology, via interface with all of the actors within that space. And so we are engaging not just as a tech company, because tech is a big part of facilitating that process, but Genjo, we agree with me that there's still a lot of blue collar elements that still can't be digitized. And we get our hands dirty, ensuring that those blue collar elements are well covered across the floor. So to answer your three questions, the outlook is overwhelming. We can grow 100x, 200x in another 3 years. That's how big the space is. The problem is not going to go away anytime soon. The problem is an African problem. In fact, it's an emerging market problem. And so we have really strong business model that is quite sustainable given that situation.
Understood. Thank you very much. Ignatius.
Okay, hi everyone. Good afternoon. Happy to be here as well. I had strategy and expansion at TradeApple, right? I think I'm slightly different from everyone else on this panel, yes. Considering that you're all long haul this financing. We are more focused on the tail end of the distribution, right, which is at retail. Interestingly, currently most of trade happens in the traditional trade, as everyone knows, in all of Africa. Nigeria more peculiar because over 95% of trade happens in traditional trade, right? We have barely scratched the 5% in the modern or more mature trade, right? And what we do at TradeApple, right, we have built a platform, right, that we've built an e-commerce and embedded finance platform for retailers. That's the guys on the long tail, right, to solve the challenges, that they face, right, including access to products, access to cheaper financing, right, for inventory financing for their products, right? And we have built this off the back of the fact that we know that some of the challenges that are being faced very similar across board, right, where retailers have to travel long distances to access goods, right? Also, one of the very burning issues that they face currently is the fact that they don't have access to structured financing because it's largely informal, right? And also the fact that the distribution play currently favors, right, because there's an advantage to serving wholesale, which means that you don't take on the cost of having to do the long tail and the multi-point drops, right, for the logistics that's at the tail end, right? Most of the distribution, even in traditional trade favors the wholesale market, right? So over 78% of every manufacturer's volumes go to the wholesale, right? And that comes with its own challenges, meaning that we have quite a number of middlemen within the chain, right? There's this goods, and with every middleman within the chain comes an additional margin or an extra cost, right, which must be served. So we want to disrupt that. We want the retailers to get the products at the cheapest prices, right? We want them to get them when they want them, right, at the right time, right? We don't want them to have to journey all the way to the markets, which is where most of trade happens, right? And we want them to be able to keep their stores open, help them grow their businesses with a bit of financing, right? And keep them open long enough for them to open chains and grow a lot larger than where they are. So those are some of the challenges that we're trying to solve at TradeDepot. We've leveraged a lot of tech and data, right, in our approach, because we see the value of data as a business, and we see the value of deploying tech and having tech data drive most of the decision making within the business. So that's basically a summary of who we are and what we're able to do. Also, I think just to add, right, we've been doing this for a bit over 4 years. We've grown to about having 75,000 retailers on our platform across 3 markets in Nigeria, Ghana, and South Africa. So I think that summarizes us basically.
Okay, thank you very much. That's really interesting, everyone. So I guess this question is more tailored to you, Gendro, Leo, and Ignatius. Tayo, you can just hold off on it for now. But logistical risks in Nigeria include verification, data availability, and we are not, there's the obvious trust element. So we just want to understand what are the key operational risks you face in your specified markets. Just like what is the major thing you face? Just we'd like to know. Gendro.
Okay, well, thank you. The operational risk, obviously, because there are trucks involved, a truck that doesn't show up is an obvious risk. So you have to have a very good relationship with the truck, being onboarded, the trucker, the driver even. So if you want to make sure that he's reachable all the time and you know what he's doing, he has to have a certain level of tech adoption. So tech adoption is important. And it's not an easy one because the great majority of truckers have Nokia 8810. And so dating from 1987 or maybe 1990. So that tells you that effectively, if you don't have a USSP approach, it's difficult to get hold of them. And then do they have enough credit? Do they have data? All these issues are one of the problems. Tech adoption, I think, is very important for going forward. So now another operational is not having enough trucks, for example. Are there enough flatbeds in Nigeria, or are there enough tote liners? There are a lot of brewers and not enough tote liners to transport boxes of beers, for example, or they are fighting. They want, Heineken would keep some for them, making sure that they are exclusive to them. All these kind of stories that we can try to get into the middle, but it's not obvious because the number of type of trucks is limited also in Nigeria. So that's another operational issue. So I think one last point, when we bridge the gap also is the financing part. I mean, it's not an operational as such, but it could be operational because when the trucker comes to the gate, he needs money to put diesel in his truck in general. So there has to be an upfront payment to fuel. And if the company that hires them doesn't do that, someone has to. And that's the next gap we bridge also, actually. We pre-finance this kind of things.
Okay. Ignatius, over to you. What risks do you face?
Okay, so in terms of e-commerce being still very young within this space, right? We face between ourselves and our retailers, really, right? you're trying to convert these retailers from the traditional ways of doing things to being more digital, right? You want them to trust that when they order products on your platform, that they get it when you say they are going to get it, which in our case is 24 hours, right? A lot of work goes into that, and the fact that we've largely digitized the entire route to market end to end from order to fulfillment means that from a data standpoint, the accuracy of our data on this retail points, right, needs to be 100%, because it means that I'm not going to send someone to go verify the store while deliveries are being made, right? I need to have done those verifications as soon as those stores are onboarded. So we spend and invest a lot of time and energy, right, in making sure that the data that we capture from these retailers are 100% correct, right? Data from their store locations to their phone numbers and everything, even down to the outlet types and all of that, right? We also have been able to give these retailers some digital wallets, right, which enables them to pay for their products early enough, right, or pay for their products via that digital wallet, right, meaning that we have been able to reduce the cash handling, right, which the drivers would usually have from a traditional distribution standpoint. So these retailers are able to pay money into their digital wallets while deliveries are also being made, and also get deducted from those same wallets if they have a credit with us and a loan or an active credit with us, right? So those are some of the things that we face between ourselves and retail, and some of the things that we've also been able to solve for from a cash handling standpoint. We have partnerships with a lot of financial partners, right? Most notably NIBS, right, for e-bills pay, that allows the drivers go deposit the cash if they have to deposit cash, right, and not have to carry that cash overnight and bring it to the warehouse the next day, right? So those are some of the things that we've done to mitigate some of that risk between ourselves and our retailers, between ourselves and the delivery or fulfillment angle. Yeah.
Understood. Thank you very much. Leo, I want to ask you too. So, I know Gendro has really said a lot in terms of operational risk, but is there any other thing you would like to talk about, particular to Lorry, that you face? Just quickly.
It won't be exactly particular to Lorry, given that we're in the same space. However, the biggest risk I'd like to maybe just add is the business we're doing is fulfillment, right? And that fulfillment risk is the biggest of all the risks. Maybe your transport rate, your rates to Kano is say 700K, but you're carrying a consignment worth 25 million. So you need to get that consignment from point A to point B, even though you have GIT insurance and fidelity insurance to cover that loss to your client. You also need to midwife that process in such a way that your rate of fulfillment is high, good quality, on time, all the time. And so investing in that on-journey architecture via technology is a significant part of the investment that we make at Lorry. Trying to get areas of that whole flow that are digitized. But because this industry is completely traditional and you're taking the industry on a journey, you need to calibrate for them and improve the model for them manually before they trust you enough to take your digital solution. For example, Genjo mentioned about electronic proof of delivery. A lot of even big multinational companies don't have a system that allows it to happen. You need to take them on that journey and then gradually get them to that destination before you can start integrating technologies. So, however, with what we have done, I'm very proud to say that fulfillment component, we are the risk element calculated over the last 2 years. We've done business in 3 years or 4 years in Nigeria is less than 0.003%. So while it is bigger, much sizable for the industry, for us specifically, the investments we have done has paid off. And we are on a project now to further reduce that by another 50% in Q4 of this year.
Okay, that's very impressive, and I'm looking forward to seeing how it develops. I'm sure Gendro is really happy about that, but it's interesting to see how it develops. I'd like to leave it to Tej for the next comments.
Thanks, Chibutu. So my question would be to move, since Tayo hasn't spoken, and I think he'll be itching to talk. So he mentioned something during his intro about the partnership with Uber. What I'd like to know is if you conduct checks independently or with Uber, and how do you make sure, like what checks do you put in place to mitigate losses? And also, how do you handle cash payments with Uber, since it's a two-way thing, yeah?
Cool. Yeah. So I think sort of first background is that I was at Uber between 2017 and 2019 or 20. And I saw this problem firsthand, right? Where there are lots of drivers who are willing to drive and an income, willing to hustle, but, they just have access to vehicles, or there was no part to ownership. So this is a problem. So the question is, how do you take, informality, use available data or technology, and sort of create an ecosystem? And to answer a question, right, I'll sort of lump the answers into three parts, right, and talk about some of the pillars of our business. I think the first pillar today is underwriting. So how do you do that? Right, today, many of the drivers who drive on Uber are not sort of formally plugged into the system, or you find that data in a credit bureau or anything. But what you have going is historical data that you can earn enough from. Right, first thing is that they drive, weekly, right, and there's the data on revenues, right, you can get from Uber. And we're integrated it via API, right, and that we inject that data into our credit scoring system. So you get that data, you have, data on their history. You can also check for things like consistency, right? So there's really not sort of open source for them in the credit bureau, but there's something you can work with. So that's the sort of first line of thought for us, right? Taking this entire bunch of data on the driving history, actually using that to, credit score and validate, drivers who pass that test. I think the second, is across our market, just looking for, where there's also proper, credit scoring, either from the government or, third-party sources. The third thing is just open data, right, where it's available in the market too. So sort of taking these three, anchors and like merging them together to form a decision on whether or not a driver qualifies, right, for a loan, and then you can further build on data in that aspect. Right. The second part of our model, which is extremely cardinal, is monitoring. And that's somewhere we've invested a lot of our resources with respect to technology. And there are two parts of our monitoring technology. I think the first is just the infrastructure that collects, data from sensors within the vehicles. Right. You can learn things about the driver's behavior, right? Driving speed, understand, safety checks and requirements based on the driver's character and behavior. And the second thing is that we also have a very robust monitoring team. Also looks for things like, where the driver is on time, checks for things like, their score on our system, checks for issues like, are drivers actually, safe and in the right place at the right time. And then just giving, the strength of our partnerships with our telematics partners and the data we can ingest, right, so far, right, where it's happened, where there's a loss or a potential theft, our recovery rate has been 100%. And that's been super. I think the third thing, right, talk about is loan servicing. So the way our business is structured today is that 100% of the inflows from drivers come into us directly, and then we sort of pay out through a waterfall. But in cases where there's a high cash penetration in the markets, drivers remit to us directly. And there are a couple of things we've built sort of in-app on the driver wallet that gives drivers the option to remit. And thankfully today, right, the fintech space or the disbursement space has become much more ubiquitous. So the driver sort of earns that money, right, but is able to transfer either through their bank account or through payment options like, many of the payment channels we have today, digital payment channels, right, which are embedded into our system, right, back, into Move system. So that gives us sort of the chance to collect that revenue upfront and pay the driver at the end of the week. Just bringing these three together, right, that sort of power of underwriting, also, the power of, our credit scoring system, the monetary infrastructure we've invested in, and the loan servicing system that we have continued to run, right, gives us a very full proof hedge and has really, created that ecosystem that's protected us from this risk.
All right. In addition or in continuation of what you just said, you mentioned drivers having wallets. So that's the embedded finance play, and I think Ignacio has also pointed that out for Trade Depot. So for the both of you, right? So we know banks have had shortcomings when it comes to vehicle financing or traditional distribution. I know you put in place financing for your drivers to access, for them to keep their operations flowing? Are there additional incentives that you give, your drivers and general stakeholders, right? And do you think your business model is sustainable in the long run?
Mm-hmm.
So,
absolutely.
I think you Ignatius.
Okay. So you want me to go first? Is that what you said?
Yeah.
Okay, absolutely. So I mentioned a couple of things that are interesting about the model and why it's sort of sustainable, both from like a customer LTV standpoint and just sort of the network effect of the model. I think the first thing is the flexibility we bring, right, and access to our paths to ownership, right. So for our customers or the demographic we deal with, these are sort of informal mobility entrepreneurs who can sort of walk in today with no data, and based on just your driving history, right, you can get that into a move car, right, and get that financing. So the first thing is the flexibility, whether it's in terms of how you pay, where you pay, or the amount of tenor or the vehicle you have access to. So that makes it extremely competitive. The second thing, right, to mention are just the competitiveness of our offers, right, in terms of the interest rates. So interest rates today are from high single digits to sort of mid double digits rates in the market. That's sort of 14, 15%. So that makes it extremely competitive. Now, just for context, right, in the informal market and the demographic we're deal with today, right, and I sort of saw this a lot at Uber, right, just because there isn't traditional financing or it's too long or too hectic, the alternative options are super expensive. They're sort of 50% through an informal partner, you're connected with, who really doesn't trust you, and there's no even reliability around this, earnings or this, vehicle or this financing itself, right, which is sort of called the hire purchase model. Nigeria could range up to 50%. So that competitiveness has made just, drivers extremely sticky and brought in that, sort of high LTV and value to drivers. I think the third part, which is important, is the embedded financing solution we have. So today, through a network of partnerships in our ecosystem, right, we have, 4 partnerships. A driver comes into the system, just needs to be screened and scored, right? You have access to a fuel card. We also provide, servicing and maintenance partnerships. We also sort of work on the licensing. We also, have screen-in ads that allow us in and the drivers sort of earn. Then we also have insurance partnerships, right, for these drivers, and OEM partnerships too. So you look at sort of all these pieces and this sort of point, and when you sort of add them together, there's a huge, deep network effect in there that not just makes us, extremely competitive, but also makes us, really sustainable from an economic standpoint.
All right, thank you for that. Ignatius, do you have anything to add? Although I know your business is, different, but you mentioned embedded finance for Trade Depot, and I'm thinking, okay, other players will have, embedded finance too, and the other incentives that Trade Depot provides to drivers and stakeholders in the market, and if your business model is sustainable in the long run.
Okay, great. Speaking of the issues or the problems with or challenges with traditional distribution, I'll do a very quick analogy. Picture the woman at the end of your street, right? No, it's not. Is it? Okay. Oh, apologies. Okay. Okay. Can you hear me? Yes, you can.
Yeah. Yes, we're good.
Okay. Yes, sorry. So, picture the woman at the end of your street, right? A mommy ayo, for example, right? Just for those that don't understand, mommy ayo is almost every store in Nigeria or in Lagos, right, is named Mommy something, right? Because almost over 2/3 of the stores in the country are owned by women. So it's a female-led play, right? Picture how she restocks her shop, right? Sometimes she has to lock up the shop in the morning and travel long distances to go and buy products, right? She pays for the transportation cost to get there. She pays for the transportation cost to load products into a vehicle and transport those products back to her store, right? And we come into a place where also she's only able to work with capital that she's able to gather from family and friends and maybe proceeds from the business as well. How can she significantly grow her business, right, without having to stay on long queues in the bank, trying to bring collateral of a land that doesn't exist or building that doesn't exist somewhere, right, because she's really informal. Also, she would not have a credit scoring, just similar to Tayo's scenario where his drivers can't have a credit scoring, right? There's no properly structured credit bureau for the informal markets, right? So we have to credit score based on transaction history, right? And a host of other things which form the algorithm that credit scores these retailers, right? And we're able to offer them much cheaper financing, much easier financing, a lot quicker than you typically get. I mean, if a woman has traded with me for 6 months or almost a year, right? And I have that history of her buying history and all of that. It's very easy for me to give her a loan to buy products on my platform, right? Grow her business, also align her, keep her store open, stay in the store, not having to leave the store to go buy products, right? The goods come to her, she sells, she makes her money. I've taken out the middleman in the chain, so she's making a lot more profits from buying from us and working with us, right? So that's how we picture that. Those are some of the challenges in a nutshell, right? I think I mentioned a couple of them in the introduction, right? Some of the challenges that we found ways to solve with the data that we're able to harness from offering these services to these retailers.
Well, thank you very much for that. I think Chibudu will have a follow-up question.
Okay, so I think this is multi-lot to Ignatius and then Leo also. So in your businesses, like in your specific businesses, like how do you see the logistics market evolving, and what sector, cement, FMCG, like do you see the most growth, and like do you see the most demand from? Leo.
Okay, so that's an interesting question. So the lorry model, the thesis behind it is that wherever there is a cargo to be moved, it should be moved, and it should be moved in a manner that gives us a history of where cargo comes from, where it goes, what cargo it is, what asset types is used for those movements, and over time provides us analytics that is useful for one, developing the space, regulatory, some form of new logistics activism in terms of what quality of road is relevant given the tonnage of cargo that is moving via different routes and all of that. And of course, grows our business. In the outlook for Africa, Africa is growing in population-wise on a daily basis. Food production capacity in Africa is growing on a daily basis. In Nigeria, most of the multinational companies are growing double digits year on year, whether it is in the FMCG, whether it is in the commodity sector, whether it is in cement, whether it is in importation, whether it is in traditional haulage and all of that. So we expect that every single sector, every single segment of the haulage business in Africa will continue to grow at double digits, some even at doubling year on year. Okay, so this is what gives us excitement, and these numbers are not just economic numbers from the National Bureau of Statistics showing evolution over the last few years. It is also coming from our experience. So, for example, we began our COVID recovery in March, and from March to date, we've grown 10x. From month to month, some months we grow 100%, some months we grow 80%. This is just how massive the market is. And so for our business, our expectation is that for the foreseeable future, 3 to 5 years, we should be able to do double the 10x, 20x growth year on year. It's a massive, 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 massive sector that we are so grateful to be pioneers in this space, along with other practitioners like Genjo.
Understood, understood. Thank you very much for that. I think Tej has a question.
Yeah, Genjo, I would like to ask, so last year during the pandemic, we saw there were some regulatory moves the government had towards delivery and logistic companies, right? I don't know how important regulation can be for investors when investing in a region. So I'd like to know about 360's relationship with regulators in the different markets you operate in, and how have you been able to mitigate some of these regulatory risks that have come up in the past and some that will come up in the future?
All right, thank you. First of all, I want to thank Leonard for his comments. May I add one comment on the growth potential to Leonard's quite exhaustive approach? Is that one thing, one sector in the logistics, where in the transportation part, where we'll see a lot of growth is the cold chain transportation logistics, meaning that obviously Africa needs more agricultural products to be moved, but the level of post-harvest losses are quite big, are too big for the moment. And one way to mitigate that is to focus, concentrate, and invest into the cold chain transportation systems in Africa, both in terms of depot and in terms of transportations. So that's one thing. Now, in terms of your regulatory question, we are not really, we're not specially friends with regulators, but for example, what happened during the pandemic, that every transport linked to food transportation was given a waiver by the authorities, both local and federal. And so the people who transport, the transporters who transport, for example, flour or pasta or all these kind of things, or tomatoes, could show a waiver to cross the borders between the states. So at this moment, for example, we don't, if you look at the emissions regulations, right, Nigeria is not really concerned about it too much, right? The great majority of the trucks are dirty. If you consider the standards of Europe and the US, it's a great majority of diesel. There is probably room for improving this by bringing cleaner trucks in the market. Trust me, we are trying to work on it with parastatal institutions in Africa, for example, the IFC or the other groups like this. But there is a matter of cost, of the implication, of course. A gas truck costs double the price of a diesel truck, notwithstanding the fact that the great majority of the trucks, when they are new, are very expensive compared to the Tokumbo that you can find here. Right? The Tokumbo meaning second-hand trucks, right? So, and those second-hand trucks have the preference of the stakeholders in the market, because the price of transport is the same from Lagos to Kano. Is always 700,000, right, Leonard? You can't change that. If it's a new truck or an old truck, it will be the same price. So going further, let's suppose that going further, we want to add more trucks and we want to be a stakeholder in adding more trucks to the market. We will be considering the fact that we will need, for example, a leasing, we will have to comply with the regulations that are needed for owning trucks and being able to lease them out. That's one thing, but that's not in the immediate future. That's, for the moment, we are very much of an asset-light company.
Okay, thank you so much for that. I know it's a different dynamic, but Ignatius, how is your regulatory, the environment for you? How do you deal with it? Is there anything particular that we'll find interesting about about the regulatory space for you?
Not at the moment, right? Just like in Genjo's case, right, during the pandemic last year, where movements were restricted, food provisions, right, were allowed to move and be transported across the country, right? We also benefited largely from that because a lot of the more traditional open markets were closed, obviously. Right, we benefited from the fact that we were one of the very few parties that could get products to the retailer, right? So from that standpoint, I'm on Genjo's side. We don't have a lot of regulatory issues in our markets, right? Regulation really goes towards the manufacturers of this product, right? And maybe some regulatory issues on how the vehicles that carry products and what permits they have to do all of that, but nothing significant that would impact the business negatively.
All right. So since regulation doesn't seem to be a problem, I think competition might be a problem for some of the companies. And for for Kobo 360 and Lorry, You guys are like the major, digital logistics companies in your space, and I won't ask about competition between you guys. Well, what I'll ask is, competition with other players, the traditional logistics companies that were there before you guys came into the market, right? So how often do you experience pushback from them? And what are your plans to expand your customer base and gain more market share as you continue to grow? Okay, so I think I will go with Leo first before getting to.
Excellent. So, like I mentioned earlier, it's an open sea, right? It's so huge. The vista to the chances of bumping into each other in a competitive manner barely doesn't exist between us and Kobo 360. I believe that we have more areas to collaborate and compete, because the more we move the market from traditional to this tech-driven environment, the more our businesses grow, the more the industry is easier to regulate. You talked about regulation, and the more it's easier for the partners that are really critical to our growth to connect with the entire value chain, financing partners, whether it's asset financing partners, whether it's working capital financing partners, whether it is even consultants in the area of our journey management and all of these things. The more we move the entire industry into this space, the better for everybody. Talking about the reception that we got, it was interesting. When I joined in 2019, I had been on the client side most of my life, working at Nestle, Kimberly-Clark, and so on. And so I knew the problem that the typical supply chain manager was facing, and I approached the issues from that standpoint. But the traditional transporters and truck owners saw us as competition. It looked like a perfect marriage that you own assets. I have no intention to own assets. I want to provide you working capital and provide you on journey management, take away the hassle of finding cargo from you, take away the hassle of finding funding to move those cargo from you, and essentially midwife, be your back office, essentially, right? We thought that it was a very easy value proposition, and they would quickly say, but that wasn't the case. There was always that pseudo analysis. What if you decide to buy trucks tomorrow and you kick me out of this space? And we're saying the day we do that is the day our business plan collapses, because that's not the problem in this space. We're coming to solve a problem. However, having over the few years we're here, validated that thesis over and over with them, we are seeing more collaboration between us and some of those players who at the beginning were quite resistant to us. And so we foresee in the near future where people will understand that this marriage just serves everyone's benefit. So far, so good. So far, so good.
Thank you. Genjo, is he married for you too?
No, I think I am fully in agreement with Leonard. You know that both Lori and us, if you take Nigeria alone, I think we cover maybe 2% of the transport market together. So there is a lot to be done. A lot of people are still not on the platform. And I think there is more advantage to be on a platform, even if you don't if you don't trip all the time for that platform or the other one. You can also, a trucker can also have, let's say, half of his trucks on the platform and half not. But the advantage of being on the platform in both our cases is that the reverse logistic is important. When a truck goes from Lagos to Kano transporting finished goods, like from the port or from the factories in Lagos, let's say he transports noodles. He wants to come back with something. He may not have that client while the platform will have it. So there is sorghum to be transported back towards the brewers in Shagamu, for example. There is, if you manage that well, and I think that we are giving enough vision to the transporters about what is good for them to be on a platform, that we can only go together. I think that's a fair statement to say. I mean, the future is, you can only make money in two ways. You can only go in two ways. One is demographics. The other one is productivity gains. Productivity gains will come by being on the platform. Demographics will come from being on the platform because you will have more demand on the platform than you have normally.
All right. Thank you for that, Gencho and you. I think Chibundo will take over.
Okay, so really interesting. Thank you very much. I guess where people are really interested in now, especially with all the money that's going around in Africa, and I want to start with Tayo. Where are you in your fundraising journey, and what are your fundraising plans? In terms of geographies, where are you looking at? What is exciting currently? I'd like to know, where Move is going in terms of geographies.
Absolutely.
Sorry, just chip in. I mean, Tayo, it won't be bad if you guys reach Series B this year, right?
Of course. Watch the space. On a serious note, we recently closed a $23 million Series A round. So we're really thankful to our investors there for all the support they have shown us on all facets. There, I think the focus for us is one, to sort of take our past learnings, right, build on this. We're still scratching the surface in many places and cases and in many cities, right? So expand on that knowledge, right? Expand our base there, deepen the network effect with our partners and the existing our team. I think in terms of just expansion, right, geographically now, the goal is to still continue with our 11-city expansion plan alongside Uber on this journey. So we've done 4 cities now, but there's so much more that we can do in these cities and even more. I think, just from an investment standpoint, to something that's extremely key for us as we grow and scale the business, deepen our investments in technology, right? Strengthen the team, deepen our product knowledge across the board, and just make sure we have a sort of top-notch team that can help us, grow, stabilize the business, also bring value and create that desired mobility company, right? That's targeted at providing, democratizing our vehicle ownership for mobility entrepreneurs across the continent today. So that's the focus for the business.
Okay. Ignatius. So what are your plans, funding, geographies?
Okay, great. I'll take a piece of Tayo's book, right, because it's really important to consolidate on already existing markets, right? And we're in Nigeria, for example, we are already in 14 cities, right? We take a city-to-city approach to expansion. In terms of other markets outside of the markets we're currently in, we would be looking to expand into, in the near future, Anglo and Francophone West Africa, as well as Southern Africa. Those would be our focus for expansion. In terms of fundraising, I think we are all always in the market to raise funds, right? We're all in a very capital intensive business, so we need to stay in the market. Genco, I'm sure spends the most time on the road seeking investors or looking for investors and looking for the right partners, right? Because aside the funds that come in, right, having the right partners that understand the business model to drive you to the next level is really important. So we're constantly in the market. So I know that's political footage, but yeah.
Okay, Genjo, please.
All right. So, well, thank you very much. I mean, fully in agreement, right? I mean, effectively, there is a strange thing. First of all, we obviously are looking for investors because we are raising the Series B at this moment as we speak. And I mean, I think that we're talking about 40 million fresh money coming in, between 40 and 50, I should say. So, but I don't want to comment more until you see it in the press. I'll speak with Tej at the right moment about it. And I think what is important effectively is to find the right investors for us. That's very key. And in terms of the expansion plans, the improvement of the technology is always important. Adding up new products and making sure that they're technology-wise sound, like in the fintech space. If we come into, for example, if we add products to our value-added services, can they sustain being? I mean, will they be financially or technologically solid. All these kind of things have to be worked on, and there's a number of money that will go into there. Otherwise, we are also obviously capital-intensive companies, which means that the money that you get from investors should be used as a war chest to negotiate with the banks and get the cheapest financing possibilities you can find, right? And access eventually public markets like capital markets, commercial papers, or bonds, if you have a rating and are able to access those funds. So I think that the financial markets in Nigeria are ready for innovation, but also are quite good because there is a growing pension fund universe in Nigeria that is demanding for investment, for new investment outside of government bonds and the equity market. So I think that we are in a good space, and the rest of Africa also expanding in. So what we want to expand obviously is penetrate better value-added services in the countries where we are already, and then going into new countries in Africa, for example, Benin, Egypt, eventually, why not? Yeah.
Understood. Leo.
Yeah. Okay. So one of the things Lori takes pride in is in our technology itself as a product, right? So one of our growth strategies is expansion, geographical expansion, but via technology. So you may have read about our licensing deal with Imperial Logistics, the largest logistics business in Africa, which effectively gives us a footprint in 7 countries in Southern Africa. Outside of these, our core areas of focus still remains East and West Africa, where like similar strategy to Genju, we want to deepen our presence in this market. The market is just so huge, so massive, and what we're doing is working. So yeah, so talking about investment opportunities financing, when you look at our growth trajectory, like I mentioned earlier, as an investor, you'll be interested. So are we getting interest from parties that we feel are viable investors? Answer to that is a yes. But we also have internal milestones that we want to reach before we get too active in the space, so that we don't, we are able to really get to a point where we understand fully that we can sustain what we have achieved. So those internal milestones are also at the back of our heads, while we are not averse to new money coming into our business anytime soon.
All right, let me chip in one thing or ask one question. I mean, since everyone is in the business of kind of giving some form of financing to their drivers, or partners or stakeholders, right? I just want to know if anybody has any plans for raising debt financing, because I know in Kobo raised something like that in the previous round. I don't know if there are plans to raise more debt finance to operate here. For anybody, just if you have any that's in your plans.
Yes, I mean, essentially, like I think Genjo mentioned something like that while talking. So we're using domestic debt financing for funding these operations on behalf of these transporters. Essentially, what you want to do is use your equity as a hedge for accessing cheaper rates domestically, and then so that you are spared exchange rate risks along with the risk associated with financing in general. So yes, banks have been good facilitators of the process. A number of banks are open to innovative ways to work. We're happy. At least Nigerian banks have been good supporters of the process. And I think the numbers also have aided that project, made them believers. During COVID, we hit a small hiccup. We dropped volumes not because goods were not available to be moved, but because financing, the financiers, banks particularly, hunkered down along with the rest of the business, and that affected us. But I think for now, the business model is proven enough for them, particularly in Nigeria, and we're enjoying relatively good support. So if there are any bankers here who want more of that kind of support, to help on growth. Yeah.
Okay.
All right. I think you will do take over now.
Okay. So it's really interesting, and I think we're all excited because, as Genjo said, as Leo said, you're still a very small part of the market, so there's so much potential in Tayo and Ignatius too. There's so much potential with your businesses, and we do want to watch and see as your companies grow. We at RenCap are very, very grateful for your presence. We are very appreciative of you coming in, and we found you very interesting, and we are looking forward to further conversations down the line. I want to leave Tej to say just one last comment before I wrap it up. This is a very interesting panel.
Yeah, I mean, I think in the beginning I said it's been interesting to see how these companies have evolved over time. I think some of them, got founded before I started reporting in tech, and even now, I mean, everyone is still acting strong in quotes, and there's still room to grow for each and every company. So I just hope regulation doesn't catch up with anybody, right? And your businesses work strong. Yeah, I think that's all I would say.
Okay, we'd like to thank you all. We are very grateful. Thank you, Ignatius. Thank you, Taya. Thank you, Leo, and thank you, Genjo. Tej, thank you so much for being on the call. And we'll wrap it up there. Thank you.
All right.
Thank you very much, everyone. It was
Thanks, everyone. Have a good one.
Thank you. Bye-bye.
Bye-bye.
Knowledge is information, but not all information turns into knowledge. Today, every company leaves digital footprints in hundreds of different sources. But this information by itself does not tell you who it is you're looking at and what the risks of doing business with them are. Businesses can't exist in a vacuum. They need employees, customers, partners, contractors, investors. Good counteragents help a company succeed, create products, make profit, expand business opportunities. But what about bad ones? 49% of organizations around the world say that they've been victims of fraud or economic crime. 2/3 of Russian companies say they've encountered economic crime in the past 2 years. This is significantly higher than the global average. Every year, 15% of companies simply disappear, whether on their own initiative or because they're forced to do so by tax bodies, often leaving unpaid debts. If you want to minimize your risk, You need to find and analyze every scrap of information you can, identifying, analyzing, collecting facts. Processing big data is impossible without qualified specialists, experience, time, expensive equipment, new technology, machine learning, graphs. Spark Interfax gathers information from all available sources and converts it into knowledge, allowing you to see the world of business in its entirety with all its risks and opportunities. And there's no doubt that tomorrow we'll be able to understand the world of business even better, thanks to the emerging digital economy, cutting-edge technology, and the availability of new information about the lives of companies. Knowledge decreases risks and creates trust, the foundation of any successful business. Knowledge is information, but not all information turns into knowledge. Today, every company leaves digital footprints in hundreds of different sources. But this information by itself does not tell you who it is you're looking at and what the risks of doing business with them are. Businesses can't exist in a vacuum. They need employees, customers, partners, contractors, investors. Good counteragents help a company succeed, create products, make profit, expand business opportunities. But what about bad ones? 49% of organizations around the world say that they've been victims of fraud or economic crime. 2/3 of Russian companies say they've encountered economic crime in the past 2 years. This is significantly higher than the global average. Every year, 15% of companies simply disappear, whether on their own initiative or because they're forced to do so by tax bodies, often leaving unpaid debts. If you want to minimize your risk, you need to find and analyze every scrap of information you can, identifying, analyzing, collecting facts. Processing big data is impossible without qualified specialists, experience, time, expensive equipment, new technology, machine learning, graphs. Spark Interfax gathers information from all available sources and converts it into knowledge, allowing you to see the world of business in its entirety with all its risks and opportunities. And there's no doubt that tomorrow we'll be able to understand the world of business even better, thanks to the emerging digital economy, cutting-edge technology, and the availability of new information about the lives of companies. Knowledge decreases risks and creates trust, the foundation of any successful business.
Good afternoon, ladies and gentlemen. Thank you for joining us today. My name is Abi Adshafe, and I'm a member of the Renaissance Capital sales team, and I have the pleasure of hosting this afternoon's panel on digital lenders and neobanks. Co-hosting with me this afternoon is Taj Kene-Okafor, the Africa reporter from TechCrunch, an international online publication dedicated to technology, venture capital funding, and startups. Our esteemed panelists include Tolokbe Omoleya Oshindero. She's the head of legal and compliance at Branch. Branch International is a leading finance app that provides loans, investment, credit scoring, and transfer services to its customers. Branch has over 6 million customers in Nigeria, Kenya, Tanzania, and India, and to date has provided over 20 million loans to its customers across its operating markets. Lauren Heine is the CEO of Fair Money, an online bank focused on servicing frontier and emerging markets. And Chijoke Doze is the co-founder of Carbon, an online bank with operations in Nigeria, Ghana, and Kenya. Thank you for joining us.
And thanks for that, Abi. So I'm Tej Kene-Okafor, a reporter for TechCrunch. We know all the companies here are lending companies and online banks. But what I would like to know is the evolution of your businesses from when you started it and what it is now. So if each and every one of you, Lauren, Chijoke, and to take us through, walk us through the evolution of your business, what you had in mind when you started the company and what it is today. I think I'll start with Chijoke.
Thanks, Tej. So I think with Carbon, we've had many names before. So we started off as a lender, a consumer lender, and we were actually offline. At the time, we were called One Credit. And in a couple of years, we decided that we couldn't hit the customers we wanted to offline because it required so much in terms of physical infrastructure. And it was almost, you're trying to beat the banks at their own game using their own playbook, and you haven't got the resources. So that's why we pivoted to a digital platform, and that was called PayLater. And that was the, lending instantly via smartphone app. And we did that for a couple more years. And again, I think we always wanted to be a bank, but we realized that, telling customers that here's another bank that's asking for deposits, you're not really going to stand out. So we decided to give them what they wanted. And in Nigeria, and I think in lots of sub-Saharan African markets, credit is still the product that is still lacking. The retail banks don't provide it, as of when. And I think that was our wedge. So we were able to add other additional services, payments, bill payments, transfers, etc., saving products as well. And now we've got the whole sort of full suite of banking, our own debit card. So that was really the evolution. Digital lending, credit as the wedge, and then offering customers a sort of value for money current account.
Okay, thank you for that. Tolu, how about Branch?
Yes, so I would say that I'm not one of the co-founders. I'm just the head of legal, but I will tell our story. Us starting from a purely mobile loans company. So, for example, in Nigeria, we started in 2017, and essentially the problem was to help, the underserved or the unbanked or a particular segment of the market of the economy get access to credit, and that was the problem that we wanted to solve. So again, if you think about traditional banks and how they generally related with individuals in terms of getting access to credits. When you think about the complicated documentation process, think about requests for collateral, difficulty or the way with which they carry out credit assessments or credit assessments for individuals, and questions like you getting your ID comes up, them being able to verify your house address, or when you being able to ascertain that you have some sufficient credit history, those sort of things determine whether they're able to keep credit or not. And with what's the right way to describe it now? Over the years, that has been something that makes it difficult for banks to lend to individuals. So that was the problem that we were looking to solve. Our founders were looking to solve, and they set out to solve, using two methodologies. One was trying to solve this in a way where you get access to credit in a quick and convenient manner using your smartphone data. and not going through the traditional credit underwriting model that banks have had to go through. Second is building a relationship with the borrower such that you're able to create a, through our loan ladder system, where you're able to, at the end of the day, build a credit history for the customer. So, for example, with our customers, when you get on the branch app, you're offered a particular loan amount, and then when you take, you're offered that loan amount, usually very small, and when you repay that, you're offered an higher amount. So essentially, you climb up the loan ladder. The more we give you the more we give you loans, the more you repay on time. The more the confidence we have that you are eligible for an higher amount, and that way you sort of build a credit history with us, and that gives us confidence to lend to you more. And with that, we also cut out some of the traditional credit assessment requirements that banks require. Complicated. I mean, I wouldn't say like zero paperwork, but complicated paperwork, requests for collateral and stuff like that. I essentially sort of cut out in our own credit assessments, and so that's one way that we've sort of addressed the problem of access to credit. So we started as a purely mobile loans company, but now we've sort of evolved towards a multi-product financial company. So in addition to those, again, thinking about the fact that if you haven't got access to credit, if you can't get credit from the bank, you're probably not able to get other financial services from the bank. They're probably not likely to be able to want to sit with you, offer you an investment plan that helps you maximize your wealth. So with that, and with the information that we have about you, having offered you loans for one or two times, we're able to sort of help you in terms of managing your wealth. So with that, we sort of moved from just providing loans alone to offering investment products, helping you, giving you access to pay your bills, or to pay your bills of what's it called, to transfer funds I think transfers are still free, transfer funds without cost or without charges that you would have had to pay, with the traditional bank. So we moved from just mobile loans company to a multi-product financial services company. And I see that in the next months, years, there might be additional products that we would add to our offerings.
All right, thank you. Laurie, please, if you can add to that.
Sure, yeah. Hey guys, so my name is Lana Hani. I'm the CEO co-founder of a company called Fairmoney. And at Fairmoney, really the vision is to build a financial home for clients in emerging markets. We started the firm in 2017, and we really built basically on two hypotheses. I mean, the first one was that if you want to start a bank in a country like Nigeria, you really need to start with the largest customer pain point, and as my colleagues have already alluded to, that was and is still today the credit market. I think the Nigerian consumer was and is still today largely underserved on both the consumer and then on the MSME side. And the second piece was that if you want to build a mobile bank in a market like Nigeria, you really can't just copy sort of the the approaches of other companies like Revolut or Chime or Nubank or Tinkoff Bank in Russia, but you really need to understand sort of the local context and the local consumer and also the local funding requirement. And back then in 2017 there was not a lot of funding available, and so we need to start with a product that actually allows us to build a profitable company from the get-go. And I think that is something that has paid off for both for us and the consumer over time. So 2017 started with lending product and then evolved over time to a full-fledged financial service provider. So today we offer credit products to the user, we offer current account product to the user, payments product to the user, and in terms of sort of number of active accounts, I'd say we are probably the largest digital financial service provider in the country today. Roughly 1.5 million bank account users, dispersed around 100 billion naira in the economy over the last 3 years, and I think that's something that me and the team are very proud of. Financing side just raised a pretty large round with Tiger Global last month, and all of that is going to help us serving the Nigerian consumer better, evolve the product. As I mentioned, we're in the lending space. We are offering payments to the customer. Just offered our first debit card to user, and we really also understood that problem is not a Nigeria-specific problem. That's actually a global problem. That the sort of commercial banks are not doing the job as they should, not serving the user as they should. And that's why 2020 we also started a new operation in India, where we're basically essentially replicating what we've done in Nigeria. So starting with a credit-led model, solving the largest customer pain point, and then sort of building our financial value proposition around the user, with a final goal of, in the end, replacing hopefully replacing actually the leading commercial banks in the country with a full-fledged mobile value proposition.
All right, I think Abi wants to ask a question.
Yeah, I'd like to address my first question to Tolokwe. How big do you think the total addressable market is in Nigeria for digital loans, particularly because some of your clientele will already be banked customers? And it's a bit of a two-pronged question, because then immediately following that, I'd like to ask you, could you discuss some of the headwinds that you faced as you expanded out of your home market?
Okay. So when I think about total addressable market for digital loans, I think about it from perspective of, again, for us, we don't provide like offline services, or our services are online. So I think about it in terms of the number of people that have mobile phones in Nigeria. When you think about the mobile phone penetration, I think there was a report that came about 65 million adults in Nigeria have access to mobile phones. So that gives me a sense of what the total addressable market could be lower than that. When you think about the fact that not everyone in that number is going to need a loan from us, or probably prepared to get a loan from the person. When I think about the total addressable market, I think about that.
Tolu, I'm not sure if it's just me, but you're very muffled at the moment.
Oh, is it better now?
Much better now, thank you.
So okay, I'll take. Oh, okay, I'll take it again. So I was saying that when I think about total addressable market for digital loans, I think about the numbers of mobile phone penetration in Nigeria. So think about the number of adults in Nigeria that actually have access to mobile phones and are able to, apply for a loan. So I think I look at that figure. So I think there's some study that claims that about 65 million adults in Nigeria have access to mobile phones. Again, you might have to discount for the fact that some people have more than 2 phones. There are also individuals that, even though they have access to mobile phones, probably not interested in taking loans from us, even because of the size or whatever it is, and would rather take them from a traditional commercial bank. So that's the way that I would think about this market. So that also covers for whether, your question was around thinking about whether our customers are already banked customers and all of that. I think when I think about the total addressable market or who our potential customers could be, so the fact that you already have a bank account doesn't actually mean that you're being served by the current banks. Also, you could have a bank account and not be able to walk into the bank to apply for the loan. You might be able to walk into the bank to apply and not, get a loan because the requirements are not what's suitable for you, because they require that show different things. What's it called? They might require that you provide the collateral, even if your collateral is not required. There might be certain things that the bank would want to see that you're not able to provide. So take, for example, a trader in the markets that deals exclusively, not exclusively, but mostly in cash. Has good trading history, but because the cash is not routed through the bank, if you walk into the bank and you're trying to get a loan, it's difficult for the bank to properly assess you, and to give you the loan that you're looking for. Even though you have a bank account, you still don't get access to the credit that you require for yourself or for your business. So that's a potential customer for us, even though he's banked. So that's the way that I would think about your question. In terms of the challenge that we faced, so again, for most of our borrowers, one of the things that we ask you for before you're, in terms of your onboarding or KYC for a borrower will be your bank registration number, which already assumes that you have a bank account, but then also just, it's just an indication that you have a bank account. Doesn't mean that you've gotten the financial services that you require from the banks that you've registered with. So that's that. In terms of your question around what the challenges that we faced, expanding into other countries, I would say that, one thing that that's not a challenge. One thing that we have identified, and I think the potential for credit for the markets, in the countries that we have, or the countries that we're in, and the countries that we've sort of studied. So there's a huge potential for credit. So if looking at the countries that we're in, we're Nigeria, India, Kenya, Tanzania currently, and totally understand that people want access to credit. They want it in a way that's easy for them to get, and that's also convenient for them to be able to repay. So that's something that we have identified in the markets that we're in. In terms of challenges, I would say that one major challenge that we have faced in terms of dealing with regulators, or just even in terms of regulators trying to understand and regulate the market. So that's one thing that is obviously common in Nigeria. So even in India, we have, so we already started in India, we already started as a non-banking financial company in India. And, even though that's not like a full-fledged, bank type institution, sometimes the regulations that don't particularly fit the type of model that we're running, and then you have to comply. Same thing, I think in Kenya, if last year or 2 years ago, there was some regulations that prevented us and other digital lenders from accessing database of credit information, which is useful for our own credit assessment. And you have to go through the whole process of trying to engage the regulators, explain to them that this is what's needed, this is what we're trying to do. We're not saying we don't want to be regulated, but we want regulations that speak, that sort of what's the right word now, recognizes the type of model that we're running and not something that is best suited for the traditional or existing financial institutions. So there's that. Another challenge that I would say is also sometimes in terms of manpower and talent. So again, I think this is something that might, I don't think it's common to us, I think it's also common to, other tech companies, as well. So one other challenge is just in terms of talent and just identifying certain specific, what's it called, talented people that are able to do the work or able to, deliver the sort of standards that we want. I think those are the things that I realized.
Thank you.
All right. So my question would be to Lauren. I think you made a point when introducing money, and I think it's a point that Branch and Carbon can relate to. Not copying the models in the US or other global markets and bringing it to Nigeria. Coming with a credit-led approach. First. But what I want to know is if there are, there are like global neobanks, right? So I would want to know from FedMoney's perspective is if there are global neobanks you are kind of trying to adopt, maybe if they have a playbook you're trying to adopt their approaches, and how is it going for you? Do you have what's it called? Yeah, a global playbook that you're looking at to adopt into Nigeria and India, for instance?
Yeah, sure. Thanks, Ed. So I think, let me get started by just saying I think we all know that there is no playbook for Nigeria. It's too much of a complex market. But when we did start the company, me and my co-founders and today the management team, we do look for global comparisons. And actually, the way we look at it, we don't necessarily only think about it from a other neobank perspective, but we look at which kind of financial institutions did revolutionize the way we bank today in other geographies. And there are 3 to 4 companies that we are looking at that we thought have really executed the model really well and thoughtful and have sort of really changed the clients' lives in these countries. So one of them is definitely a Nubank in Brazil. Now the 4th largest commercial bank in the country after 8 years of operations. I think they have 40 million customers. Incredible product. A similar company I would say is Tinkoff Bank in Russia. A very similar model, credit-led approach. Started with a credit card, and then sort of moved towards other lending models. Moved into SME lending, moved into asset-backed financing. Then started to offer the clients, a deposit solution, and is now, I think, with 6 million clients, also one of the larger banks in the country. And then, not to forget, is of course Capital One in the US, another company that has approached the problem that we are trying to solve in a similar way. I guess what all of those companies have in common, what I've just said, is that the models are comparable. So you do start with a consumer focusing or MSME focusing credit product. Use that as a first product for the customer, get them on the platform, and then build this ecosystem around the user. Build the trust that at one point also the salary account will move to you. At one point, the first sort of instinct I always tell my team what we want to do is we don't want to build a product. We actually want to build an instinct for the user that as soon as there is any kind of financial services need, you're going to our product. That's the idea. And I think that's what these models have executed really well. And that's what we are also trying to execute really well. And I think there's 3 to 4 things that
we use as really as comparisons where we think that the execution has worked. First of all, I think from a way that these companies are run, from a way that we are trying to run the companies in a very data-driven approach. If you ever hear someone from Tinkoff Bank or Nubank speak, you'd hear that most of their credit decisions, and actually really most of their product decisions, are driven with an MPV approach, right? So you're looking at sort of the unit economics that a certain product drives for you, and then make decisions. And I think that is something that we like, that we do internally. And for me, as a founder, that's very important, because I believe that's the way how you can build a sustainable company. So very data-driven approach, very unit economics-driven approach. Then of course, and I'd say that that's a no-brainer, extremely customer-focused product approach. So we're not building a product for us, we're building a product for the user, and it's the user in the end that needs to drive the roadmap. And I think that's the reason why sort of a product like Nubank within 8 years built the five largest commercial bank in the country, because they have solved the problem for the user. And I think we try to approach the same. And then, I can't emphasize it enough, what's necessary is capital. If you look at these companies, the amount of money they have raised, that's the reason why they needed that, because you need to really invest in talent. You need to really invest in the product, and that costs money. And, I think sort of with our latest raises, we've sort of shown that in Nigeria, the companies have the capacity to raise significant amount of money. The capacity to attract investors like Tiger Global, and not only on the really equity side, but we are all lenders. So, we are now financing our book in Nigeria, for example, exclusively with Naira. So we have a capital markets operation in the country that helps us to, finance our book. And so the capital aspect is a very important one, and we are really focused on that. And then lastly, I think the one point that drives everything is talent, right? Tolu has mentioned that, whatever these verticals are, in the end, you need someone that gives the right impulses. You need someone that knows how to execute in a specific vertical. And I think Nubank, Tinkoff, and also Capital One have done that really well, hiring, recruiting everywhere in the world, where you already have seen these models, and where you maybe then don't need to reinvent the wheel. And we think really similar around this, right? If you look at the company today, we are around 250 employees, growing roughly 30 to 40 employees a month. And if you look at where we are growing, we have employees today in 13 countries, right? So, I think we are loving the ideas, and we have a value in the company. It's called talent has no passport. We're really in love with the ideas to sort of merge, different intellectual capacities from different countries on one specific problem, which is how to build the best, financial service provider in Nigeria. And I think that what makes us as a company different, our product different. And in the end, that is for me the one single key to succeed. The other ones are catalysts, but the real unlocking factor to replicate these successes for me is talent, and talent only. And I think there we have shown in the past and will in the future that we're able to attract the best people in the world. Yeah.
Yeah, thank you for that, Laurie. Yeah, Abby.
If I could direct my next question to Chijoke. As you think about developing your new banking proposition, how do you go about building trust with your customers and developing a top of wallet strategy with them? And what kind of hooks are you finding that really work and are sustainable and attractive beyond just lending?
Thanks. I think so. For one of the things that we did to sort of engender trust in our customers, a couple of things is transparency. So, I think Carbon was the first to give free credit reports to all its customers. So, you can download our app, and even if you're not a customer, you can just, view your credit report. And that was because, we wanted to show customers that not only, are we lending to them and making money from them, but we're helping them build a positive credit report that they can go to their banks and get, a cheaper loan, maybe, if the banks were willing to lend to them. And that's us saying, like, we want to make sure that you're better off financially, and that you're creating this positive track record that would make it easier for you to access capital, loans, from any financial institution. So that's one. I think also publishing our accounts was also one of the things we did to show people that, look, we want to be the custodians of your money. And whatever fintech companies can say about banks, people trust banks. And so we want to, and I think fintech, the average person, woman on the streets is seeing like, all the money's been raised by fintech companies, and it looks a lot like young men, which unfortunately fintech companies are heavily skewed towards men. And it's okay, what do they do with the money? How do they make money? So we wanted to make sure everyone, okay, this is how we're making money. This is how we're spending the money. Like banks are very transparent as well. They publish their accounts, quarterly or half-yearly basis. And I think, because our vision is to be the dominant Pan-African digital bank for Africans in the diaspora. And I think that to do that, we need to make sure that people actually trust us. It's not only just because we're cheaper, because then that is temporary. I think what's important is that we build trust where people feel like I trust these people, not only with my transaction money, but actually maybe my salary or even my savings. And I think it's not going to be overnight. I think that's actually probably the biggest barrier to fintech to really going mainstream is the trust issue. And I think especially when you don't have many branches, our strategy is not to have branches. So compared to, let's say, Citibank or First Bank of Nigeria, UBA, where you see branches everywhere, that, okay, my money is there. If you're somewhere, I don't know, even in Lagos, if you're in Sule area and Carbon's in VI, where are they? I don't know if my money is safe, especially if there's downtime in sort of payment infrastructure. So I think it's that's what we're doing to engender trust. Look, in terms of share of wallet, I think that like Lauren was talking about, data-driven decisions to make products. I think that there's also a danger of just stuffing customers with so many products. We know the playbook. It's going to be maybe crypto, if that's a polite word. Or it can't even say FX anymore because we can't even touch that. But actually, yeah. So when you think about the playbook for neobanks around the world, it's crypto, wealth tech, it's FX, it's remittances, all these things that we can't do.
Yeah.
Exactly. So, but I think someone once told me that you can do it very well by making sure that you do the ordinary things extraordinarily well. And when you look at the angst from customers, certainly in Nigeria, things like, imagine if you built a product where you get instant transfers, instant refunds on failed transactions. I mean, we do that at Carbon. It's not perfect, but it's something we're working on where, we don't want to trap people's money. So it's those little basic things that I think, in addition to exciting new products that people actually want and that improves their lives. But I think that sometimes it gets forgotten. What gets forgotten is the basics. So it's about, okay, what new shiny product do you have to get customers? And one of the things that we've done over the past is I'm more relaxed than I was, let's say, 4 or 5 years ago, where other companies announce these massive products, and we've done massive products and they haven't worked as well. And we're like, yeah, okay, we have the same customers, we know their price points. So I think for us, it's while we will, we are bringing out new products. I think some of the doing the ordinary things extraordinarily well, and we still have a lot of room to improve customer service. Failed transactions. Doing those things well, I think will definitely increase our share of customer wallet.
Awesome. So no unnecessary reinventing of the wheel then. Just focusing on what works. Okay, great. Thank you.
All right. So this question is to all the speakers. So what license do you operate with in Nigeria? I mean, I won't say it's obvious, but I'd like to hear from you. And also, given the recent announcement by the CBN and also microfinance licensing and whatnot, so do you operate with those licenses, or are there other additional licenses you have that people don't know about? Okay, sorry, I'll go with Chijioke. I mean, since we just finished up with you. Yeah.
Me or Lauren?
Okay. No, go ahead, please.
I think my network was bad there. Yeah, I meant Chijioke. Yeah.
Okay. Yeah, we have a microfinance bank license.
Sorry?
Yep, we have a microfinance bank license.
Okay. I mean, do you think you should have? Do you think a different license should be created for, lending companies or digital banks in Nigeria?
Look, I definitely think that innovation always outstrips regulation. So it's going to be catching up to do. Maybe more clarity on the licensing, because a lot of people say they're regulated and they have different licenses, but then I think they downplay the actual differences, because give an example, a money lending license and a license from CBN has different restrictions and different responsibilities. And yes, they might be regulated, quote unquote, but one, there's a different time. It takes a different time to get those licenses, and the scrutiny is a lot more in some of these licenses. So I think I think it's important to protect customers, because I think that there's a lot of abuse in the digital lending space. I'm glad to say, none of my fellow co-panelists are part of that, but there's a lot of, digital lenders using customers' data recklessly and in a way that it really doesn't help the industry at all.
Okay. Rory, do you have anything to add to that?
Yeah, I mean, so look, I want to agree with Chijioke here. I think so. First, to answer the question, we're also operating on a microfinance banking license. And generally, my view on on licensing is, and I think we've been able to educate us a bit in that way, because we're operating now in multiple countries. And so we have, for example, the difference between Nigeria and India. I'd say India is probably in most of the ways when you look at infrastructure, but also payment infrastructure, customer education, but also when you look at how the licensing, is actually organized a bit more advanced than Nigeria. And I think overall, in the company, we really appreciate a clear licensing system. We actually, even though, it's some of these licenses, especially from CBN, are not easy to get. It takes time and can be extremely frustrating. But, it also does something to the market, which is really important, which is what Chijioke just alluded to. It's enforcing enforcing good practices, and it's also keeping bad players out. So, sort of contrary to maybe the overall opinion, me personally, I guess generally, well-funded, serious, and sophisticated fintechs actually are usually pro-licensing, having a very strong central bank that sort of sets a clear rulebook out on how you can play and how you cannot play. Because I think in the end, we all have the same interest, right? We want to develop a market that, that is not only there for the next 6 months, but really for the next 100 years, right? Internally, we always talk about building a 100-year company, being there around in 100 years. And to be there in 100 years, what you need is a clear regulatory playbook, right? That's one of the most important fundamentals, so that there's no anxiety from the regulators' end on what companies are doing, and then there's also no anxiety from the companies' end on what which is the right license. So overall, I think from our end, from families' end, and I again agree with Chijioke here, we do appreciate a very clear, well-designed, well-thought-through licensing process, and if that is then a separate licensing, for digital banks particularly, why not? I think actually that's a good idea. I also, however, think that the current microfinance banking license scheme is a proper license, right? It is pretty stringent. It enforces strict compliance, and it makes sure that customers' deposits are safe. And I think that's the most important for us as a company, and that sort of the clients are protected. Yeah, that's my thoughts.
All right. Tulu, would you like to add to that?
Yeah, so I mean, apart from saying that, consider that we have a finance company license that is issued by the CBN. Totally agree with Chichoke and Lauren in terms of making sure that to an extent there's clarity and there's certainty from the regulators that what regulators apply to a predominant potential business and businesses like ours that are traditional, that are to an largely very digital. The models are different. We don't access customers, onboard customers in the same way traditional banks do. We look at view things different from traditional banks. So sometimes I see, I see I don't want to say a misfit, but it's just not fit for purpose. Some of the obligations or requirements that we're required to comply with because we're regulated by the CBN. You think about these things like this is clearly suited to existing traditional financial institutions, and then you have to find a way to comply because you're regulated by the CBN. So again, I think I speak for quite a lot of people when I say when we say that I'm pro-regulation to an large degree. It's useful to have regulation. Again, we're talking finances, we're talking about people's money, people's investments, loans, or whatever it is. So to a large extent, I'm pro-regulation, but it should be clear, it should be fit for the model. So I know that it's a lot of work for the regulators themselves. To an extent, they're always going to try and catch up, but it would be great if they're able to catch up faster and able to come up with or look at the existing regulations and see where amendments can be made, exceptions can be made for very, very, very digital model businesses. Yeah, that would be my question.
Right.
I'd like to ask another question, and I'd like to pose it to all of you. I mean, given your business models, we cannot, ignore the importance of asset quality. Starting with you, Lauren, could you please just tell us, what segments of the market you focus on, what kind of NPLs are you operating on, and how do you address recovery issues? And is that something that fintech should be paying a lot more attention to in this day and age?
I mean, sure, yeah, happy to take that one. So, I think first of all, on the asset quality side, and you already alluded to that's something that is very important for us as a lender. Well, maybe let me actually start with sort of the customer segmentation. So how we are thinking about the customer segmentation differs a bit from what Sule has thought. So we, very broadly, we are dividing the market into 3 different segments. So you have unbanked, underbanked, and then fully banked customers. And then in each of those subcategories, you then have different credit facilities. So you would have more short tenor, relatively high APR loans, unsecured, and then you have anything that is sort of in the mid tenor range from, let's say, 6 to 18 months, and then anything that's larger and potentially secured, right? And that you have in the underbanked segment, in the bank segment. And traditionally, when we started, see there's a curve. We've moved very on the left from underbanked, unsecured, and then moved towards the banked users. So that was a bit our journey, relatively low, short tenor and relatively high APR. And over time, over the last 4 years, we've actually really managed to move our book, towards a relatively large average ticket size, and then also relatively low APR, right? Actually, if you look at it, in some of our facilities are now competing directly with the commercial banking sector, right? So for some of our facilities, you could actually get the same price that you get on a GT Bank loan facility at fair money. So that's how we've evolved the book. So then you asked about sort of asset quality level. I think it's actually public. We would be targeting on a book level, sort of NPLs of around 10%, which we think is good in the market. It is, in my view, unfortunately still too high, right? But there's only so much that you can actually do as a lender with underwriting. I actually think that from an underwriting perspective, we've done a very good job over the last couple of years, and you actually have like sort of technical indicators for that. In underwriting, you would call it area under the curve. In Nigeria, models perform very well, but there's also underlying infrastructure problems, right? So, if I compare Nigeria with India, the hit rate of a credit bureau in Nigeria is roughly 50%, whereas in India it's 98%, right? So sort of 50% of the customers that apply have a credit bureau file, whereas in India, 98% of the customers that apply have a credit bureau file. and that that is a bit that at one point gets a blocker on the underlying asset quality. And I think when we talk about regulation, actually, yeah, you need to talk about how to regulate the fintechs, but you also need to talk about how to regulate those that actually supposed to build infrastructure. And then you also need to think about how do you how do you enforce good behavior even from unregulated fintechs so that they are not driving up the NPL costs for the entire industry. I think that is something in Nigeria where we unfortunately not yet there. And sort of, from a regulatory perspective, I think for the best thing in my view that the regulator today can do is just improve the credit bureau system. All of the other symptoms in the lending industry, such as relatively high pricing in Nigeria compared to other markets, those things will get solved over time. A sophisticated player get larger and larger, but even a sophisticated player cannot solve, for non-regulated lenders that don't report for the credit bureau. So I think that's one of the perspectives how I look at the problem. From a recovery point of view, I think one thing I'd like to highlight actually in Nigeria itself, what we're looking at is what we call the natural default rate. So imagine you give 100 loans, how many do get back without any collection or any underwriting? And contrary to public, like I'd say, widespread public opinion, even within Nigeria, in Nigeria, that number is really good. It's outperforming most emerging markets where we either are operating in or looked at. And so the Nigerian consumer generally doesn't like to have outstanding debt and not pay it, right? I think that's a very important, I always talk about that because it's a very important, I think our country has sometimes not the best reputation, right? And here it's clearly data-driven wrong. The Nigerian consumer pays much better than the average consumer in many other emerging markets, right? And yeah, on the collection side, we do regular collections. We don't do any physical collections, given that our average ticket size is still relatively small compared to the average consumer book in the in a commercial bank, for example. And I think one thing when we talk about collection, and Tate was just alluding towards that, I think very important for us, we have very, very strict customer protection principles when it is about how we collect, and also when it is about how third-party providers that work with us collect, and very strict sort of QA processes to make sure that a customer that is not paying gets treated very fairly. And then in the end we do use the credit bureau system and report people, customers that are not able to meet their obligations. But I think also there's some space, for the regulator to step in. And I think recently we've seen a first action of the NDIC against one of the unregulated players that has actually had relatively ethically bad collection practices. And yeah, maybe when we speak about what the regulator can do, I think the way that some companies, and obviously no one here on the panel, but more unregulated companies are collecting their facilities specifically in Nigeria is unfortunately not in the interest of the customer, and also clearly not in the interest of the industry. Yeah, I hope that could shed some light on our thinking and on that point.
That's great. Thank you so much. Chizoke, could I ask you to please, give us your thoughts?
So in terms of the asset, our target base, we're squarely in the underbanked space. So all our customers, at least in Nigeria, has to have a bank account, whereas in other markets, we use, because those are mobile money countries, we can actually lend and interact with customers that don't have a bank account. So in Nigeria and Ghana, it's unbanked and underbanked, whereas in Nigeria, it's squarely underbanked, because we require BVN, a bank verification number for onboarding. Look, in terms of our asset quality, our NPLs around 11%, and they're trending down. Our rates go right down to 0%, where we actually provide financing to customers up to 6 months at 0%. And then we think that there's a huge opportunity to change the way people interact with loan products. So typically our demographics about 70% men, roughly about 20 to 35 years old. 40% identify as self-employed, over 50% are graduates. So it's, these are banked customers that don't feel that they're getting enough services from their banks.
Thank you. And Tolakwa, your insights, please.
I was just going to add to what you guys said in terms of asset quality. So again, for us, in terms of our loan products, you certainly need a BDN to meet that to an extent, but looking at banked customers or banked individuals. So essentially, for us to start getting people that are banks, but are either not, that are generally not satisfied with the quality of financial services that they get it from their primary banks or get it from traditional banks. So we start, we're able to provide credit to you that you don't have obtained or gotten from the bank, or you not have gotten the timeline that you need, the loan for. In terms of our support, our NPL levels, I can say that we're still around. It's a single digit figure. Sort of, I think it's a testament to the credit assessment, our credit assessment and what's called borrower review process. At least currently for now. For recovery and collection, so we don't do physical recoveries. We work with collection agencies on a very strict, what's called SLAs, and compliance with our recovery and collection principles, where you have to respect the customer, so giving the harassment, share customers data with third parties. So you never get a message from branch or from someone who wasn't the branch claiming that someone has gotten a loan and it's your name as a guarantor, whatever it is. So we do not do that. Yeah, very strict on ensuring that even though you're a borrower, you're still protected the dignity that you deserve.
Can you come forward, please?
So look, you're a bit muffled again.
Is it better now?
Yes, that's great.
Yeah, okay. So I was saying that, even for collection, you work external collection agencies and, under very strict terms of, with them complying with our recovery and collection principles. So even as a borrower, we respect you. We deal with you as a human being and with the dignity that you still deserve, even though your loan is outstanding. So we will never harass you on the phone. We would never send messages to your contact saying that you've gotten a loan from branch and the loan is outstanding, stuff like that. So we certainly do not do that. And I would say that, so we don't do physical recoveries as well. So again, all of this would be, you be contacted with the number that you have provided to us, and that's the limit in terms of how we try to recover our loans.
Actually,
Thank you very much.
Yes. Abby, one thing I would, if I'm taking requests, I would say that RENCAP should ask the banks specifically on the NPLs on their consumer side. When you report it, it's always like the bank. But if you actually tease out a lot of the consumer and the digital lending, the NPLs from some of the banks, you would find that we're actually doing a lot better than them.
Thank you. No, we'll definitely ask that question.
Yeah, okay. Nabi, can I go on?
Please.
All right. Yeah, so I think one question I wanted to ask would be around your approach to digital banking, which is credit-led for branch, for carbon, and for fair money. In recent times, we've seen other new bank players, like in Nigeria and in Africa, adopting the deposit-led approach, right? And those companies are kind of morphing into trying to provide credit or overdrafts for their customers. So I see them trying to eat into your market. Do you envision yourself, taking deposits too, just as they are trying to enter credit? I don't know if that makes sense.
Sure, happy to take that. I think makes absolute sense. I think in the very beginning, I sort of alluded to our thinking when we started the company, and obviously we did look at two different approaches: start with a credit-led model and then take deposits, or start with a deposit-taking model and then at one point offering credit. I think our thinking was and still is that if you start with a credit-led model, there's basically only upside and very few downsides that I see. Obviously, there's some bias here, but let me elaborate a bit on the upsides of that model. So, for example, Nigeria, there's now one of the larger, probably the known sort of digital bank that's also raised at the same time than we did. But if you really look at the economics of what they're really trying to build, you'd realize that in terms of customers, we have a few 100,000 more customers than them, but we also have roughly 400 times more revenue, right? Just on an analyzed basis last year, right? So if you look at that, and I sort of keep on wondering just what is actually the business thesis behind these models, because even today, so if you check out any publicly listed commercial bank anywhere in the world, you would see that roughly somewhere between 65 and 95% of the revenue comes from a lending, right? So, banking is, in our view, and so I appreciate people might differ, but in our view, banking is not a subscription model, right? Banking is not a high-touch subscription model, like some of the sort of messengers. Banking has a different business model, and I feel, while we in my company, and I guess some of the other panelists here, try to innovate on the way that we distribute financial products, we don't try to innovate on the business model of the bank. I feel that's not what we want to do, right? That's not what our mission is. We believe that the reason why banks are the oldest business in the world, or one of the oldest business in the world, why they have been around for thousands of years, is that the business model works, right? I think there's absolutely no, in my view, there's no need to reinvent the business model of a bank. I think there's a lot of need in reinventing the customer centricity of how banking products are actually distributed, and then also, building the product around the user while keeping the same business model, right? And I feel, we've seen, I think in Nigeria, Jojo, you've been around for some time. I think we've all been around for some time, so we've seen models come and go. I think that will always be the case. There will always be models that come, then prove not viable, and then go again, right? And for me, that is one of those, especially on the sort of either purely payments place, or purely high touch deposit taking place without a clear business model. So I think that's sort of my 2 cents on that. Yeah.
All right. Yeah, Chijioke, I know you want to add to that.
Really? Look, I think that, investors like payments. They don't like credit because they think it's too capital intensive. So it's a great story to focus on payments, but interchange in our markets are really low, so they can't really sustain. They can't sustain a business, and I think that I haven't seen, and who am I? But I haven't seen any good examples globally of rushing into credit, trying to create a book very quickly and not get hurt. So I think it's, for us, we firmly believe in the credit-led digital banking model. We think that, while I respect payments, I think, it's not easy. I think it is probably better to go from credit to deposits and deposits to deposits and transactions to credit. So it's just going to be watch and see, and I think the proof is, the results will speak for themselves in maybe a year or two. But when I look globally, Lauren talked about Tinkoff, Nubank, Capital One. I would even add Capitec, which was a lender first, and now it's probably one of the biggest retail banks in South Africa. They're profitable. At least Tinkoff is. So is Capitec. Haven't really seen that sort of transaction-led digital bank being profitable. I think they've been sustained by their investors by multiple rounds. So, we'll see.
All right. So do you want to add to that?
I think that just, from my own personal perspective, it's a question of, are you looking to be the customer's only financial services provider? So are you looking to be just, the only entity that they look to for their financial services or financial things? So you want to be able to provide credits, you want to be able to manage the money, and that means does that mean that you be able to, accept their deposits, offer them investment or wealth management products, offer them payments products and all of that? And I think that for us as a company, I think it's a question of what our customers want or what our customers, prefer. What are we seeing? Are we getting a lot of requests for what's it called, for deposits? So currently we have an investment product and we've seen a lot of traction with that. So we launched that. We launched that earlier this year, and we've seen a lot of traction. We've seen people ordinarily would not even have had to use branch, because probably they need our loan amounts, but are interested in the investment products, and we've seen those people come on board as new customers. And I imagine that, maybe in the next couple of months or years, there might be some sort of request or some sort of, tangible, figures that would maybe warrant us moving into the space where we're able to accept deposits, or maybe just even diversify our investment products such that we're just able to maximize that for the customer. So yeah, it might be, might not be.
All right, Abby.
Yeah, before we wrap up, and just thank you for your time, I just have one question. You all mentioned something, and I couldn't help but take notice. You all mentioned talent. In light of how fast-growing and just how exciting your space is, how are you able to retain and protect your talent? And also, again, I mean, Lauren mentioned that there is no playbook in Nigeria. The market is so difficult. Chizoke, you mentioned the fact that, the things that fintech, the fintechs want to focus on, you can't in Nigeria, be it FX, be it crypto. Do you also find that a lot of the quest for, the battle for talent is coming from domestic peers or more from international peers? I'd just love to hear all your thoughts on that. And Tolokwe, if I could please start with you. I
think it's both. So just in terms of the pressure for talent, I think that it's both, so locally and internationally. So I was having a conversation with someone last week, and he was saying that one of the developers certainly has at least 3 jobs. Working for them, working for someone locally, and working for someone that's paid in dollars. And that's just the reality. So I think he had fired someone before, and then, found out that this was what's happening with this current developer. And that's just what it is. So, when you find talent that is in Nigeria, understands the market to an extent. So whether you're in Nigeria or you're in Switzerland and you're building for Africa, you would want to get that sort of person and get them on board. So the competition for talent is both locally and internationally. And I think for us, it's a question of how do we make understanding that people might be here for the long haul and they might be here for short stints, but while they're here, how do we make them feel valued? How do we make them put this, giving their best? What do we do to make sure that people are properly recharged, and how to make sure that they feel like they're part of what you're building, something that's important to them, to their career, and to to the company. So I've just seen that we have 4 minutes left. So I was going to go into like the different fancy things that we have. So we have dolphin days, we have very attractive leave and vacation and stuff like that, that we do at branch, all in a bit to just make sure that people feel that they're part of something useful while they're here. They're able to stay longer, just maybe stay more longer than they probably would have stayed somewhere else.
Okay, thank you. Chijoke?
Look, I think that we probably all do similar things. The world has changed. COVID has made remote work something that is normal. In terms of carbon, I think competition is really mostly international. I think the Nigerian talent is now it has always been, but I think now that COVID has made remote so accessible, so we face a lot of competition from global names actually, that household names, and also Canada, and the challenge is, it's not even enough to earn dollars and work in Lagos. People actually want to leave, and we can't really do anything much about that. I think that with all these, and I think this is why the likes of Paystack exiting is really helpful, because now options now become real meaningful, and I think that it's not enough to announce these wonderful raises that we're seeing, and there's lots of this, but it's, are there going to be exits where the average employee actually now makes $500,000, $700,000 in options because, their company got taken out, or IPO'd or SPAC'd, etc. So I think that's the last thing, because, you can do all these wonderful things, but at the end of the day, if somebody gets an offer to, Ireland, the situations, I know situations where people have been paid dollars in Nigeria, but they got an offer to live in Germany, they're gone, and not even, and it wasn't even as competitive as just staying in Nigeria and earning dollars, but it was Germany, they're gone. So I think that maybe with options, maybe with more companies actually exiting and showing real returns, that we cannot also add options to the mix, because we give them, but it's like it's paper unless unless you see lots of companies and lots of people making a lot of money from options, exercising options.
Understood. Thank you. And Lauren, could I ask you to have the last word, please?
Yeah, sure. So look, I mean, I think it's a great question, and as I think about it, I think, prior to COVID, when we would be hiring, we would really look for 4 things. So we'd look for a strong cultural fit, for the right skill set, obviously, for a very high degree of mission drivenness, and then also for the right location. So these are the 4 things that we'll be looking at in one or the other way in getting people on board. I think what COVID did is it just removed the location item on the one hand, but it also, on the other hand, or at the same time, sort of created a level playing field for employees, their expectations towards the company and what the company needs to deliver towards them in order for them to stay. And I think I agree with what some of what Sujoko was saying. I think overall, I think it's a great development, right, for sort of the Nigerian engineer now to get access to dollar payments and or the same perks that sort of someone in the US or in Canada has. That's great for the employer. And I think it's also great for the company because more and more companies, us included, are now actually hiring worldwide, right? So I don't see it necessarily from the perspective of, US companies or Canadian companies start to, poach our engineers. I actually see it from a different perspective, as is, we are actually now hiring in Ukraine, right? Or we actually have now 50 engineers or 50 employees in India, right? Or we're now starting to, hire data scientists in Estonia, right? So all of those things, I'm not sure we would actually have gone there as a company without COVID as the accelerator. That has some downsides. Yes, the overall sort of the level playing field is everyone has now the same expectation towards the employer, which is great for the employee. But it also has a lot of upsides for us as a company. I can't be more grateful for that development. Actually, I mean, from a talent perspective of what has happened to the company, I was looking at the statistics. Pre-COVID, we had employees in 2 countries and roughly 80 employees. Now we have 250 in 13 countries, right? And I don't know how that statistic would look like without the shift that we've seen in the last year, but I'm sure it would look different. I mean, I'm very sure it would look different, and I'm also sure it would be less beneficial to us as a company, and then in the end also to the Nigerian consumer that now gets access to products that are built sort of anywhere with a great skill set that's available worldwide. That's my thinking around the topic.
Thank you so much. I see time is fast spent and I can't ask any more questions, and I have so many more, but we're going to have another panel session at some point in time and invite you all back. That has been so insightful. And I just wish to thank you all for your time. Chijioke, Tolokwe, Lauren, and my co-moderator Taj. Thank you all so much for your time. Ladies and gentlemen, thank you for watching. Have a great evening. Thank you.
Thank you all.
Thanks for having me. Cheers.
Knowledge is information, but not all information turns into knowledge. To Today, every company leaves digital footprints in hundreds of different sources. But this information by itself does not tell you who it is you're looking at and what the risks of doing business with them are. Businesses can't exist in a vacuum. They need employees, customers, partners, contractors, investors. Good counteragents help a company succeed, create products, make profit, expand business opportunities. But what about bad ones? 49% of organizations around the world say that they've been victims of fraud or economic crime. 2/3 of Russian companies say they've encountered economic crime in the past 2 years. This is significantly higher than the global average. Every year, 15% of companies simply disappear, whether on their own initiative or because they're forced to do so by tax bodies, often leaving unpaid debts. If you want to minimize your risk, you need to find and analyze every scrap of information you can, identifying, analyzing, collecting facts. Processing big data is impossible without qualified specialists, experience, time, expensive equipment, new technology, machine learning, graphs. Spark Interfax gathers information from all available sources and converts it into knowledge, allowing you to see the world of business in its entirety with all its risks and opportunities. And there's no doubt that tomorrow we'll be able to understand the world of business even better, thanks to the emerging digital economy, cutting-edge technology, and the availability of new information about the lives of companies. Knowledge decreases risks and creates trust, the foundation of any successful business. Knowledge is information, but not all information turns into knowledge. Today, every company leaves digital footprints in hundreds of different sources. But this information by itself does not tell you who it is you're looking at and what the risks of doing business with them are. Businesses can't exist in a vacuum. They need employees, customers, partners, contractors, investors. Good counteragents help a company succeed, create products, make profit, expand business opportunities. But what about bad ones? 49% of organizations around the world say that they've been victims of fraud or economic crime. 2/3 of Russian companies say they've encountered economic crime in the past 2 years. This is significantly higher than the global average. Every year, 15% of companies simply disappear, whether on their own initiative or because they're forced to do so by tax bodies, often leaving unpaid debts. If you want to minimize your risk, you need to find and analyze every scrap of information you can, identifying, analyzing, collecting facts. Processing big data is impossible without qualified specialists, experience, time, expensive equipment, new technology, machine learning, graphs. Spark Interfax gathers information from all available sources and converts it into knowledge, allowing you to see the world of business in its entirety with all its risks and opportunities. And there's no doubt that tomorrow we'll be able to understand the world of business even better thanks to the emerging digital economy, cutting-edge technology, and the availability of new information about the lives of companies. Knowledge decreases risks and creates trust, the foundation of any successful business. Knowledge is information, but not all information turns into knowledge. Today, every company leaves digital footprints in hundreds of different sources. But this information by itself does not tell you who it is you're looking at and what the risks of doing business with them are. Businesses can't exist in a vacuum. They need employees, customers, partners, contractors, investors. Good counteragents help a company succeed, create products, make profit, expand business opportunities. But what about bad ones? 49% of organizations around the world say that they've been victims of fraud or economic crime. 2/3 of Russian companies say they've encountered economic crime in the past 2 years. This is significantly higher than the global average. Every year, 15% of companies simply disappear, whether on their own initiative or because they're forced to do so by tax bodies, often leaving unpaid debts. If you want to minimize your risk, you need to find and analyze every scrap of information you can, identifying, analyzing, collecting facts. Processing big data is impossible without qualified specialists, experience, time, expensive equipment, new technology, machine learning, graphs. Spark Interfax gathers information from all available sources and converts it into knowledge, allowing you to see the world of business in its entirety with all its risks and opportunities. And there's no doubt that tomorrow we'll be able to understand the world of business even better thanks to the emerging digital economy, cutting-edge technology, and the availability of new information about the lives of companies. Knowledge decreases risks and creates trust, the foundation of any successful business. is information. But not all information turns into knowledge. Today, every company leaves digital footprints in hundreds of different sources. But this information by itself does not tell you who it is you're looking at and what the risks of doing business with them are. Businesses can't exist in a vacuum. They need employees, customers, partners, contractors, investors. Good counteragents help a company succeed, create products, make profit, expand business opportunities. But what about bad ones? 49% of organizations around the world say that they've been victims of fraud or economic crime. 2/3 of Russian companies say they've encountered economic crime in the past 2 years. This is significantly higher than the global average. Every year, 15% of companies simply disappear, whether on their own initiative or because they're forced to do so by tax bodies, often leaving unpaid debts. If you want to minimize your risk, you need to find and analyze every scrap of information you can, identifying, analyzing, collecting facts. Processing big data is impossible without qualified specialists, experience, time, expensive equipment, new technology, machine learning, graphs. Spark Interfax gathers information from all available sources and converts it into knowledge, allowing you to see the world of business in its entirety with all its risks and opportunities. And there's no doubt that tomorrow we'll be able to understand the world of business even better, thanks to the emerging digital economy, cutting-edge technology, and the availability of new information about the lives of companies. Knowledge decreases risks and creates trust, the foundation of any successful business.
Thank you all for joining this final panel session where we'll be discussing the digital asset and wealth management part of the fintech ecosystem. Naturally, we save the best for last, and representing this industry would be 4 key panelists. We've got Odunayo Iweni, who's co-founder and CEO of PiggyVest, Razak Ahmed, co-founder and CEO, Cowrie Wise, Tosin Oshibodu, the CEO of Chaka, and Ibitunde Balogun, Group Executive Commercial Tangerine Group. Over the course of today, we've heard from various parties that are part of this ecosystem, starting from the regulators and infrastructure providers, be it the NGX or the SEC, who have shared their perspectives around markets, investor protection, and their paternalistic view of things. We've spoken to the VCs that have funded many of the entities that we have on here, as well as others that we have seen in prior sessions. We've spoken to the traditional banks from the perspective of their digital business arms, and these arms are trying to compete with the fintech entities that we have also spoken to, whilst also trying to collaborate. Outside of that, we've spoken to mobile money providers, and those mobile money providers have been one of the key parts of ensuring that the consumer understands digital and payments from a digital perspective. before this session, we spoke to lenders and neobanks, and these lenders and neobanks have also buttressed on that wave to support the ecosystem. Digital payments, last but not least, is a very key reason, and perhaps the rails for many of this. And with the digital payment industry maturing, even though it's still nascent, we've been able to have many secondary uses of that. People are able to transact in a very, very quick and swift manner, and this has supported the growth of the digital asset and wealth management businesses. So perhaps we jump straight into the session now, and I'll raise my first question with Oduayo of PiggyVest. PiggyVest is the first savings and investment app in West Africa and was launched under piggybank.ng 5 years ago. Can you talk us through the journey and evolution of your business from a commercial, as well as importantly from a regulatory perspective? I think the second part of that question would be, what does the future hold, and what new asset wealth problems will PiggyVest be looking to solve for as we move forward? Thank you.
Thank you. Hi, everyone. My name is Odoi. I'm co-founder and CEO of PiggyVest. And as was mentioned, we did launch PiggyVest 5 odd years ago. And why did we launch it? It was essentially in answer to a gap that we'd observed, like as how young people interact with the financial services ecosystem. Ideally, you hear a lot about people being excluded from the system, but there's people who we also found out were within the banking ecosystem or within the financial services ecosystem that were not being serviced by the products that were available. As of 2016, we realized that a lot of the barriers to young people beginning their financial services journey from savings or investments, right? The entry level, the barrier to entry was high, right? The minimum investment amounts, the minimum ticket sizes were beyond what entry level like young people could afford. And so we built PiggyVest, piggybank.ng as it used to be called, to be literally a piggy bank, right? Like your savings box, except one that you had on your phone. And it's evolved since then into more than savings, to alternative investments, to discretionary savings. And we've added a suite of products over the past 5 years that the platform has now expanded towards 6 core features. And how have we evolved regulatory-wise? Well, to be honest, when we started, the regulation was a bit unclear, and we've spent the past 5 years kind of trying to untangle that as well, working very closely with officials of the CBN and officials of the SEC to kind of clarify, where do asset management tech or wealth management tech companies fit in? And luckily for us, we've actually made like a lot of progress there. We've seen startups like Chaka go on to have like the first SEC license for traders like them. We've seen CarryWise get their own SEC license. We ourselves acquired an MFP license in 2018 after our seed fundraise. So slowly but surely, I'll say that companies like ours and other upcoming like fintech companies are finding their regulatory footing. And it's, like I said, I suppose events like this one and roundtables like that, bringing all stakeholders together, that allows us to kind of figure out where do we actually fit in this financial services ecosystem. As for commercial problems that we continue to solve, PiggyVest has always been very user-focused, right? When we started with one product, helping you save daily, weekly, or monthly. And every single evolution, every single step that the product has taken has been because of where the users have directed us to. So where are we going in future? Honestly, I couldn't tell you, because it will be mostly PiggyVest users who can answer that question, right? Where is the world where is like situation taking them? Where is Nigeria's economy pushing them towards? What kind of problems do they need products like ours to solve? That's where we'll go.
Thank you very much for that, and very clear and concise. And we'll dig a bit deeper as to your expansion plans later on. It's interesting that as we spoke to the SEC today, they mentioned plans. I mean, there are regulation around robo-advisors that's been released, but they mentioned other things that will be coming to the market before the end of Q4 this year. And it'll be good to see how the market adjusts and basically moves forward, and how the competitive landscape changes.
Yeah.
I'll move on to Razak Ahmed, who's also in the savings game, creating platforms that enable consumers save in a more efficient manner and give access to domestic mutual funds. Cowrywise has done this quite innovatively thus far, and it will be interesting to understand what the next frontier is for Cowrywise. APIs, for one, is something that we continue to hear more and more of, and we believe that that is a suitable way to democratize access to many of your products. How do you view this, and what are the trends from Cowrywise perspective in providing financial solutions to providers as well as end users?
Yeah, thank you, Sule. It's my pleasure being here. Yeah, the primary problem we're trying to solve centers around providing access, which is a main problem that's quite obvious in the market. And over the past 4 years, thereabouts, we've been able to provide that to thousands of users in Nigeria. But initially, the major problems are like two that we identified. The first being the availability of asset classes, right? Because from day one, while we understand that people needed access and they still need access to investment products, we also need to be quite sure that those investment products are quite available. So availability of investment product, the asset classes, I think is a major problem that we try to solve. So after solving that, then the next question will be, how do you connect that availability to users who actually want those products? And we've been able to bridge that gap. So what we've done so far is to leverage partnerships, right, with a couple of fund managers locally to aggregate all their mutual funds and then provide access to retail investors to be able to invest in those funds. And largely, we're actually leveraging on some mega trends to be able to do this. While we've been able to do this on a B2C level, there are trends that provide opportunity to scale exponentially. And those trends are mega trends happening not just locally, but globally. For example, mobile telephony adoption, growth, significant growth we've seen in digital product adoption generally. And this is not just related to financial services alone, but digital products generally, from mobility to telecoms to, anything that has gone digital provides an opportunity for people to experience what it is like to serve financial products digitally. So what we are leveraging on with the API is actually to leverage the superpower that this digital adoption provides to scale financial products exponentially. And what that entails is bringing in our previous experiences, partnering with fund managers to aggregate all their mutual funds, then digitize the entire experience and bundle everything into an API that allows any digital platform to be able to embed investment products and offer investment products to their customers. Because traditionally, banks will leverage branches, largely paper-based investment account creation and so on and so forth. But because of that digital adoption, there is a unique opportunity to leverage that digital space to offer investment products in a way that is completely different from how investment products have been offered in the past, but also provide efficiency and scale as key components. So that's what we're doing with the API. So overall, we're leveraging the mega trends that are happening globally and in Nigeria to aggregate key asset classes that average humans or average Nigerians can have access to, and then to use that opportunity to embed investment products in various digital platforms. We believe strongly that that is the ultimate yardstick to democratize access to investment products rather than going primarily B2C. B2C store was more or less like an opportunity to test the adoption of the product. Then distribution-wise, leveraging the API allows us to go at scale exponentially.
Thank you very much for that. And that's a theme we continue to see and hear recurrently, even from other infrastructure providers. There is a move by many players into becoming infrastructure providers themselves, just to grow volumes exponentially, and of course with that revenues. Perhaps now I move on to Tosin of Shaka. Shaka is one of the leading digital stockbrokers in Nigeria. It is the first digital broker to be licensed by the SEC, and this was pointed out on here and even in earlier sessions. Where do you see growth and the regulatory environment going forward? There have been certain announcements as of recent, and it'd be good to understand how that has worked and what the vision for the future is. I think the focus on digital stockbrokers in the past has been domestic markets, but also a big focus on foreign stocks. How has this changed thus far, especially given the sensitivities of certain agencies with regards to FX? And what is the expected focus going forward? Over to you, Tosin.
Yeah, thanks for that, Sam. So I think just to say, yeah, Shaka, what we do is we enable borderless investing for individuals to be and companies to be able to invest both in the markets locally as well as globally. And our mission and why we exist is to give the best investment opportunities, the same kind that any individual company has, say, in America, in Europe, or in Asia, to make sure that people in Nigeria and in Africa more broadly, we have the same access to the best investment opportunities everywhere, as well as, crucially, that we make investing in the local markets easier. So, let's call it the best investment opportunities as a honeypot to bring more people into the local market as well. And so far, we've seen that happen. We have over 120,000 people who signed up because of this mission, and we're very excited for where it is moving forward. From a regulation point of view, similar to what Odun mentioned, we did start in a place where we always set up to be very regulatorily conscious. We set up as if we were regulated. We set up to be transparent and auditable. In that same regard, we partnered with regulated brokers and as well still engaged with regulators as to our status. As of about 9 months ago, we started engaging with SEC in a more accelerated fashion. And, as of a few months ago, like you rightly said, we got the first fintech license for what we do and a newly minted license. I have no doubt there'll be more companies that will get this license as well. So it was a win because it gave clarity as to be able to offer and to be able to do what we do, the kind of agency that will oversee, as well as clarity to anybody as to the parameters in which you can operate. Now, I can't predict the regulatory future, but I can say, I think, a few things that just about just any market that's seeing innovation in the financial sector. I think there is a phase of innovation where perhaps there's less oversight, and there is a phase of regulation where it's very important to integrate and align with where the overall economy is going. I happen to believe that this is a situation that's playing out in varying degrees in other countries as well, as they're figuring out the lines between legacy and new players, where you cooperate, where you can compete, as well as what the regulator has to say about the parameters in which you can do what you do or what we do. I also can't speak to any particulars about FX and to in that degree, but I think what I can say as well is that ultimately the apex regulators for that are CBN and for investments are SEC, and super important for the scale in any of the industries in which we operate, that the structures are there and are there approved by the regulator. Otherwise, you're building on shaky ground. It's just, shall we say, physics. So we are big believers that it's really important that ground is stable, and we're very big believers that we've got to work with regulators all the time to make sure that we can ensure that they're comfortable with how we all operate, and to also make sure that we're evangelizing the possibilities, why this is so important for Nigeria. Since we started, the acceleration that we've seen in people's knowledge of the stock market, both locally and globally, has been insane, just because people can actually partake. There's a lot more education around, a lot more financial education, a lot more financial literacy, driven by some of the platforms, but also driven by individuals who have that expertise and can see people demonstrating and signaling their interest through participation. Ultimately, just like Razak said, I think there is a long trend of more financialization in African markets, as well as more digitization. So I think the train has left the station on this one, and it's just really important that we understand that the role the regulators play to make sure that it serves the economy. And I know that that's the angle through which they're looking at it. And I think it's really important for all of us building companies, that we get to understand where they're coming from and build on top of that. I'm not sure if that fully answers the question, Samuel, but I think that's probably a good place to start.
I think you have answered it aptly, and that advocacy is a benefit. The benefit of that advocacy is for the entire market, and as we try and tread through many of this, it's about creating value, and many of the regulators do understand, and the future is digital, and I think there's a very clear consciousness that digital wealth, digital asset management is one way of regulating better, but another way of pushing the markets as we move forward. Perhaps now I move on to Ibitunde Balogun of Tangerine Financial. Tangerine's business is mostly in regulated markets. Tangerine is a financial marketplace embedded in key regulated markets, including insurance, life, non-life, pensions, asset management, and most recently, digital banking on the Tangerine Money. Can you walk us through the vision of Tangerine and the problems that Tangerine is looking to actively solve?
Thank you very much, Sam. So I wouldn't call us a financial marketplace. I would say we're more like a tech company, but we flipped it out in terms of how we approach the market. So you mentioned all the different industries that we play in, but we started with acquisitions of life insurance businesses, traditional businesses that have been in existence for a lot of years. We acquired general insurance businesses. We're in the process of acquiring health insurance businesses. We acquired access pension business. So we're essentially a digital financial services platform, but slightly different to all the other panelists is that we started from the more traditional business where we acquire these licenses, right? And we own our own licenses. So we're able to then now offer digital financial services, right, through the backing of our licenses. So obviously we saw the regulation aspect of it being a key place to, a key thing in all this. And we say, let's just go get these businesses so that we are licensed to operate, and, transact all these type of businesses. But like you said, we essentially are going to do everything across the financial services space. From asset management to, we're going to chop into Shaka's market, into Odun's market, and we're going to try to basically provide that platform where essentially people are going to be able to, access all these type of products, right, digitally. So, if you download our app today, you see we have the digital bank, you see we have insurance, policies, you see our pension business over there. Over the next few weeks, you're going to see more products rolling out, right? And essentially, we're looking to partner, where we don't have some of these licenses, but to be honest, we're looking to get all these licenses ourselves and to actually then be a one-stop shop where, you go in and you actually can do everything in your financial services. So to answer your question very briefly, it's just to say we want to solve all financial problems of, Africans, right? So we want to have that platform where everything is clearly thought out, from your everyday banking needs to making sure you have insurance, to making sure you're healthy, to planning for your retirement, to buy an annuity, to invest, to save. We'll be able to provide everything for you.
Thank you very much for that, and we really like the passion and the vision for growth there. Interestingly enough, I'm sure there are certain partnerships that can be made, licenses and with and without licenses, and we look forward and we're closely watching as Tangerine proves its business model, which is already mostly proven. Perhaps we now go back to Odunayo, and let's talk around the M&A fit and how you've looked at M&A thus far and what your expansions plans are. Are you looking mostly to buy or disrupt, or a combination of both? And how do you juxtapose this with your funding plans, historical as well as forward-looking? Thank you. Odunayo, you're on mute.
Sorry, yeah. So I said historically, PiggyVest has been in the news for funding, I think once, which was in 2018 when we raised our seed round. Future funding rounds, we're still having conversations about that. It'll come, but we're like, we're a bit more agnostic about the whole, like, you need to like aggressively fundraise for the business. I think scale back can be achieved in other ways, right? And then as for the M&A fit, at several panels, we've kind of made it clear that PiggyVest is open to collaborations, to reasonable collaborations, I suppose. Like, we have to put that caveat. We don't think that we can build everything by ourselves, and we're not going to try. As much as we can, we're going to work with people. Where acquisitions are possible, we're going to acquire. Where like aspects of the business being merged together as possible, then we're going to merge. We're not like trying to build a super app in that way, at least not at like in the short to medium term. So the growth trajectory is, there is certain like aspects of the financial services ecosystem that we're focused on. And in those ones, we will absolutely be building to kind of compete. But in other aspects, we'll be open to collaboration, to acquisitions. And we've already been in the news for one mini acquisition. And so there'll be more announcements, as we kind of alluded to when we announced that as well. I think that Nigeria's financial like fintech ecosystem is very young, still very nascent. And I think that more than anything, there is still a lot of M&A plays that are yet to come. One of the things that we'll see with what we've seen with the more mature ecosystems is that it's very easy to build like small silos of these products. It's very easy to build small silos of these products and kind of like run in your own little corner. But if we're going to compete globally, and everyone is getting a global outlook now, we're all looking beyond Africa, beyond emerging markets to compete on the global stage, then we do need to be open to working together, because that's the only way to actually win.
Thank you very much for that. And just one final point there is, when you look at acquisitions, are you looking at talent mostly, or are you looking at the ideas and the tech behind it? Or is it a combination of both?
I think it's a bit of both. PiggyVest's founding team is, our founding team is largely like made up of engineers. And what we've done like very well, I think, is hiring all the really smart finance people and letting them make the decisions. So when we do hire, like, and then when we look at like what is a complementary company, it's not just about the ideas. Is about who's currently working on it and how can they come and serve. In a lot of cases, it's usually the talent. We want these people on our team. They're already working on something smart. How can we absorb them? In some very unique cases, it's the idea. They're already working on this. We didn't get the idea first. We could build it, but to what end? And then we go ahead and like propose a collaboration. So that's kind of how we see it. It's a mix and match. There isn't a science to it. I think a lot of these decisions are more like an art. And so that's how we approach it.
Thank you very much for that. And that was quite clear. We'll move on to Razak. And the question here would be, comment on the competitive landscape of the digital asset wealth management space. What do you expect will determine success as we move forward, both in the short term as well as the medium term?
Yeah, thanks, Sam. I think the space is still at a very early stage, And I'll look at competition from the perspective of the entire space versus the traditional, rather than internal. But if you look at it internally, there are different verticals that currently exist. While to some extent, there are similarities in terms of business models, I think the next 5 years, there will be remarkable differences in terms of how each company evolves, right? So currently, if we're to focus on the ecosystem alone, currently we have different players, doing different parts of the asset management business. Except, of course, for Tunde, right? Who wants to do everything, or who is currently doing everything. And that's fine as well with the strategy. But again, if we're to distill it into different verticals that different players, are operating in, Shaka, for example, is a broker, and they are focusing on that brokerage business. So I will assume that their business model is transaction-based. I'm assuming. I don't know what your business model is, but holistically, I'll assume that it is transaction-based. So the same thing with, say, PiggyVest. They have savings, they have investments, Tunde, pension, asset management. They even have a digital bank. So banking alone is a whole lot of headache, right? Asset management is a whole lot of headache. Combining that with retirement is a whole lot of headache. Brokerage is a whole lot of, is a massive space on its own. So those verticals, we are seeing different players emerging to occupy each vertical. Now, if we are to compare what all these players are doing right now relative to what the traditional players have done in the past and relative to what the economy is capable of producing or unlocking, I think the competition is what has not been covered yet, not within not among the players that currently occupy the fintech space. So overall, the determinant of success will be players who are able to combine or who are able to operate within the intersection of three major things. Regulatory compliance, largely because the space involves management of public funds as well. People's fund, not public as in government, management of people's fund. And anywhere in the world, when it comes to management of people's money, regulators are always on the lookout, primarily for the purpose of investor protection, for the purpose of building the market, for the purpose of ensuring that whatever innovation exists on a sustainable basis. So that's one key element. The second part is players that are able to identify the exact needs of the users. The important thing about user behavior in Nigeria today is that it is changing remarkably. And one thing that the traditional players are probably still trying to understand is the depth of that change, right? For example, if I'm a traditional bank and I'm developing a product, because I have branch networks, most likely an important element of that entire product flow will terminate at the branch level. But we all know right now, people don't have that patience to go to branches. But if you're a pure fintech player, when you design your product from beginning to the end, branch network as an infrastructure doesn't come into the equation at all because you've never experienced it. You don't even have the capacity to do that, or you don't even have the need to do that. So in terms of product thinking, in terms of product play, in terms of reaching out to the consumers, I think the contexts are different. So it is very important to understand that perspective. Then the third element will be companies that are able to identify the asset classes or build out those asset classes, right? And connect users to them. And that's very essential in the sense that Nigerian market has a very huge informal sector, right? The formal segment is not as huge. And if you look at the total value of asset classes we have in the country, even though we have different asset classes, right? We have equities, we have bonds, and well, let me say crypto, quote and unquote, just because it hasn't been regulatorily approved yet. But from users' point of view, users see it as an asset class, right? So the success of any player in this space will be determined by the ability of that player to operate within the intersection of these three factors. Identifying the asset classes that consumers want, playing within the regulatorily defined framework, and being able to understand users' needs extremely, extremely well. So those are the factors that I think will set each player apart. But at the end of the day, competing with the market that is yet to be captured, I think is the ultimate competition. Even though, yeah, there is competition within the space as we have it, because to a large extent, we all still target the same set of users. But overall, there is a huge pie out there that needs to be bit. So for example, if you look at the retirement space in Nigeria, the pension space, for example, it's about 11-12 trillion naira industry, for example. That's huge. And that space is primarily dominated by the traditional players. And for example, how many Nigerians are actually under that pension industry or are covered by the official pension industry? Probably around 10 million, 11 million Nigerians as well. So if you look at that, it says a lot about the potential that exists out there. So if a fintech player, for example, wants to do pension, that means one, you have to do regulation, two, you have to compete with the existing players that currently have about 10 trillion or 11 trillion naira. And this is huge value compared to what we all manage currently. I mean, all the players within the fintech ecosystem, asset management ecosystem, so to speak. So I think those are the major factors that I think will determine success. Regulation is very key. understanding user behavior is very important, and identifying all the major asset classes that users can have access to, including asset classes that cut across boundaries globally, because users want that. So how do you ensure you provide access to those asset classes while being regulatorily compliant? I think any user, any company, or any player that is able to hack that successfully will have success rating all over it.
Thank you very much for that comprehensive answer. And one of the key points is the pie is still big. Everything is nascent. So there's many individual races to be run, and the competition perhaps is now, but it's really around growing it and taking it from the more traditional players. The other thing that you mentioned that resonates is around user behavior and that determining what success is. And I think that's a theme that we continue to hear. Talking to Tosin or Shaka, it'd be good to understand the traction in the marketplace and what some of these customer dynamics or user behaviors you've witnessed from a digital broker's perspective, and how that has played versus your business model and market share.
Yeah, so, I would echo what Razak has said. Like, when we started Shaka, our expectations were very conservative. Even some people on this panel maybe invested in Shaka may know a little bit about it. But yeah, our expectations from the very jump were very conservative. Would people want to access this way? Do people really want to invest in the stock market? Is it too risky, et cetera? But we were governed by a thesis that just lowering barriers and making things easier, just like, just lowering the gradient of ground, water flows. We just expected more users, more people to be able to opt in if it was easier. And we were blown away in the first year by how many people and how much people participated. As I mentioned, we've got over 120,000 people who signed up, which is more than the expectation that we had, less than 2 years into the business from our initial projections. However, from getting in and looking at how widespread interest is, you talked about customer dynamics, you start to see some very interesting things. And this speaks again to what Razak just spoke about, which is listen to what users want and making sure we're tending to those needs. We started seeing that, yes, there is this narrative, and it is true, of a generational shift where younger people who are in the workforce and are growing the workforce have different interface needs, different expectations about how to invest, both in habit and in format. And that's not going to change. So it's really a question of how quickly existing financial services map to that versus how much they service existing customers. This is not a new problem. I think there's a whole book called The Innovator's Dilemma written on this. So it's every business has this question, but in the industry that is going on. And so I would expect every month, every year, that digital will take market share away. And there has to be some kind of calculation going on in everyone's mind as to when to invest fully and when to disrupt the existing business. And I think that's going to continue. But we also saw that, besides this demographic shift, that there were people in their 30s, 40s, 50s, 60s as well on the platform. And again, this comes down to user behavior changing, more people adopting smartphones, everybody's mother here is on WhatsApp, right? So, it's not a big hop for that person to download another app and choose to invest in an asset that they can only get through that mechanism. And so, the draw may be the assets for some, a special group of assets that you want. The draw for others may just be the format. And I think this is going to be a theme we continue to see in the marketplace as people bring more innovative products to market, as well as the formats of offering these products get more and more customer-centric. Moving forward, though, I would say we're so much at the early stage of the market. We're all at the very early stage. I would expect 5-10 years from now, we're talking multiples of where we are now. And I'll say right now, I do believe we all compete more for things like investors and partners and even regulatory attention, areas where we can also collaborate, than truly for customers. I would hazard a guess that for most people, the demographics of our customer bases are probably quite intersectional, and users probably use us for different reasons. We've seen a lot of cases where users may may use an existing channel for some services we offer and may use us for a different service that we offer. And so in a sense, the user is choosing how to distribute their share of wallet, choosing how to distribute services. Even if you offer more than one product, this bundle is serving different people in different ways. And I think moving forward, as we all evolve to serve our customers and whoever our main cohorts are, we'll see more differentiation naturally. I do think that's going to be a case. So I think we're more similar today than we probably will ever be as we continue to move forward. But right now, I would say, like, for us, our main focus on our customers, is on our customers and making sure that, beyond just serving the nascent new entrant to the market, the person who's just learning how to invest, that we're also not neglecting the people who have been investing for years and years, have existing habits, or are looking for an easier way. This customer typically has more capital and is typically very, very aware of the benefits of that digital investing provides. We're sometimes classed as a digital broker, and I think that's fair. But our mission is definitely about making investors smarter, helping them hit their goals, and making the friction to do that less. And so we will continue to offer products and break new ground in products that allow us to do that. And so far, our customer base has been clamoring for that. I think, again, that's a common theme we'll all see. Like, Cowrywise have such a great brand, so do Tangerine, and so do PiggyVest. And I think you see customers buy more into the brands and the belief they have in the services that we all want to offer, that Shaka wants to offer as well, and evolve with the brand, than I think having a more, shall we say, pick and choose or rational, I won't call it irrational, but a more dispassionate view of, like, you offer X, you offer Y, I choose X, I choose you for X, I choose you for Y. I think it's likely more an investment in the journey with the brand. And I think we all are taking customers on that journey in different ways.
Thank you very much for that, and very clear. I think a main part of what you said is digital wins. And when you look at the business of Tangerine, it's a digital platform, and that's the way it's positioned. Traditional businesses, yes, but digital platform with extreme aggression behind it. It would be good to understand, Ibitunde, how those businesses have performed thus far, what their plans are for the various businesses, as well as for international expansion. And whilst we look at international expansion, what markets excite and why?
Okay, yes. So for us, these businesses have been. So they were traditional businesses who already had customers. So our model was slightly different, where we were not starting from zero in terms of our customer base. We already had over 2 million customers, right, across all the businesses that we invested in. The real problem was now trying to digitize and get more and create more value for them. So a lot of our customers, were engaging with the old companies by going to their offices and filling out forms and all that. And we said, look, you know what, we have this customer base. We want to attract and get the new customers that Razak is talking about. But we have low-hanging fruits where we have, hundreds of thousands of customers. Let us digitize their experience and make them fall in love more with tech, right? So they can easily do they can easily buy products, they can easily buy services. So these businesses are continuing to grow because essentially we have optimized the traditional businesses. So they were growing maybe 5-10% year on year. Now that we've accelerated that to grow 20-25% year on year, and we'll continue to do that as we digitize the businesses. Obviously, we're aggressively going after the new markets, right? So I 100% agree with Razak that the competition is not really within the space; it's really with the traditional businesses, right? And the people that are unbanked, the people that don't have access to a lot of all these services. So we're growing the business through using tech to optimize the processes and continue to then escalate. But then we're also trying to then rapidly expand. We have appetite for and you would know this, other African markets, the usual suspects, so Kenya, South Africa, Egypt. But we're also seeing a lot of activity in the Francophone, West and Central Africa, right, in the likes of Ivory Coast, Cameroon. So for us, it's about where we see we can create value, where we see we can add more fire to the Tangerine, to the Tangerine family, and we can just continue to grow. So yeah, those markets are interesting to us. Our approach is to acquire, and set up different platforms if we have to. So essentially, it's just do whatever we need to do to make it a success. The goal is to completely create digital financial services for Africa, whether it's through acquisitions, whether it's through setting up new businesses, whether it's through enabling traditional businesses. That's what we want to do. So it's we're optimizing essentially the traditional businesses that we did, making them completely digital, and then we're building and acquiring new digital customers.
Thank you, and I believe you're doing that under a single brand being Tangerine.
Correct.
Good. I think what I'll do now is ask a question around the consumer, because at the end of the day, all these services are created for the consumer. The competition for the consumer remains very fierce, whether it be, and the easiest consumers naturally are ones that already have some version of this service, which is now being optimized. So you've got competition from banks, neobanks, crypto, payments companies, mobile money, and everybody in between. And it'd be good to understand how fierce this competition is, and how do you understand what the consumer is worth? Is it the same consumers across the platforms? And what are the unit economics and the potential for scalability as we move forward? And I think I'll ask all the panelists this question, but starting with Odunayo. Thank you.
So yeah, I think that there's very fierce competition that's ongoing right now, and it's not because the competition is particularly internal. It's because whether we like it or not, we're all competing for the share of card of roughly the same pool of people. And at the moment in Nigeria, I think there's about 41 million unique BVNs, and so that's indicative of just how many people is in the larger pool. And then when you distill it, I don't think there's anybody here on our platform, on this panel right now, who's doing mobile money. So if you're doing to the banked people, to the people who interact with financial services on their phones, that number becomes a bit more narrow. So while there is still a bit more to capture outside of the people that we've already captured, there's still a bit of competition between the 4 companies that are sat here today, because outside of the products that we provide, there's several financial services products that are being provided out there, right? A lot of the reasons, because we're really a lot of us are focused on, I think 75% of us here are focused on Naira-based products for now. And as you can see, crypto is slowly, but almost very surely eating into the market, right? So, there's people with hundreds of thousands of users. We have millions of users on the platform, and we want to keep that going, right? You want to keep acquiring more people, and you want to chart a path to 10 million. Everyone wants to get to the 10 million user mark and the 20 million user mark, but we can't not acknowledge that there is quite a lot going on, and the fight for disposable income for the average Nigerian, which isn't a lot, is really on. And as much as it's okay to there is a bit more to be captured out there, but as it is right now, as everyone's, you can tell from, I don't want to belabor the economic situation too much, but it's a big indicator in how people relate with financial services products, in how people relate with digital services products. And, it's shrinking just because we're going through a bit of a tough time, right? And people are, more than anything, the average user, the consumer is trying to optimize their returns. The consumer is trying to beat inflation. And so when you put all those things together as considerations, every single platform on this panel is doing their best. But we all have far more than how many BVNs can we capture today to contend with. And thinking that way makes you realize that the share of card that we're all fighting for is a very limited pool, and the competition is very fierce.
Thank you very much for that. And perhaps I'll move to Razak on your perspective.
Yeah, thanks, Sam. I think it's a bit difficult to assign value to a customer right now. I don't have it, frankly. I don't know if anyone on this panel has one. Please share with me. It's quite difficult, and the reason for that is because the space is still very early. We're still trying to understand user behavior, trying to understand what resonates well with the users. More and more, add more products, to add more features to the products. And because we also operate different business models, right? Some business models, they are primarily based on transactions, like volumes. Some business models are primarily based on AUM in terms of core asset management, and you take a fee on that. So there are different business models that we all operate. So it may be very difficult to actually assign a specific value to a customer. But an alternative approach to look at it is to look at what the purchasing power is for an average Nigerian, for example. Because when you talk about asset management, you're actually talking about people consuming and then leaving something of consumption to save and invest for the future, right? So what is the purchasing power that an average person has? How much pressure does an average person undergo in terms of their wallet, right? Economically speaking, we've not done really, really great in the past 2, 3, 4, 5 years. This is not a political discussion, but we've not done really well economically speaking. So if you look at the per capita income, the numbers are not smiling. And these are the indicators that can unlock the value that an average user has in the country. Just as a scenario, imagine if we're able to double our per capita income, or we're able to take it to about $10,000, for example. The value that will be unlocked as a whole will be much more than the sum of the individual parts. And that is the benefit that comes from the multiplier effect, right? So there is a huge opportunity, but we also need to understand the constraints that currently exist, right? While the potential is there, we also need to understand the constraints. So in terms of the unit economics, I don't know if, I think from the business side, it makes sense, right? In terms of providing access to investment opportunities at scale to people, it makes perfect sense. It makes perfect business sense. That if you're able to provide this solution at scale, you should be able to benefit from economies of scale, you should be able to beat down the cost, you should be able to be more efficient, and so on and so forth. So from that point of view, you will say that the business model should be viable in the medium to long term, right? So, but how viable that is, there are so many factors that can impact that. Economic factors, effects, and so many other things. Regulatory development, evolution of consumer behavior, deployment of technology. There are so many things that happen at global scale that impact us locally as well. Crypto, for example, to what extent will it disrupt what we have here? To what extent will people continue to adopt it? And not just in Nigeria, globally, and so on and so forth. So that's for that. Competition, well, I think, although it's quite right with respect to the level of competition and attention that we all focus on, like probably the same space, the same set of customers. But what we also seen is that there are certain factors that intensifies competition. One is, say, for example, if it is very difficult for you to enter the market, right? If it is difficult to enter the market, then competition becomes less stringent. But right now, what will happen in the next few years in the space is a situation where it's a lot easier to enter the market. And the reason, possible scenario is that it will be a lot easier to enter the market. And that is primarily because if you look at what exists within the payment space, payments, for example, unlocks a lot of opportunities, right? Innovation in payment space, in the payment ecosystem, unlocked massive opportunity for digital financial products like savings and investment to be able to, for us to build on that. And that is primarily on the back of payment infrastructure, right? Now, if we have investment infrastructure fully built out, the entire investment experience is digitized, then the infrastructure play comes to fore, which means for any player who wants to come into that space, even though there is regulatory barrier, that API infrastructure can actually serve as an abstraction of all those problems. So you don't need to face regulators because you're already using an API that is regulatory compliant. You don't need to, face product development because there is already a product that has been developed. You don't need to go through 6 months, 12 months of product testing to actually identify which product resonates well with the customers, because all these have been. So there are lessons as well that come in from the various experiences of each players that new players might not necessarily go through. So they might not pay that school fees that most of us have paid here to come into the market. But again, they will have to contend with the size of the existing players as well. So I think overall, it's a balanced game. Competition will still be there overall, but there are certain things that new players will find extremely easy to do. But there are certain things they might find difficult to do because existing players have already, scaled that hurdle overall. And in terms of the value of the users, as I mentioned earlier, overall, I think we should just try to be extremely hopeful that the purchasing power of an average Nigerian swells over time. Because even though the expectation is that will happen, it's just a matter of when, frankly. With the right policy in place, the right support for the government, the right regulatory developments, and the right understanding among all the stakeholders, I think that value can be unlocked massively. And by then, we just be sharing the pie, I think, rather than competing for a very smaller one.
Thank you very much for that. I think what you're saying is something that resonates across all markets, as well as all industries. A rising tide lifts all boats. But the one thing I've gotten so far is digital wins, and the fact that from a macro level, it's a youthful population. As that youthful population goes into, starts to work and goes into the economy, what they are used to is what they will continue to utilize. And that basically points to digital once again. Perhaps I then hand over to Tosin to give his perspective on those questions.
Yeah, I think really great points by both Odun and Razak regarding just share of wallets. It's a reality. But I think not all wallets are equal, and I think that's perhaps not maybe a hidden truth behind making all our services work, because I think everybody here is committed to financial inclusion. For example, on Shaka, somebody with 2,000 Naira can open an account and start trading, buying GT Bank or buying MTN and or otherwise. But it's quite clear that somebody as well with 2 million Naira or 20 million Naira can do the same. And so in a sense, the distribution of customers and their value of their wallet, which is a different thing about the value, I think is a different question about access. I think those are two orthogonal things that, yes, we still are all subject to given the macroeconomic factors, but I think we shouldn't underestimate the degree, again, looking at disruption angle to which everyone here could be serving both a high access group, but also competing and serving better people with higher wallet sizes who may be with traditional players. And I think that's a trend that we'll also see pick up. I think something that's also not to be underestimated that is a barrier here is even that share of wallet that we're all competing for, how fast it's growing despite the overall wallet size, wherever that is. And I think those are linked a lot to trust and education. With a lot of what we do, all of us on here, it's similar to health in that if you know it, like truly know it, and you trust who's gonna do it for you, you almost definitely will. It's just good for you and it will help you achieve your goals versus a discretionary thing that you've got to buy into or you've got to be convinced of, like say buying, a certain product or certain brand. Financial services, just like health services, are meant to be objectively better for you. But the things that get in the way are trust and education. And I think cumulatively, we're all building that up. So I would also expect that just as a percentage of total wallet, that we would see how much people are investing or saving. I think we would see that go up as well. So I still think there is a secular trend of digital eating more share, more trust, more education in the market, growing share, and probably all digital services serving as well higher value customers over time, just given as our service capabilities continue to expand. And maybe there might be some natural advantages from having large groups or large access of retail customers, I do think that you'll see the ability to serve higher value customers, higher wallet sizes continue to go up. So I agree with all the points re competition, but I do think the pie will expand even in a market where overall investments may not be expanding, or in a market where the economic situation may not be trending in the best fashion. I think digital will continue to grow because of these factors.
Thank you very much for that. I think last but not least, Ibitunde, and what I did hear from Chake is that not all wallets are equal. There is still value to be made. However, perhaps all wallets are up for grabs. So Ibitunde, it would be good to get your perspective on this.
Yeah, definitely all wallets are up for grabs. I think for us, like Razak and everybody else has said, you can't really put a number, try to ascertain the customer value. But what we try to do at Tangerine is essentially be with you from the beginning to the end, right? And I think a missing key in a lot of conversations around finance in Africa is the insurance element, where you have people who have all their savings wiped out because of an incident. So a family member is sick, or there's an accident or something happens, right? And there's this whole share of wallet, then I have to go and break my safe lock, right, with PiggyVest because something has happened, right? So I think for us, we try to look at the customer holistically, because we can offer you either, if in retirement, whether you want annuities or pensions, program withdrawal, or through the course of your life, education policies, life insurance, health insurance, you want to travel insurance, you buy a new house, a car, and obviously all your payments and stuff. So I think with product evolution, we'll try to capture more share of the wallet, obviously trying to be there at every step of the way. So we are designing our product in a way that you can actually use that product all the way from probably 13, 14, if your parents can open you a junior account, till 60, 70, and there are so many different products. Obviously the total economic system, the total economic environment that we're in, is going to hamper the disposable income. But I think that's going to grow over time, as people get more sophisticated. You would see that people can actually get more for the amount that they have, right? They can actually know when to invest, when to buy Tesla, or when to buy MTN and know the returns that you're going to get, and when to do insurance. So yes, even if you don't have that much, making sure that you buy the right products that would help you navigate different circumstances. So I think product innovation will play a role in that, you're being able to capture more value from the customer, and also build financial freedom for the customer. So that's what I think about that.
Thank you very much for that. And I think this essentially wraps up this panel discussion on digital asset and wealth. Gentlemen and ladies, you have heard from the foremost entities in this space, trying to create value for consumers, trying to make sure they have a very smooth and efficient experience as they create wealth for themselves, as well as their various families and society. And we're very keen to continue to hear from you. Many of these entities are very open and have presences online, and thus I'm sure you can download all of the apps, test them yourselves, and share your feedback as we move forward. Thank you again to our panelists, and thank you to the audience.
is information. But not all information turns into knowledge. Today, every company leaves digital footprints in hundreds of different sources. But this information by itself does not tell you who it is you're looking at and what the risks of doing business with them are. Businesses can't exist in a vacuum. They need employees, customers, partners, contractors, investors. Good counteragents help a company succeed, create products, make profit, expand business opportunities. But what about bad ones? 49% of organizations around the world say that they've been victims of fraud or economic crime. 2/3 of Russian companies say they've encountered economic crime in the past 2 years. This is significantly higher than the global average. Every year, 15% of companies simply disappear, whether on their own initiative or because they're forced to do so by tax bodies, often leaving unpaid debts. If you want to minimize your risk, you need to find and analyze every scrap of information you can, identifying, analyzing, collecting facts. Processing big data is impossible without qualified specialists, experience, time, expensive equipment, new technology, machine learning, graphs. Spark Interfax gathers information from all available sources and converts it into knowledge, allowing you to see the world of business in its entirety with all its risks and opportunities. And there's no doubt that tomorrow we'll be able to understand the world of business even better, thanks to the emerging digital economy, cutting-edge technology, and the availability of new information about the lives of companies. Knowledge decreases risks and creates trust, the foundation of any successful business.